largest crypto trading event the world has ever seen.
If you think trading is easy, that's the fastest way you will actually get wrecked.
The market will fuck you whenever it wants.
I still think within 12 months we're at 20,000.
I look at the chart of Bitcoin and it's a beautiful triangle pattern.
Over 9 hours of non-stop crypto content, 30 plus trading experts, 11 star-studded panels, featuring speakers like Mike Novogratz, John Najarian, Raul Paul, and many more. This is Cointelegraph Crypto Traders Live.
What's up, YouTube? I'm your host, Giovanni.
And I'm Jackson.
Welcome to Cointelegraph Crypto Traders Live, the world's largest crypto trading live event.
We have over 9 hours of crypto content coming your way today. We're going to be talking about everything from technical analysis to the psychology of trading to how to build the best crypto portfolio.
And we have an amazing lineup of guests coming up, including Mike Novogratz, John Bollinger, and Raul Paul, and many more.
So without further ado, let's bring out the first panel, which is going to be how to avoid mistakes and start trading like a pro. The guests will be Vays, Michael van de Poppe, and Eric Crown, and the panel will be moderated by John Najarian, who is the founder of Market Rebels. Take it away, guys.
Welcome. I am John Najarian, and I'm delighted to be here for Cointelegraph and all the nice folks over there that have got this event together. We are going to be getting to your questions. Mike's going to be moderating them and popping them in to us throughout the session, so please do ask questions. Feel free, because these are three of the not only biggest crypto traders, active traders, and YouTubers, but truly crypto influencers as well. Folks, as you can see on the screen, Eric Crown, Mike van de Poppe, and Vays. And guys, let me welcome all of you guys. I'm sure it's been a wild several days for all of us, even if you're just watching. Even if, I'm more of a hodler than a trader these days for cryptos, but man, it has been all over the place in a good way. I think anyway, because I'm a guy that, like I say, has embraced what you guys have basically been out there proselytizing for years. Because again, folks, these guys all have very successful YouTube channels that introduce people to crypto, that talk with people who are already engaged in trading digital assets. And that's why this is such a cool thing. So thank you guys for being here today. If you don't mind, maybe we kick it off with just, let's see, how did you guys get started? Maybe briefly, because I'm not going to give you guys the background on these people. I'm saying that you know who these people are. And if you want to ask me questions to ask them or whatever, feel free. But Eric, let's start with you. How did you get started trading crypto?
Yeah, absolutely. And pleasure again to be here. And thank you for inviting me. And the way that I got started in crypto and actually trading in general was I must have been like 11 or 12. My father was a trader himself to bring me down to the floor of the Pacific Stock Exchange. And I used to be his clerk every summer as a kid. Kind of evolved from there into college, where I kind of reached out to one of my family's friends and essentially harassed him into letting me kind of shadow him as a market maker on the floor of Arca, of which that's where I got most of my experience. And then a few years ago, started hearing more and more about this good old Bitcoin thing. And 2016, 2017 happened, and I started to switch on over full time, and really haven't looked back since. Actually, really very much enjoying it.
And are you pretty much, swing trading? Is that, are you basically catching that momentum back and forth, Eric? Is that one of your main things?
No, I've always been more so on short-term timeframes. I will play longer term when the opportunity comes. But the big thing with that is that more often than not, there's not big swing opportunities. It really only happens a few times a year, as far as I'm concerned. So most of the opportunities out on the shorter-term timeframes for myself. Playing mostly options versus spot and futures.
Michael, how about you? Not only, how did you get started in trading digital assets, but what do you think of the most recent move that we're seeing here in Bitcoin in particular, and any other you'd like to address?
Well, first of all, thank you for having me. My name is Crypto Michael. For the people who don't know me, I'm not American. I'm living here in the Netherlands, and I'm based on the old Amsterdam Stock Exchange. As you can see above me, it's the old jackets you wear during the trading in the 90s. I got into crypto during 2016, 2017, so relatively late. And it became from a hobby towards a passion, towards my lifestyle. I guess it's the standard for everyone who gets involved in crypto. Regarding the recent move, I think it's a really interesting move, as what we see is that the dollar is weakening, and at the exact same moment, gold, silver, and Bitcoin started to rally upwards. And that's the impressive part of it. And I think that's different than what we have seen in the previous months with the S&P correlation. So I think we are getting into a very interesting period in which we are acting as a safe haven, or want to be. So yeah, it's been crazy days. I've been working all out, 50, 16 hours a day, but hey, that's the life of a trader.
Very true, very true. And Tone, I wish I had dinner with Eric and Michael as well, but I've enjoyed a couple of great dinners and conversations with Tone. But for those who don't already know Tone, how did you get started in trading crypto, and what do you think of the most recent move here?
Sure. So I got started in trading around early 2000s, coming out of the .com crash. Basically took technical analysis courses from those that able to survive the .com trading days. And so I've been mostly a swing trader after that, even though I did work at companies like Bear Stearns and JP Morgan, where my trading was somewhat restricted because I did have a job helping to build risk models. And I got into crypto around 2013, and that's when the altcoin exchanges were just becoming popular. Those were the days of Cryptsy. That was like one of the first altcoins trading platforms. Then I was there for like when things like BitMax launched. So I was trading crypto in those early days, but I kind of, I got tired of sitting behind a desk basically and trading. So when I had the opportunity to start traveling the world in late 2014, early 2015, and just evangelize Bitcoin, I took that opportunity and I really enjoyed it. And what I've been doing since mostly is educating people about trading. Trading isn't going anywhere. I'm not actively trading now, especially crypto. I just find that ecosystem to be so immature, and I don't want to entrust my crypto on these exchanges. But I still trade traditional markets. Now that in quarantine, I'm back to trading options, option strategies, option spreads, because it's all the same. Trading is trading. Whether you trade altcoins or crypto, or whether you trade traditional markets, your tools are not different. Your market is different. And for me, and we're going to talk about it later on the show, if you're going to trade crypto, it is more pump and dumpish, and that's just not my style. Only Bitcoin has some technical analysis you can do on it, but everything else more relies on chat groups and this immature market like penny stocks, which I wasn't a fan of back then, and I'm still not. So if I do go back to trading crypto, it would only be Bitcoin on the most reliable liquid exchanges there is.
Gotcha. Well, and like I've said, folks, these three gentlemen do have massive followings for YouTubes that they've done. So I'd encourage you to check those out. We'll make sure we get some of that information posted here to you. But if I could, guys, maybe switch up to just a little bit. Let's see. This is one that none of us really like to talk about, biggest mistakes and so forth. But if you wouldn't mind just, a quick, we can do these kind of rapid fire, some big mistakes you've made. I'll start with you, Michael. And this is not, to take you down at all. It's just when you made that big mistake, what did you learn from it? I guess the audience would love to hear that, Michael.
I guess the biggest mistake I've made is I traded Digibyte in 2017, and then that coin went like 50x into 2 weeks. And then at the top, my mom said to me, maybe you should sell some of it because it's a great money you make and stuff. But I kept it, and the dollar value remained the same, or sort of the same, the months after, because Bitcoin went up. But my Bitcoin value completely got crushed. So in essence is that people should be checking both the BTC and the USD pair if you want to make more BTC. That's just the key rule of it. I wanted to make like 50, 60 grand in that trade, but it came all the way down, back again, held it too long. So I guess taking profits, they are profits when you take them, and if you keep them in the coin, it can just disappear. Profits are not profits until you liquidate it.
Same story, Eric. I mean, I'm sure some of that resonates with you, but as a guy who started off on Arca, which was, an archipelago, folks, is a group of islands. And the guys that started Archipelago, that was, of course, a stock trading venue. So you had to learn some of those same hard lessons, I'm sure, Eric, because Archipelago was one of the biggest things during the .bomb era. So, but it could be digital or it could be stocks. What was your biggest mistake?
Yeah, so my biggest opportunity for learning, we'll say, which definitely didn't feel like that at the time, it really sucked at the time, was when I was actually trading a couple years after I became a professional market maker on Arca. And I thought that my knowledge of the markets and I thought that my tools and the access that I had to some of the advantages that you get as a market maker made me invincible. I was getting mentored by some of what I consider the best traders in the world. And I thought that gave me knowledge that, was basically godlike. Well, I was very much humbled a couple years after that and pretty much blew up my whole account and pretty much went from, having a nice living to having absolutely nothing, being completely broke. And that lesson, while it definitely did suck the most at the time, it was perhaps one of the most defining lessons of my life and one of the most defining times, was incredibly difficult, but that gave me the emotional leverage that was needed in order to make the right changes going forwards, which is the lesson that I learned there was at the end of the day, the market's always right. You're always wrong. So you better be able to adjust your opinion and realize that you are the bitch of the market at the end of the day.
The bitch of the market, did you say?
That's right. We're all getting spanked, baby. We've been bad boys.
And folks, Eric and I had not discussed this, but my first 40 companies, and yeah, I had over 40 companies because I'd set up, Eric, each trader as an independent company, as an independent LLC and so forth. So when I
back when people were independent.
Yeah, because that way it wouldn't be a house of cards. If I had one bad trader and he or she over levered and got into trouble and, the blinders went on or something, they could take everybody down, right? So instead I siloed all these businesses. So I'm not trying to say, oh, John's some big conglomerate. I'm just saying, if you're putting up, like Michael just said, 50 grand to make in trades and things like that, when you back a trader, maybe you're on a 50-50 split or whatever it is for the first, until they return the capital. But the name of the company, Michael, was TMAR, T-M-A-R. The market's always right.
They are.
Just like Michael said, folks, the market is always right. And you hear people flippantly say on CNBC and elsewhere all the time, things like, well, your liquidity can run out before you're right. You can be right on what's going to happen in Tesla someday. But if you decide that I'm just going to be short Tesla in the face of, this huge whoosh, and the head of Volkswagen says, this is going to be the biggest company in the world. I don't buy that, by the way. But if the head of Volkswagen thinks so, great. You don't want to, your liquidity could run out well before you're right on that trade. All right, Tone, how about you, sir?
Sure. I'm actually going to go the other way. From Michael, I have never considered missed opportunities mistakes. A lot of people think they're mistakes, but they're not. People always say, Tone lost so much money not making money in Ethereum. No, that's not how it works. I'm sorry, guys. Like a missed opportunity, there's always another opportunity. So to me, those aren't like mistakes. They're like there are regrettable trades. I had in 2018, I went huge leverage short on Bitcoin in October 2018, right before it crashed 50% from 6,000 to 3,000. I ended up losing money, and I went even more leverage short on Bcash at the time, which would have made me more money. We're talking that would have probably made me 10 to 20 Bitcoin on that one trade. Unfortunately, I had my account closed and I never got a chance to profit that trade. My account was closed by the exchange, and this is another reason why I don't like crypto exchanges. My account was closed like a few days before the 50% crash in Bitcoin from 6,000 to 3,000. And that's not even my mistake, right? And so that's kind of regrettable, but I sleep fine. Missed opportunities to me is not a big deal. The biggest mistakes have always been being over leveraged, being too confident in the market. And for example, even the last couple of months, like I thought that this rally in the S&P 500 was going to end. And I kept attempting to short the S&P 500 starting in like June and July. And those trades were just very, very frustrating. And I was very confident. Probably lost a little more on those trades than I should have. I also made big mistakes. I learned my lesson in 2006 when I kept shorting the real estate market, shorting home builders, shorting everything. And my options just kept expiring worthless until I ran out of money in very early 2007. And I blew through my trading account shorting real estate and went and got a job the next month at Bear Stearns, which less than a year later went down because the real estate crashed. So all I had to do was just not bet so much on all these positions. And that's why risk management is so important. It's really a long game. If you think that you're going to get rich real quick on that one perfect trade, you're going to learn real quick how you no longer have a trading account.
Yeah, I think many of us have been there. We've got a question from the audience that I'll pose to all three, Eric, Tone, and Michael. And I'm sure you'll chuckle when you hear it. Can you tell us some guaranteed returns trading techniques? Other than buy low, sell high, Eric, what are some guaranteed return techniques?
Guaranteed return techniques. Sir,
is there such a thing? Is there such
no, there's not. There's not, man. I've been around the best traders in the world. I don't know a single trader who gets 100% of their trades right from top to bottom, ever.
Correct. How about you, Michael?
Well, Eric is right. I mean, if somebody is saying that he's right 100% of the time, it's just a troll. It's just a fool. Nobody can say that they are. Nobody should be sure about what's going to happen in the markets, as you're just, well, the bitch of the markets. So, yeah, I mean, we're all betting against each other and we don't know where everything is going. So in the end, the market is right. And you just got to develop your own strategy to become a better trader, with mistakes, with failures, with losing money, with roller coasters. And then in the end, you develop your own strategy and then you luckily start to make money.
How about you, Tone?
I'll bite on it. Obviously, there's no such thing as a guarantee, but I think the closest strategy to some kind of guaranteed return is covered calls. I'm really a fan of that strategy. It's slow, it's methodical, and it does require fundamental research. Nothing is ever guaranteed, but if you are an expert at covered calls, you can, I believe that a proper methodical covered call trader should beat the average market returns, what the S&P 500 gives you on average over the last 100 years, averages like 7-8% return. I think a good covered calls trader can beat it. Now, you're not going to make 50% return in a year as a covered calls trader. And of course, you could buy the stock and sell calls on a company like Wirecard that goes bankrupt, but those are very rare. So obviously, there's no such thing as a guarantee, but and the people that ask this, want to become millionaires immediately. But if you are looking for something, some kind of a steady return that's more than average, start learning about covered calls.
If I could respond to that, actually,
sure.
I would massively disagree with that. As an options trader myself for many years, covered calls are great. Absolutely. That used to be a base part of my game, but saying that that's a guaranteed return strategy is a little bit dangerous, mostly because, well, if you have anything like we had in the last year where S&P did dump pretty damn hard, it doesn't protect your downside at all. You're fucked below your strike price. Zero protection.
Well, no, that is true. And if you started doing that strategy right before the crash, that's fine. But if you have been doing covered calls for 10 years going into it, you've certainly outperformed the market as well.
Yeah,
there's
but like
a lot of corrections within that 10 years, I'd have to say.
But again, but yeah, like we're talking about a guaranteed return, relatively speaking, your guaranteed return versus the average stock market return. And in my experience, if you are just, if you are simply a buy and hold investor, in the S&P 500, you should be able to slightly beat those returns if you do your homework in covered calls. Now, obviously, you enter the wrong trade. Again, if your entire covered call strategy is on something like Wirecard that goes bankrupt, then yes, but it still requires diversification. It still requires a lot of homework.
Right. I see what you're saying, Michael. There.
Well, no, I wanted to say something about, like, if you bought a dip on Bitcoin the past 10 years, you would have made a fuck ton of money as well. So, I mean, it's all depending on whatever you do, but like covered calls as a guaranteed trading strategy close to it, I'm not buying that.
All right.
I've been doing very well with it. That's been my main strategy right now in my retirement plays, and it has been outpacing buy and hold. So, but again, it's not easy. Like, it's the work you put into it, right? Buying and holding the S&P 500 over a long term will net you that 8%. If you do enough homework, you can up that, but is it worth your time? Like, could that time be better spent somewhere else? So nothing is free. So it depends on how much work you're going to put into it. You know, an extra 2% return on your portfolio may not be worth the time you're spending on it to get that extra 2%.
Gotcha. And I think where we're probably all on the same page is that it will enhance a return, but it's the same as a naked short put, as Eric and Tone and Michael know. If you short a put at, 10,000 for Bitcoin strike or whatever, that's the same as a covered right, owning the Bitcoin itself and putting out the call at that strike at 10,000. Yeah. It protects you only as much as...
Guys, there's always stop losses, right? No one is forcing you to hold an asset as it's crashing, right? You can still put a stop loss on the underlying asset.
Sure. And then you'd have to buy back your covered call because now it's naked.
Well, of course, but it would be a lot cheaper than what you sold it at if your stock dropped.
Yes, very much so.
Like, you don't have to hold through a crash. No one is forcing you to. So again, look, guys, trading isn't easy. And obviously there's no such thing as a guaranteed return. But over the years that I've been using covered calls, it's a very underrated strategy because it's so slow.
Yeah, well, the way I always pitch it, guys, covered calls, is, it's just like you have an apartment and you want to rent that apartment out and collect rent every month. Now, if all of a sudden something great happens, like Bitcoin surges, or if all of a sudden your, let's say your town got an Amazon fulfillment center and 20,000 new jobs showed up and everybody needs a house or an apartment or whatever, you could see real estate prices jump. So if you said, I locked in a rent for 1 year for this apartment, you're cursing yourself because, you'd rather be out there selling the apartment at twice the price that you bought it for. So covered calls limit your upside. They, just like Eric said, they don't give you all that much protection to the downside, but in particular in a, up and down without being massive, Eric, up and down market, if you're just churning, it can be a good return. But again, none of the three of us or four of us are saying that this is a guaranteed return. There is no such thing. People all, for instance, just very quickly, when I talk about what we do using an algorithm to find our trades and jump in and jump out, we are probably close to 77%. And just think, if you were at a table in Vegas, blackjack, and you're at 51%, they'll kick you out. Because if you're a good blackjack player and you're counting cards, they'll kick you out. Wall Street or crypto, they don't kick you out for counting cards. You get rewarded for counting cards. And again, but that still means that I have at least 23% of my trades, nearly a quarter of my trades are losers. And I have to cut them and move to the next trade. So I bet you guys have similar views, but what I try to do is have small losers and let the winners run as much as I can. So I set, since I mainly trade options, I set, whether it's on Bitcoin or whether it's in the stock market, if I have a 50% drawdown on an option position, I cut it. That's on an option position. That's not saying I ride Bitcoin from 10,000 to 5,000. That's on an option position where I've paid $200 for an option and it falls to 100. I'm out. I figure whatever research I did wasn't good enough and I'm out.
I'm usually out at 35 to 40%. I'm usually out earlier.
Yeah. Well, like I say, everybody needs to just have their either mentally or, like you've said, Tone, set a stop loss, whether it's mental or whether it's an actual physical stop loss through the brokerage or whatever connection you're using to get into those options. But anyway, those are options. Let's talk about this. Did you guys have, and I'll start with you, Michael, did you have a mentor or a coach, somebody that trained you, that helped bring you along in trading?
No.
No, not at all. How about you?
I don't have a coach, so
all right.
Maybe Eric has.
Eric, now you started off, you must have been, like you said, you started with your dad on Wall Street. Did you have one of those guys at Arca that was like a mentor to you and that taught you some
absolutely.
trade?
Absolutely. In every facet of my life, with any skill that I've ever tried to learn, I've always followed the same sort of process, which is find a mentor at first who is exactly where I want to be, and then just listen to them, just do exactly what they say. So that's kind of how I leveraged my connections when I was younger. Like I said, I started with my father being a clerk. That really, got the feet kind of wet at a young age. Also kind of set in all the early conditioning, I suppose, as well. Seeing the floor at that age really just seemed like a massive playground. And especially, when you're young and you're kind of a little bit confused, I suppose, and scared about going out into the real world. You think like everyone's supposed to be in suits and everything and acting very, very proper. And you go down to an exchange like that, and people like one guy threw me in a trash can one time. It's pretty funny. It made it a lot more relatable and fun and something to look forward to. And then later on, after college, I started to leverage my my connections, and that's when I met who I typically refer to as my main mentor, who was a former market maker on Arca, who then went on to the programming side with making market making what's called programs. Of which I just kind of sat next to him for about half a year to a year and soaked up as much as I could, then started to veer off to a few other people that I met down there. And that's basically how I learned most of what I know.
Gotcha. How about you, Tone? You had obviously Wall Street sort of like Eric in your blood. What did you have a mentor that really kind of gave you some good direction?
I didn't have an individual mentor, but I didn't just learn trading on my own. So I learned trading in courses similar to what I teach today. And I didn't have those people like on speed dial. So I took courses, I took a lot of notes, and I learned from traders, but they weren't exactly my mentors. I just took everything I learned. And then one of my old college roommate and I that took those courses together, we basically spent a year to 2 years perfecting our trading strategies, and basically took what we learned and tried to create our own trading systems. So it's like an in-between answer. I didn't learn on my own, but I didn't have a direct mentor I could like ask questions to.
Okay. And I'll just throw out there, folks, that what we do is we have subscriptions, we have education, and we have coaches and mentors. Probably only 5 to 10% of people ever ask for a coach or a mentor. Obviously, they're paying for it at Market Rebellion if they choose to go that route. But some people really need it. And if you do get the proper guidance, whether it's from Eric or Tone or Michael or our stuff, it can save you a lot of headaches and obviously a lot of heartache because somebody that really helps you get your discipline on will be somebody who you'll be grateful to for years to come, because you can trade for a lifetime. It's one of the great things about it. It's not like maybe golf where you hurt your back like Tiger, but you don't have Tiger's money, so you can't go to get 16 different surgeries so that you can still make that turn with your back, or football, baseball. There's a lot of great sports, but you can't always do them your whole life. Trading is something you could do your whole life, and it has become democratized. It's much cheaper. The data is much better. It comes at you much faster. You don't have to pay for it in many cases unless you're a pro. But there's just lots of great stuff. By the way, another question from the audience, but before we get to it, please, if you'd like to ask a question, please just post it up, folks, because these gentlemen would love to answer those questions. A guy who's going by no BS wants to ask for your 2 favorite indicators. So I'll start with you, Eric. 2 favorite indicators. I assume it's technical.
Indicators. Right. Yeah. So the first one is actually a shout out to one of the guys in the audience right here. Bollinger is historical volatility percentile. Absolutely beautiful. If you trade options, go get it. It's on TradingView. He's made it for free. It's amazing. Thank him right there because it is truly spectacular. As far as anything else goes, you know, my main mentor was humongous on moving averages, exponential moving averages. So that's what I spent the most time with myself. And it rounds out my my sort of personal strategy the most, I'd say. But anything that has to do with momentum and lining that up with volatility is typically where I see the you know, the magic happen, I suppose.
Now, Eric, what was the one that's on TradingView? What did you call it? Volatility what?
Historical volatility percentile.
Thank you. Thank you. Michael, how about yourself? Favorite indicator or 2?
Well, I first wanted to reply to the first question before this one. I think the biggest mentor is yourself. If you are able to evaluate and analyze yourself, and I think 90% of the traders don't even analyze their own trades. If they start doing that, recognizing their own mistakes, they can develop and improve their own trading skills. So just about that. My favorite indicators, I don't use many. For the people who follow me, I'm a pure PA trader. The only indicators that I use are the MAs, but on higher time frames as they are significant. The more people who use the MA, the more reliable the indicator is. And the majority of the indicators are just based on price action. So if you don't understand price action, you don't understand the indicator. That's my view on it. So I just use PA, price action, and the MAs, and like sometimes RSI.
How about you, Tone?
I have to give 3. So for me, it's all about the price action. I'm big on candlesticks. I'm big on the shape of the candlestick. But that doesn't apply very well to illiquid assets, which is another reason why altcoin trading doesn't do it for me. So I need the most liquid assets. And to me, it's all about the price action. So candlestick chart patterns like shooting stars, hammer candles, doji candles. So that's my number 1. That's the first thing I look at. The second thing is chart patterns. Big fan of ascending, descending triangles. That's my second favorite. And third, back when I was on Wall Street, it was and had Bloomberg access. It was the TD sequential from Tom DeMark. I'm now building my own indicator that is similar on the back end, but will have all of its own properties. Named it the Momentum Reversal Indicator, MRI. Still working on that. And it's going to replace what I used to use the Tom DeMark sequential for, because it's not a price indicator, it's a time indicator. And it's all about price and time. A lot of traders forget that time also matters. So I need that time element in my trading. And that's the best one that I have as a time momentum indicator.
Cool. Thank you. Michael, how about another question from the audience? Is pattern trading effective in crypto? You've just talked about a couple patterns, price action and things like that. But do you match that up with a pattern when you're making your trades at all, Michael?
Yeah, I do see people using the standard old classical patterns, and they work. But I'm more relying on levels than pure patterns. So, for instance, if you see a bull flag, then the whole entry is already gone. So I try to maximize the entry as I just try to buy the support, get a very tight stop loss in, and increase my risk reward rather than buying somewhere in the middle because of some pattern. I think they do work in crypto, but they do work on the majors only, as what Tone said. If the illiquid asset is going to move, patterns just disappear. If some will just wants to dump, it's going to go down. If some will wants to market buy, it's going to go up. So yes and no on that answer.
Eric, how about you?
Yeah, I don't really have much use from trading in, especially cryptocurrencies. I mean, Jesus Christ, man. For the most part, I don't find them very efficacious, at least not enough to put any real risk on. If anything, the ones that I do find that work out a decent amount are the triangle types. But I've actually got data from one of my friend's firms in Chicago. He runs a quant firm, and they've actually run through the analytics on all these, and they found that pretty much any pattern that's not a triangle in Bitcoin land has usually around 30 to 40% chance to actually play out, which for me is not good enough to put risk on.
All right. How about you, Tone? Pattern trading?
Well, no, that's what I mentioned earlier. That's my number two, is the triangles, ascending, descending triangle. Bitcoin just broke out a huge symmetric triangle. I didn't know which way it was going to go. I was actually anticipating or leaning for it to break to the downside. But with symmetric triangles, you don't place that trade until you see it break one way or another. And I was on the long side of that trade as it was breaking. So yeah, I'm a big fan of triangles. Those are really the only ones. Maybe something like cups and handles as well. So I am a big fan of chart patterns. But again, you need the asset to be liquid. These things don't work on illiquid assets that are prone to some guy with a frog on Twitter as a handle, having influence on the market. Like that's no chart patterns or anything will work on those.
All right.
Can I add something?
Yeah, please, of course.
Like, I know that many people are using like 8 indicators or seeing all these patterns, but as if you are going to make these patterns on your TradingView account, it blurs your mind. The more indicators you use, the more patterns you start to recognize in the chart, the less it will work. So my vision on trading is keep it simple. If you keep it simple, you can keep it objective and you can start trading and see and read a naked chart. Like in every chart, you can see a symmetrical triangle, you can see a cup and handle, you can see whatever stupid pattern there is. But that doesn't mean it works or guarantees an entry and an exit. You have to understand how price action works. If you understand that, you can optimize your trading, in my opinion.
What about the hardest thing to learn in trading? And I'll start with you, Eric. What's the hardest thing that you had to learn about trading crypto?
About trading just in general, realistically, it comes down to I think what we began this talk with, which was for me emotions, man, mastering the whole emotional cycle and coming into emotional maturity, because in the game as a trader, it's different than any other profession for the most part, because you are your own boss. You don't have any, authority figure to tell you what to do. Even in terms of gambling, you have like a defined start and stop. You don't really have that in trading. It's, I guess you get liquidated, but that's not really the best way to do it either. So really coming into that maturity, which is a combination of realizing that, it's a game of statistics at the end of the day. And the statistics can work for you if you let them work for you. But anytime that you let your emotional state interfere with that interpretation, you're going to naturally veer it off that course. And going back to actually my man Bollinger over here, he's really, 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 really good in understanding that, because he gets that when you have a statistical edge, which a lot of the tools that he shows, essentially do. That's pretty much the point of having a technical analysis indicator to begin with. If you just follow them in the way that they are meant to be used, without confounding it with anything else, mediated by risk management, that is where over time you can actually make a living off of that. But that's not to say that every last little trade is going to work out in your favor. That's kind of what I had to get over with when I first began, because I was conditioned growing up in the Western world. I live in Finland now, so it's a little bit different here, but I grew up in San Francisco. And, from the day that we're born, we have our parents, they tell us what to do, they tell us what's right, they tell us what's wrong. Then we go to school, then we have our teachers, they tell us what's right, they tell us what's wrong. Then we go to college, we have our professors. Then after that, if you get a job, you have a boss. And then after that, you have, I guess, the media who tells you what's right or wrong. The cycle continues, but you never really think for yourself. Whereas in trading, you really actually have to. And there's no other external force that can tell you what's right or what's wrong, only your own P&L. And that's really where you have to be your own boss in that way, which is so difficult because we're conditioned, especially in the Western world, against that. And so for me, that was probably the hardest part to learn, because I was so, ingrained in that academic mindset.
Very cool. Thanks, Eric. Tone, how about yourself, sir? What's the hardest thing to learn in trading?
Again, I got like two. I had an answer, but now I'm changing that answer because I see a comment in the live chat that says, "Well, Tone said he was expecting the Bitcoin symmetric triangle to go down, but he took the trade to the upside." Well, that is one of the hardest things you have to learn, is that your opinion is really irrelevant, and you have to take the trade that's there. I thought I was anticipating for that symmetric triangle to break to the downside because we needed a pullback. But when it didn't, I took the trade to the upside because that was the trade in front of me. And that's probably the biggest lesson you have to learn, is that your opinion is really irrelevant. What you think doesn't matter. You have to trade what is in front of you. And the other thing that I want to say, the hardest thing, I didn't have to learn this, but a lot of crypto traders need to learn it. People screaming, again, on Twitter how much money they made in some shitcoin pumping, it doesn't actually mean they made any money on it. So you have to ignore, you have to listen to yourself more than others. I always teach people not to follow other traders. Learn what you're doing and create your own trading systems, because following other traders means you have not solved that one thing that you need to be a successful trader, which is coming up with your own strategies, your own ideas. Now, you could collaborate with a small group of other traders if you are not ready to do it on your own, and that's perfectly fine. But being a follower of another trader will only get you into trouble.
All right. Let me see here. I'm going to take another quick look at the questions. One coming in here is, how do you guys relax? I mean, for me, it's very tough, not necessarily to relax, but to stop thinking about the market. But do you relax? Let's kick it off with you, Eric. Do you find it difficult to relax, or as soon as you're done trading for the day, are you just on to something else?
No, man, I found that it's always about balance, as with anything else. And, to really put yourself in the best mindset to be successful with trading is actually not to be in any sort of like worked up emotional state. It's to be relaxed, essentially. So, in order to take care of yourself that way, I found the best way for myself is to, go to the gym, eat mostly for myself, consists of meat, I suppose, do sauna every day, masturbate, do all the things that are necessary to get through the day. And that's what can just put you in that relaxed state, which is going to allow you the most access to your logic, to your logical thinking process, I suppose, is the best way to say that.
So that's an interesting take on relaxation.
Just human, man.
I love it. Thank you very much, Eric. Michael, in the Netherlands, is it a little different on the relaxation scale, or is it?
No, man. I also masturbate as well here, so no. Like,
I'm sure everyone does. I'm just not sure they've ever said it on a crypto, on a Cointelegraph.
Hey, transparent, so like, but like I go to the gym as well, and one of the biggest things that made me relax more is that I turned off the alerts. I got completely crazy by having these alerts through the night, and then waking up at like 4 a.m. because of some stupid alert going off. I just place my orders in, and if something gets stopped out, I'll see it in the morning and start working from there. Get a fresh workout in the morning, get a fresh update of the markets, and then we kick off. Just get that hours of sleep is probably the most important thing if you want to be a consistent trader. Get that relaxing going.
Yeah, and that's a big one that I miss. Sleep, meditation, and reading are huge parts as well as my day.
I agree with all three, and maybe even the fourth. But how about you, Tone?
All right, so for me, gym is not relaxing at all. The gym I go to is actually pretty insane. So I don't find that relaxing. I just find that necessary to try and stay healthy. Reading doesn't really relax me either. The only thing that on the list so far that you guys mentioned, and John, you know this because I took you to one, is hitting up the sauna, hitting up the Russian bathhouse. I usually do that at least once a week. I find it as I travel. I find I'll rent a hotel that I look at the pictures. I even call them up. I'm like, how good is your sauna? How hot is it? So I find saunas around the world, even as I travel. So I try to do that once or twice a week. I'm not as active trading, and a lot of my strategies are pretty passive. So it's not very stressful. So the trading side isn't stressful. Being the public personality is more stressful than my trading, to be honest with you. Dealing with as many trolls as I have. I send a tweet and there's like 3 articles about a tweet that I send that I get pinged in the morning. And I'm like, guys, this isn't that important. So that has been a more stressful part of life for me than my actual trading, because my trading is pretty relaxed. And like I said, I'm sticking to covered calls. I'm sticking to a lot of these simpler strategies in order not to get even more stressed out. So that's pretty much it for me.
Well, I'm like these guys for the most part, folks, except that I do find, even though I loved hitting the Russian baths with Tone, and oh my God, it wears you out. And he's not like a guy that's in there for 15 minutes, half an hour. It was like 3 or 4 hours, and he was going to go for 6. I'm not kidding, right, Tone?
Well, right, but not in the sauna in a row.
No, but you're there.
We're there for like the whole day, just going in and out of different saunas.
Yeah. What I do is I get up really early in the morning, usually between 4:30 and 5. I get on the elliptical if I'm at home, and then I put on a weight vest after I do 36 minutes of that, and put on the weight vest with 40 to 60 pounds in it, grab a couple of 10-pound weights and go for a several mile walk, not run, walk. And it just, my head is completely clear after that, guys. I either listen to music or Bloomberg, depending on my mood as I'm doing the walk, but it clears my head, and I'm ready for the day. And sometimes I've already put on some trades that early in the morning, and when I get back, it's still an hour before the stock market opens. So I still have plenty of time to position and so forth. But like I say, I don't really trade crypto as actively as these guys do. I'm more or less, one of those old-fashioned hodlers. You guys, is day trading, this is a question, they didn't say who it's from, but is day trading as profitable as swing trading or not? Which to me, it kind of sounds, for the most part, when I have done swing trading, it's usually during the day. I'm not usually swing trading for days and weeks, but maybe that's different for these guys. So let me pose that to you first, Eric. Is day trading as profitable as swing trading?
Is day trading as profitable as swing trading? This is a very strange question, to be quite honest with you, because they're not necessarily mutually exclusive, for one, and then also it depends on a lot more other variables that are actually going to make you profitable. I mean, for one, do you actually know how to do it properly? Going to be probably the biggest part of anything. With swing trading, the problem is that, at least that I find, is that a lot of the time things just naturally take time. So there's an opportunity cost that you could be having with getting into shorter term trades. For myself, I choose a day trade just because it works my lifestyle a little bit better, and I don't like holding positions overnight. And it makes me not relaxed to go to sleep with positions on, unless they're like very long-term positions, which were already documented. But in the case of Bitcoin, when you talk about swing trading, I mean, you also have to define what time frame that you're on as well. I mean, a swing trade on a 4 hour is not the same thing as a swing trade on a weekly, right? How often do you get an opportunity on a weekly swing trade? Maybe a few times a year if you're lucky, and if you even trade it properly to begin with. So for the most part, you're the main part of my game, just because that's the only opportunity that I'm getting is on the short-term time frame. So there's no real answer to that question as far as I'm concerned. It's more just what sort of opportunities are present are the ones that are worth taking advantage of.
All right. How about you, Michael? Crypto Mike.
I think the whole question is wrong, essentially, as this person is probably focusing on the profits and the money itself. Well, rather it should focus on improving their own skill and improving their own trades, and then the money will come itself. So swing trading, day trading essentially are somewhat the same strategies, depending on the time frames, for me at least. Mm-hmm. And it all comes down to improving your own TA, to your own skill, and then you're good to go. I mean, 90% of the traders don't even make profit. So why asking a question which one will be profitable? Day trading is maybe even more riskier, as the majority of the day traders go on and leverage trading platform, put a 100x long or short, and then go get the liquidated mill. So I don't see the point of that question, and I don't think that there's any answer to it.
How about you, Tone?
Yeah, no, it depends on you. One could be more profitable for you than the other. It's not about one being better than the other. You have to decide which time frame and which assets are better for you. Now, you may have to try them both to see which one you like better, which one puts you in a better mental state. Like Crown said, he's more of a day trader. I'm more of a swing trader. I don't have a problem holding positions overnight while I sleep because my strategies were designed for that because they are more hedged. So it really depends on yourself. And this is what you have to solve. You have to solve that problem. Like, look, people can teach you TA. Like I teach people technical analysis. I try to teach people risk management as well and position management so that you don't get wrecked on a single trade going over leveraged. But I can't teach you which time frame is best. I can't teach you which assets are best. I can't teach you which of these TA tools will make you more comfortable and more confident taking the trade. You will have to try all of these strategies out with small capital and see what works for you. That's there's no such thing as one being better than the other.
I agree. Guys, another question here. At what point do you need to upgrade to 4 monitors?
I don't think that you ever really truly need 4 monitors. I have 3 right now. I've made it work with 2. You know, it depends. Like, what do you? I mean, first off, if you're just a regular average Joe trader, you probably just need a laptop, to be quite honest with you. Yes, it's nice to have more screens. Yes, it'll make your life easier, of course. But realistically, like, how much effort do you want to put into it? If you're quite serious, I think you already know the answer. But it really comes down to necessity. I've actually never really needed 4 screens, even when I was a market maker and I had 4 screens. You know, you can really only see so much at one time anyways. So, when your eyes are moving horizontally and vertically, like, shit just gets cut out to begin with. So it's, I really find the best bang for buck with like 2 wide screens is actually kind of where it's at, like mostly horizontal so that you don't have to go up and down.
Michael?
I guess you don't need it. Like, the majority don't need it, but there are some traders who are having like 15 open positions and they want to micromanage all these positions. And then maybe you have to have 6-7 screens to see all these positions, but that's just an outlier. The majority don't need. They are good with just a MacBook.
And you, Tone?
I'm currently watching you guys on the Zoom on my 135-inch widescreen monitor, which is connected to my laptop, which gives me a second one. I wanted to go for the 49 because I just like seeing the market, and it's not even because I have a lot of positions on. It's just that there's chats, there's all this stuff going on. Look, I like productivity. The moment we were able to get 2 monitors at work back in like 2009, I was happy about it. I love productivity. It has nothing to do with trading. I just like having multiple monitors. So I even travel with a portable monitor that 16-inch little portable. It's light. I just connect it to my laptop as I travel. Actually looking to buy a laptop with 2 monitors embedded in it, like a little tiny one where the keyboard is. So it's about productivity. If an extra monitor helps you with productivity, then you should have it. It's again, you have to be comfortable. The more comfortable you are as a trader, the more confident you are as a trader, the better you'll do. Because trading scared money is the worst thing you can do as a trader. You have to be confident in your positions. And the moment you feel your position is going bad, you got to cut that position. You got to take that loss. So these are all the lessons that you just have to learn through a practice, and hopefully you're using proper risk management tools not to blow your account in those lessons.
I as it turns out, folks, I use 2 42-inch monitors. They're dirt cheap these days, obviously. So I have, across my whole desk, basically almost 6 feet of screens. And it's probably because I'm ADHD and all the other bad stuff that one could possibly be that I have all that. But as people have told me, there was this one guy who was a fighter pilot in the Navy, and he said, when you're landing a jet on an aircraft carrier, all you do is concentrate on that ball at the light on the deck of the aircraft carrier. And they have it set up same way as commercial aviation, where when you're coming in at the right glide path, it's green. And if it goes red, you're dead. So, that's indicating, you've got to come up or you're coming down too fast or whatever. So you need to, he compared it to a knife fight in a phone booth when you're landing a jet on an aircraft carrier. And you can imagine if you're in a phone booth and you're in a knife fight, how difficult that would be. I think too much information, like all three of these guys have said, folks, too much information could cloud your vision and maybe even impair your confidence, because the more inputs you're taking in, that's great, but they're going to contradict each other. Very seldom do, a vast majority of your indicators go this way and the other indicators are going that way. And then which ones do you pick? There are traders, I'm sure you guys have all three run into this, who, when they're having a bad time, they'll fade themselves. They'll say, well, I feel like buying here, so they'll sell. And then they'll start fading their own fade. Well, I feel like buying here, but lately I've been wrong. So instead of selling, I'll actually buy. I'll actually pay attention to myself.
I know people that have done that, and man, that kills me, because that means you have no confidence in what you're doing. And you're just going to be flip-flopping back and forth. And then that trade will go bad. And then you're like, well, I'm going to counter my original decision. And then you're back to your original decision. And it gets you into a very bad, downward spiral in your trading career. When you start doing that, if you're going to start going against what your, plan is saying, it's time to go on vacation and come back and start making a new plan.
Okay. Guys, we only have 2 minutes, so I'm just going to throw out another one real quick. And so please keep in mind that we want the next panel to start on time. And you guys have been great. So really, thank you for all the great information. Would you advise a beginner to ever use leverage?
No, I don't think that you should trade a real account at all. I think that you should. There's plenty of tools out there that'll let you get reps in without actually risking real money. If you really have to, scratch that itch, then just put in like $10 or whatever's minimal to you. And you can, if you can make money with a small amount, you can make money with a big amount. I spent my first 4 to 6 fucking months just trading a demo account, just right next to my mentor, doing absolutely fuck all. But it was very, 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 very important. Then after that process, yes, absolutely. Once you feel, and here's the right time when you know to actually put money at risk, when you feel relaxed, when you feel bored. If you're bored, that's actually the right feeling. You shouldn't feel any sort of emotions when you're getting into a trade, because at the end of the day, as I said, it's all statistics. And if you understand that, you'll understand that there's never a reason to get excited when you're in a winning trade, or never a reason to get pissed off when you're in a losing trade, because over time, it's going to naturally come into whatever strategy you're working at, whatever that sort of hit rate is. It's just naturally going to work like that if you let it without getting in the way yourself.
Got you. Guys, they're cutting us off. We've got to go to the next panel. How to build an optimal crypto portfolio. So I apologize to Michael and to Tone, but I appreciate all of your guys' inputs. I'm sure that the viewers and Cointelegraph appreciate it. So Michael, thank you very much. Eric, thank you. Tone, thank you. You guys make sure I'll tweet out links to these guys' Twitter accounts, and you can follow them directly to their either Crown or Crypto Mike or Tone Vays YouTube channels. Thank you very much, everybody. And now let's get started with how to build an optimal crypto portfolio. Thanks, guys.
Thanks, John.
Thank you very much. Take care,
Thank you.
guys.
Thanks, Michael. Bye, guys.
panel with these esteemed guests talking about how to build the optimal crypto portfolio. And when I looked at this topic, I thought to myself, this is a very strange panel to be running because everyone has different risks and different needs and requirements. And so there must not be one crypto portfolio for all people. So we're going to have a very cool discussion today. We're going to be here for about an hour. And I think at first, let me introduce our guests to you. And I'm going to start off with Mike Novogratz. Mike, if you could just introduce yourselves and just tell people a little bit about what you're doing in the market for those that don't know you, those that have been living under a rock for the last 30 years.
Sure. I think I might be one of the oldest guys in the crypto space. You know, I started a family office originally where I was a big crypto investor and then switched to Galaxy Digital, which is a public company. Our mission really is to be the bridge between institutional players in the crypto world. And so a lot of my answers today are going to come with the framework of bigger pools of capital and how institutions think.
Great, and I'm not going to let you off the hook because I'm certainly going to be asking you about your own personal portfolio as well. Let's move over to Robert. Robert, a little bit of an introduction about who you are and what you're doing in the space.
Sure, yeah, thanks, Ron. So I'm Robert Materazzi. I'm the co-CEO of Lukka. Was asked to be CEO this year. I've been in the crypto space only for about 2 years. Prior to that, was with PwC for 5 years, working in traditional banking capital markets, and prior to that was in the military. And at Lukka, we're really focused on the post-trade side of operations. So working with really all three of the companies, so XBTO, CMT, and Galaxy, helping with their post-trade operations.
Okay, amazing. Daniel, if you want to give us a little bit about what you're doing at CMS Holdings.
Yeah, so CMS Holdings is really, for all intents and purposes, like a hedge fund, though we don't have any outside capital. We just run partner money currently. We deal pretty much in the full suite of like crypto as it can be investable. We do a little bit of equity, a lot of token related stuff, all the liquid names. We kind of like span the gauntlet, a little bit in the vol side. Before this, I ran Circle Trade, which was the OTC desk out of that business, and like sort of saw that grow and then ultimately leave. And yeah, I'm probably going on 8 years now doing this crypto thing for full time. So I've seen some ups and downs.
Amazing, amazing. Paul, let's talk to you about what you guys are doing.
Thanks, Ran. Thanks for hosting, and I'd like to thank Cointelegraph for doing this. I think it's a good event to have, specifically in the times. Obviously, 2020 is quite extraordinary. XBTO, we are a systematic quantitative trading firm that was originally began in late 2014, 2015 by two ex-SAC Capital. So Stevie Cohen's fund, Philippe Bacazzi and Walton. I currently, I'm head of trading, and in short, we have a trading arm, a mining arm, a ventures arm, and capital management, and we are specialists in derivatives options.
Amazing. So we've got a very diverse bunch of people on this. You know, we've got a fund manager, we've got two fund managers, we've got Mike, we've got Paul. Let's look at the markets where we stand today. And if we look today, the markets the equity markets are coming down a little bit, but Bitcoin and gold seem to be holding quite strong. Mike, I'm going to send this question to you. Do you think that Bitcoin is now becoming an option as a digital gold, or as a commodity almost, as a safe haven, a safe haven when equity markets collapse, and a safe haven when governments print more money? Are we there?
Well, I think those two are two separate things. So yes, I think the most important thing that's happened this year is Bitcoin has been credentialized as a proper macro tool in the toolkit, you know, part of the arsenal of investors, hedge fund investors, individual investors, and institutional investors. It is in crypto world taking the lane or the narrative of digital gold, right? It's the only pure store of value. Bitcoin's only as good as the social construct makes it. It's valuable because we say it's valuable, right? I think all the rest of the cryptos who have some of that store of value in smaller communities are going to have to prove use case. They're going to have to be useful doing something else. But I think Bitcoin's a finished product, and I think that's why the bulk of the energy from the new participants and institutions are all going into Bitcoin. Right? Gold is $10 trillion market cap. Bitcoin's a little more than 200 billion. We're really early on the adoption cycle. Bitcoin's still hard as hell to buy for most institutions, for most people. I had 3 different people call me yesterday who were trying to figure out how they could buy it in their funds. And so I think we're in early stages of people moving into the institutions, moving into the space. I think they'll all will 100% start with Bitcoin. And so in lots of ways for big capital, it's going to be the dominant piece of any portfolio. It doesn't mean if you have a smaller amount of money or smaller fund, there's not lots of money to be made in some of the other cryptos. But if you're talking to anybody who's moving big capital, it's all Bitcoin.
Now, when we look at the crypto markets today, and specifically you spoke of institutions, are the institutions looking at anything else but Bitcoin at the moment? I'm going to open that question up to anyone on the floor who wants to answer it.
Let me finish and then I'll let those guys go. You know, the way I look at it is everything else is in your venture bucket. You know, if you're an institution, you should have a big venture bet in the blockchain, in DeFi. DeFi is going to change the way we do finance in the next 10 years, but it's not in the next 1 year. And so I put that in venture. There are some people that are putting Ethereum in as well. You know, that are saying, okay, Ethereum, and maybe I do an index of Ethereum and even XRP and some of the other top 5 just to get diversity. But mostly it's Bitcoin. And then, hey, should I have more of the Ethereum? And Ethereum seems to be way out in front now in the protocol race.
Mike, you've always been an Ethereum lover. Paul, I'm going to go to you and ask you, how do you think that institutions are looking at the crypto space today? And in particular, when we look at what happened about a week ago, where there was a ruling that US banks can now custody Bitcoin or digital assets on behalf of their customers, do you think that gave the boost? Is that what caused the rise from 9,200, where Bitcoin was relatively stable, to 11,000, or where we are today?
Yeah, Ren, I mean, that's a good question. I think that was part of it. I think, let's be serious. This type of movement has been going on for, much longer than what was just announced, right? Really, the infrastructure, the custody, the ground is being laid for institutions to really adopt not only crypto, but Bitcoin and some of these other coins, right? Bitcoin, as Mike said, it has to be in everybody's portfolio, and ETH has to be, closely behind. But I think, even with the launch of the CME futures contract, even the back, which is futures physically delivered, CME is cash settled. CME also has an options product where they could potentially hedge their Bitcoin portfolio, but also their whole crypto portfolio, because BTC is essentially the market bellwether. It has the biggest, beta, so to speak. So I think, there are products, there are solutions, and there are ways that traditional hedge funds, institutional investors can really step into the space, right? Because let's just talk about, CME product, for example, right? It's cash settled, right? Plus, it's the CME. Most traditional funds are going to have a relationship with the CME for, decades on end. So they don't touch the coin. And it's a normal futures contract. And, people always talking about, Bitcoin and, the volatility. And yes, it is volatile, but you can see over the past, 2 or 3 months where implied vols, in 1 and 2 and 3 months have come down to like 30, 40, 50 levels, and realized volatility even lower. It makes, for example, oil had its, oil looks extremely volatile when compared to Bitcoin lately, right? So, the criticism of that Bitcoin is too volatile for an investment, I think people need to rethink that with not only the groundwork, but the elegant solutions and ways to get exposure.
Now, Paul, you spoke about the CME future. And when I look at the CME future contract, I kind of see it as a contradiction to what Bitcoin is about. And the reason why I say that is because it's a cash settled product. And by trading the future, which closes out every month or whatever, there's trading income, it's a short-term contract. So by virtue of that, any income that you make gets taxed at very high rates. That's not really what Bitcoin is made for in a portfolio. That's the speculative side, as far as I understand. And what we're doing here is we're using Bitcoin to hedge against inflation risk, US dollar devaluation risk, aren't we?
But Rand, if you think about it for a second, so like there's a narrow lane of, what are you going to disrupt in life, right? So originally the crypto revolution, we were going to disrupt everything. You're going to disrupt the way the world. Like you talk to Joe Lubin, you'll get yourself fired up and you'll have a torch in your hand and you're like ready to charge into the streets. Bitcoin, and a lot of people are playing it really just for a disruption of central banks, just that fiat currency inflation worry. And so it's not necessarily, it sounds oxymoronic or hypocritical to say, I want to put my Bitcoin, I want to leave it in JP Morgan. I'm going to feel much more comfortable having my Bitcoin custodied at Fidelity or at the New York Stock Exchange than leaving it on a wallet. But that's okay, because you're still playing the disruption of fiat debt. The futures, listen, I think the CME futures don't have enough liquidity. There's a 20% carry right now between July and August. And so I wouldn't play it because I think, they're way too expensive. But it shows you how hard it is still to buy Bitcoin. Why I'm bullish Bitcoin is it's not easy to buy. If it was easy to buy, it would be a lot higher. So people are buying futures because they're not set up yet. They haven't changed their docs yet. One guy yesterday is changing all his docs so he can actually settle cash Bitcoin and hold it. It's not even that they're scared of the custody anymore, right? They trust the custody. Their docs don't allow it. And so this is just some transition time. But I don't think the CME futures, especially if they were trading, closer to normal carry and with more liquidity, I think it's a perfectly a good way to play Bitcoin.
So Rand, sorry, Rand, I'd like to answer that question directly, actually, because I think, listen, everybody on this panel is really, we're all educators to other folks, that are out there looking at this space, right? So you make a very good point, right? But I'm curious whether you know what an EFP is or an exchange for physical, right? So theoretically, you can take exposure through the futures, do an exchange for physical, which is an EFP. I do them, we do them, Galaxy does them, and we can actually take that futures contract and exchange it for the underlying physical. So that's what people don't really see, right? Now, Mike spoke about some very good, quality names, Fidelity, backed as, custodians, where theoretically you can put on a futures position, build it up, EFP, into, for example, the backed warehouse. So you do get the coin if you want. But to your point, most people are just thinking, oh, wow, it's cash settle, it's anti-crypto. Well, again, this is all about education and learning, right? If you want exposure to the coin, you can do this. It's essentially a swap. It's been going around in traditional and futures, 2-3 decades, right? Probably longer. So you can actually get exposure to the coin through the futures.
Paul, you remember we did that first one way back in the day.
Yeah, yes. So when Dan was at Circle, we, in coordination with, obviously the Chicago Mercantile Exchange, we did the first ever exchange for physical, and it's really a beautiful process, right? There's obviously the futures leg, and then, there's obviously the spot leg, which is a normal spot trade, but it's a package, right? And, because it's a spread, and don't get me wrong, the spread, can be extremely volatile, but again, it's a way to get exposure to the coin through the futures, but there's that extra leg. That's right, Dan.
Robert, are we at a point now where a traditional fund manager who's not investing in some kind of digital asset or giving his funds some kind of digital asset portfolio, are we at a point now where that is almost negligent?
Yeah, I mean, I think that we've historically had two different industries, really, right? We've had this digital assets, crypto industry, and we've had the traditional. And I do think we're in there's a ton of evidence to say that these two worlds are merging right now. We're seeing a lot of the traditional banks, a lot of the traditional broker dealers get into the business. I mean, we're in a ton of conversations with a lot of the name brands that everybody's, mentioned today. A lot of the global custodians are in very, very serious ways thinking about the infrastructure that's required to get into this. Which to me is real exciting. I mean, that affects the whole industry. It can affect the whole world. Mike mentioned the time frame for some of this stuff to be adopted, and I think that things like the OCC news that came out in my opinion, the biggest impact that's going to make is ideally it's going to wake up a lot of banks that maybe really weren't thinking about this before.
So we've all drunk the Kool-Aid. We are all well down the crypto rabbit hole. And I mean, we're spending our lives on crypto, but let's try and remove ourselves and look at the outside world, the traditional fund managers. If you were talking to a traditional fund manager with a equities, fixed income portfolio, etc., what percentage of their fund do you think would be prudent to allocate to crypto today? And I know it's difficult because I know every fund has a different thesis, but let's try and generalize it.
Crypto's, Bitcoin's trading at, I think implied vol is 80. It was 50 last week. So call it 65 vol, right? And so, if currencies are usually 10 vol and gold can trade historically a little higher than that, it's vol adjusted. It's not that large of a position, right? I tell new individuals to put 1% to 2% in. I've got a lot more than that in my life, but I kind of live on top of the Bitcoin price. But, if you're an equity PM, 4% is a pretty big position in a stock, but there are some funds that go up to 15 or 20%. And so it's a little bit of vol adjusted based on your strategy, but it's probably somewhere in the 3 to 5% for aggressive funds.
And
yeah, go on. It's got to be small. I mean, it's so volatile and relative to everything else. I think it's like 80 realized on the year. I mean, obviously March was like wild, but you got to really size it down accordingly just because it is going to whip around so much. Like, it just wouldn't be prudent to have like a huge position in it. So I think you're going to see very small allocations, especially until that vol comes in significantly, which it does not appear to be.
So let's talk about that. If we're agreeing that the percentage in a big fund is between 3 and 5%, if you were one of those fund managers or advising one of those fund managers, what percentage would you tell that fund manager to put into Bitcoin? And if it's not 100%, where would you tell them to put the balance, knowing that they're not as close to the fire as we are in terms of being able to trade in and out of different crypto assets? They have a lot more friction.
So Rana, if you're a big fund, it's probably almost all Bitcoin because the liquidity in the other cryptos just doesn't pass the liquidity test, right? And so if you're an individual, you might have looked at the Ethereum Bitcoin chart and shifted 70-30 Ethereum Bitcoin just because you can move in and out. But if you're talking to the funds that have to buy $100 million or $150 million worth of Bitcoin, they're not going to be flipping it in and out of Bitcoin and Ethereum. And so they're going to be mostly Bitcoin. And so a lot depends on sizing. If you're a retail customer, I would probably maybe have half Bitcoin and half everything else.
Let's just, when you say half everything else, I'm interested to know what you mean by everything else, because I've looked at CoinMarketCap. There are a lot of everything else's.
So in my portfolio, personally, when I look at Galaxy, my portion of Galaxy, it's probably 50% Bitcoin, 5% other coins, and then 45% venture bets. And so investments in other funds, investments in infrastructure, in exchanges, in custody businesses, in new products, in what I hope to be the next version of, things that get built on DeFi. And so I've got a big venture portfolio.
Yeah, the venture piece is that's the other way, right? Like, you either buy Bitcoin, you buy a little ETH, or like you stick it in the corporates. And this is why the venture funds have had so much better time raising than the active trading funds, right? Like, you see a lot of 60 to 100, 150 million venture funds coming together to invest in the corporates on the crypto side. You don't see a lot of the same sort of tickets getting punched for the active management side. And a lot of that is the liquidity, right? You can plow 10, 15 million into a handful of deals and you can make that money go to work. But once you're over 100 million, you're just baited to Bitcoin anyway. So you might as well just buy it outright. It's hard to give that money to then somebody to go manage.
Daniel, I'm interested to know your portfolio or your fund that you speak about. What's the breakdown of assets in the fund at the moment? Bitcoin, other coins, and venture.
Yeah, so it's probably 30, 30, 30. So that would be a steady state where it's a third Bitcoin ETH, a third sort of the board, and then a third of stuff that's not liquid, right? Either tokens that we have vesting on or equity positions that we have no chance of getting liquidity on in any foreseeable future. And that 30, that's the board, that moves around wild, right? That we're churning intraday, between days. It's very unlikely we're keeping positions multi-month. right? It's like a lot of like, where's this hot ball of money going? Like, what's interesting? Where's the action? And like, you sort of like follow with that. But that's because we like have a very active bias. So like that pool of names moves around a lot for us, unless we have a really strong thesis about like something, and then we're going to keep it for a longer time horizon. But for the most part, like that's in a very evolving sort of bucket of like risk that we have.
Paul, when I look at you, what do you believe is the optimal split today in a portfolio for you or for someone like you between Bitcoin and all the other coins and venture?
Sure, that's a good question. I just like to caveat this is not investment advice, and obviously we're not allowed to talk about anything proprietary to the business that we do. just a caveat. That said, I think listen, what both Mike and Dan has said is very correct. You want actual companies you want to invest in. Those are actual real projects where you with material almost call option like optionality, right? And then you want to have a proportion obviously to, Bitcoin is the bellwether. You have to have that in the portfolio. Is it 50%? Is it 30%? It's going to be a good portion of your portfolio because it's that's going to be leading potentially the rest of the coins. For I guess the alternative coins, which is a euphemism, that are further out in the risk spectrum, I think again to keep to this options like analogy, you need a few call options where you're willing to burn the premium. In other words, you're willing to lose all your money, but then have that upside optionality should they actually pay out, right? So I think if you think of a diversified portfolio that, I think Dan's, structure of like 30, 30, 30, I think is, a good place to start. And then within those buckets, you can, shift around, your structure, for example, to different factors. For example, within the ecosystem, very much like how Mike described, infrastructure plays, essentially that, if this is a gold rush that we always like to talk about, what are the picks and shovels? Who are the entrepreneurs that are stepping into the space to fill in the gaps of this still developing ecosystem? Those are the types of companies that actually make us really excited. And those are actual companies, not necessarily at the token level.
Rob, last one, very quickly. The split between Bitcoin and other coins, and then we're going to dig much more into how to actually construct the crypto portfolio.
Sure. My advice is obviously a bit focused differently. When we're talking about the post-trade side of operations and you're adding more coins or more liquidity providers, all of those dimensions add more complexity, which can add, very material costs if they're not thought of while setting up the portfolios. So, just even your wallet providers, how you're classifying things for tax purposes, how many financial controllers you need, all of those things. So I just say, just Bitcoin, you're pretty simple. You probably don't need some advanced software to manage the back office for that. When you start adding the other coins, by the nature of how the ecosystem's evolved, you need to go out to different exchanges or trading desks to acquire them. And that adds more complexity and then more back office costs. So.
Okay, so let's look at the top 10 coins on CoinMarketCap today. We've got Bitcoin, ETH, XRP, and so the list goes down. Do you guys think that is representative of the future of this industry? Is that a good litmus test of who we think are going to be the winners in the industry? You've got Bitcoin and ETH leading by country mile, and then you've got Cardano, XRP, BCH, BSB working their way down. Is that a true representation of the possible winning protocols 3 to 5 years from now?
Absolutely not.
Yeah, hit it, Dan.
Dan, go for it.
It's like, look, if you made me make a bet, like how many of those are gonna like stay in like the next 5 years? Like, I don't know, 3. Like Bitcoin and ETH probably not going anywhere, and then like give me a third is like a toss up. Maybe Ripple just has so much like inertia that you can't like move it out, but like that list is gonna move around a lot.
Okay.
So I would look at it a little different way, Rand. So what's a cryptocurrency so far, right? It's been a social construct, right? It's not the code of Bitcoin that gives it value. Like we could fork the code and call it Rand coin, and it might not be worth that much.
That's a great idea.
Right? It's that we believe
worth a lot.
that we've created that there's this community of over 100 million people that own at least a piece of a Bitcoin, that there are these people that believe in it. It's built this brand, that it's a store of value because we say it is. And so a lot of this is about the community. And so, like, listen, Ripple has a really aggressive community, mostly based in Asia, you know, the XRP army, and they have a use case, right? It's cross-border payments. And there's a story that gets people buying it. And so
Can I stop you for 1 second about community? I want to stop you around communities. Because the way I understand communities is developer communities, developing cool stuff on a protocol, VC communities or funding communities investing in the smart people that are building on the protocol, and then there's user communities. Now, when you talk about communities, and specifically in the XRP context, yes, I get that there is an XRP army. I've been attacked by them several times for mentioning XRP on my show. But how many people are actually building and funding projects built on XRP?
Let me answer that specifically. I think 75, 80, 90% of the smartest people in the space are working on things in and around the Ethereum project, right? So they've got the most developers and probably have the best chance of being the base level trust blockchain that shit gets built on. It doesn't invalidate that Bitcoin's got a far higher market cap, and I think it will continue to have a far higher market cap, even though not that many people are building on Bitcoin, right? Bitcoin has this lane of digital gold. It's a finished product. And so if XRP actually can become this cross-border payments app, you know, and they're having some success in Mexico, and if they become, you know, the interbank for that, they have a shot. And so even some of the smaller coins, I mean, I badmouthed Litecoin a couple times, just, you know, tongue in cheek. I was like, Litecoin's a, you know, poor man's Bitcoin, and it's a test net. And oh my God, I got attacked. I thought I had to get bodyguards almost. But I've learned to change my view. There's a group of people that believe Litecoin has value. And so to them, it has value. It'll never be nearly as big as the other ones because it doesn't really have a lane. And so the way I look at these is, do you have a lane and a purpose? And can you create people in some cases to build on your thing to create a broader community, but some way to get people to believe in that thing you're doing? You know, in the periodic table, only gold is store of value just because it's store of value. The other 113 elements, all we use them for something. Like copper is valuable because we use it, right? We build cars and wires and gutters and all kinds of shit with copper. Gold, we don't do anything with it. We just stare at it or put it on jewelry and wear it, right? And so I think you can think of it that way, but it doesn't mean, you know, smaller cryptos won't have a purpose. They're just not going to ever be as big. And a lot of them are going to go away because people lose, you know, it costs something to keep the project up, right? Like right now, it's the energy equivalent of the Three Gorges Dam that Bitcoin mining uses every single day. That's a lot of energy.
Dan, you had some thoughts about this. I saw the minute that I asked about the you know, are the top 10 protocols, the top 10 coins today representative of the future of crypto? You were quick to jump up and say absolutely not.
Yeah, I don't know. I've just lived through like too many cycles of like that 10 just changing entirely, right? Like every time there's like a big run and like some new thing comes along, like that whole board gets rejiggered. And I just don't think, like, it's not clear to me there's enough sticking power and like enough sort of diehard advocates and enough sort of money to like keep that whole positioning in place. And also people are fickle in this industry outside of like the top couple, right? Like stuff gets hot really fast and like it moves around quickly. I mean, like Tezos, right? Like that like rocketed up and got up there out of nowhere. And like Chainlink, same thing, right? Like I just refuse to believe that we won't see another cycle of that play out, like probably in the next like year, let alone if there's like an actual influx of money that like suddenly pushes through the system again, like you got in 17. I think the whole board rejiggers every time.
So you're saying brace yourself for alt season or for alt season 2?
Oh, I don't know. I mean, like we've been living in one the last couple of months anyway. I mean, like I wouldn't say it's as crazy as historical ones have been, but like there's definitely been like a ton of action on that. Yeah, I mean, it's going to happen. Like people love to either lever trade on the majors or they like to go out and punt on the smaller caps. And like, they're going to switch between those two sort of regimes through time. And like, I don't know, you get enough momentum behind the small cap stuff, like it clearly just takes off.
Well, yeah, one thing to remember, and this is really important point, is that, you know, I started this institutional business and you talked to me in January, I was about to put a gun in my mouth because it was so slow. Like the institutions are just finally getting there. It's taken a long time, right? Paul Jones was the first major hedge fund to say it. There's other hedge funds that have bought it, but they haven't publicly come out. They're changing their docs. It's all going to happen. It's just happening longer. Crypto is still a retail community, and the retail community loves leverage. And so you see Wobi and Binance and BitMEX still by far the dominant exchanges because they give you a lot of leverage. You know, the Asian community likes to gamble, and so it's a real speculative community. And you know, when you tell someone, "Hey, I think it's going to go from 10,000 to 12,000," and they can't get leverage, okay, that's 20%. That's not so exciting. I think one of the reasons crypto went sideways for 6 weeks was that the equity markets, Tesla became the new crypto. It was the 2017. It was so exciting. You're buying it was going up 12, 15% a day, that lots of the kind of retail spec money shifted their focus to becoming Robinhood traders on equities. Crypto wasn't as exciting. And
you think that the stimulus checks and everything else and this extra money in the economy is actually filtering into crypto assets? Do you
100%.
think that's
100%. Like the world's awash with cash. Why big guys and little guys are buying crypto is because we're debasing fiat. And America, this is an amazing statistic. We just showed a 36% down GDP quarter. 36% down GDP quarter. But disposable income in America is up 4% year on year. We have more money to spend this year than we had last year, even though the economy is in the shitter. Like, that's crazy. That's how much government money is coming into the system. That's finding its way into markets. That's why we have this equity bubble, and a lot of these new cryptos are just exploding up.
And people have time on their hands, right? Like, everybody's at home, like staring at screens anyway. Now they can just like punt around on stuff. I mean, you're seeing it across all asset classes.
Paul, I see you've got something on the tip of your tongue.
Yeah, Ran, I just want, you know, just your initial question about the top 10 and on coin market cap. And I generally agree with, you know, what, you know, Dan and Mike have said. But I think one thing that we need to think about is the one coin that is in the top 10 that maybe there 5-10 years from now, including Bitcoin, is Tether, right? Tether is a stable coin. And I think it's a bit anti-crypto, right? Because it's not a true crypto per se, but Tether and stable coins in general could be the biggest, I guess, non-crypto, project to come out of crypto, right? You think about all the different stable coins that are being developed there. When you think about, for example, Stablehouse, which is essentially a central clearinghouse for stable coins, which XBTO is involved with. You know, stable coins are not going away. And so while the top 10, I think, yes, we'll have Bitcoin and ETH. I think, you know, some type of stable coin or Tether, it's important for people.
I think the next top 8 will be stable coins.
Yeah.
Well, if we look at it today,
Libra will instantly go into that top 10.
The top volume coins traded, the top number of transactions on crypto today is actually done through stable coins. It's people moving US dollar money around. So, I mean, that is the biggest use case of blockchain today.
Though I will make an argument that becomes bullish for Bitcoin. And listen, if you look 10 years down the road and we are going to have a world where we have digital money and hopefully crypto money, not just digital money. And there's a crypto dollar, if it's Libra, you know, the Libra dollar or the Libra, you know, euro, or it's USDC, or there's a central bank, you know, driven one. We're going to be using those to do that. All the rails of custody, of trading, are the same rails that we're going to use from normal crypto. And so as that architecture grows, right, Goldman Sachs will be forced into the crypto business by their customers if they want to trade currencies in crypto instead of traditional fiat currency. If you want to trade dollar euro, but you want to trade the crypto version of it, Goldman's going to have to be in that business, and that forces them into the Bitcoin business and the Ethereum business as well. And so as the architecture of the world changed, because stable coins are coming, I mean, it's crazy that I can send you a picture right now, Ran. I don't know where you are, South Africa.
New York, Manhattan.
Okay. I can send you a picture in 2 seconds, right? On my WhatsApp or on Signal or on WeChat, whatever I want to, with all the pixels and all the complexity of a picture. But if I wanted to wire you money or send you money, it's a huge pain in the ass, right?
Yes.
Maybe if you have Venmo, I can do it quickly. But if I want to wire you a lot of money outside of crypto, I can't do it. So that's all going to shift.
Let's spend 1 second talking about stablecoin. So today, by far, the most dominant stablecoin is the US dollar Tether, even with all the gray clouds around it and the legislation and litigation and everything else that goes on around it. We don't know if Libra is going to launch or when it's going to launch. Do you see a world where the banks create their own US dollar Tether or their own stablecoins?
I think it's highly unlikely in the short term. I mean, maybe if like we live in a world where like 8 of the top 10 they're going to try to go for that custody business, right? Like they're going to want to own those assets, which they can do anyway, right? Like they can just support Tether or USDC and get the custody of those assets as is. But if they want to own more of it and they want to control the whole thing, maybe. But as an opportunity set right now, it's definitely not big enough. And it's a ton of risk, right? Like banks hate this thing anyway, because once the money leaves the door, they don't know what's going on with it. So like they're flighty as it is. They don't want to like bring any more of that risk in-house. It's like kind of a nightmare if you're a bank.
Do you see a commercial bank, Goldman's today, storing some of its customer money in US dollar Tether because now they're allowed to custody digital assets?
No.
I mean, do you think that kind of
I think Tether's still got Tether still has a big problem. And I don't think, listen, I think as we get more institutionalized, Tether is going to lose its dominant position. Listen, Tether is used because it's really efficient. A lot of the Chinese like to use it to get money offshore, to not pay tax, to keep money in this alternative system. The movement to commercialize and institutionalize broader crypto is coming with regulators attached. And so, in the US, certainly, I'm guessing in Europe, when Coinbase is dealing, Goldman Sachs is not going to own Tether because they're going to worry about what's backing it. They're going to be too worried about the provenance of it and where it was coming from. And
so what is the stable coin that institutions will rely on?
I think right now in the US, it would be USD, whatever, the Circle Coinbase coin. I always get the fucking initials backwards. USDC, is that what it's called?
USDC, yeah.
Yes. Yeah. I'm old, I told you. I think Libra is going to be pretty hard to beat once they launch. And I do think they'll launch.
And will they launch as a US dollar backed stable coin? Or
they're gonna launch with 5 stable coins: a US dollar backed stable coin, a euro backed stable coin, a cable backed stable coin, a yen backed stable coin, and a Sing dollar backed stable coin. My high suspicion is 90%, 95% of the volume will be in the US backed stable coin. Right.
Okay. Let's break the discussion and talk about actually what we were supposed to talk about, which is how to actually build a crypto portfolio here today. There are a lot of the viewers here who are thinking, I logged in, and actually what I wanted to do after this session was come out with takeouts about how to build an optimal crypto portfolio. So let's take your average investor. The average investor has a little bit of spare cash. Let's call spare cash $10,000. And this average investor wants, let's say $100,000, and we can break it up. If you have $100,000, you're in your 30s, you've just started out, how would you go about building a crypto portfolio? And let's work under the assumption that you're going to hold this portfolio for 3 years or 5 years.
I would. Now, is that if their whole net worth is 100, whatever, 100,000,
their leftover income, the money they can afford to invest, and let's say for argument's sake that is 10% of the entire asset holdings around the world or portfolio.
Okay, so this is just if this is just for crypto and I'm a 3-year holding period, I would put 40% in Bitcoin, 30% in Ethereum, 10% in some other projects that I might like that are smaller. And
what are those projects? This is what people want to hear. I want to know what Mike Novogratz likes.
So I don't have to be honest, I don't have a lot of coins right now outside. We have a lot of venture bets. Look at like the compound. who do you think made money on compound? People that bought the token or the people that backed the team early on, that when they put compound out, it's trading 40 times what they originally, they made 40 times their money. And on compound, like most cryptos, it traded up with the frenzy and straight back down.
How much money would you put into venture? What percentage of that portfolio would you put into venture, early stage?
30% of it, 35% of it.
35% of the money goes to venture, 40% goes to Bitcoin, 30% goes to ETH, but we've over allocated.
Oh, well, make ETH smaller. Make
ETH smaller. Mike, before I move on to the next guy, we're going to go through all of you guys, but Mike, before I go on to the next guys, if you want to put a stack of chips on DeFi today, do you put your money into individual projects or do you put it into the Ethereum network because that's kind of like become the DeFi protocol?
I think you put it into individual products. I'm not smart enough, I'm not sure anyone is, to know how does Ethereum become this base case has a decent market cap, but isn't where the growth is, and the real growth is on the projects that are built on top of it. If you're compound and you literally become the interest rate clearing market for the world, not just for the small little crypto test kitchen we have right now, but it becomes like the potential market cap of compound is immense, right? If you're the derivative version of compound, it could be immense. And so I actually think more value is going to be created on top of the blockchain than the blockchain itself. But that's a thought, it's a hunch. I'm not positive on that. And I talk to all the guys, and you try to do because right now Ethereum is not being valued by any kind of discounted cash flow model, how much it's used. It's being valued kind of like Bitcoin. There's a community that says this is valuable because we think it's valuable, right? It's purely speculative at this point. And
because you have the collective power of so many smart individuals building, and the collective power of all the venture capitalists saying we're comfortable to invest in projects that are building on Ethereum because we know the base layer protocol is solid.
Yeah, but everything in the world almost other than gold, at one point, you have to value it with some discounted cash flow model. Like even crazy Tesla with its $300 billion market cap, people say, well, they'll sell every car in the world and they'll dominate batteries. They tie it back to something. And at one point, those assumptions have to be right or the price goes back down, right? That's why in 1999, the internet crashed. And then out of that, the companies that actually made money became the most valuable companies in the world. And so we're still too early to understand that Ethereum pricing model, right? Gas gets too expensive. How do they fix the Ethereum inflation pricing that you can even make some mathematical assessment of what it could be?
Got it.
So right now, until we do that, it's just speculative.
Robert, I want to go to you in terms of this person building $100,000 portfolio. In your mind, where do you tell them to put their money?
And I'm pretty basic. A big portion of the population in the world still doesn't have crypto, and when they think about it, Bitcoin is the Kleenex of crypto. So that I usually recommend that. Like when my mom says, "Hey, I want to buy some crypto," she doesn't say that actually. She says, "I want to buy some Bitcoin." I'm a big fan of the Ethereum protocol, and it hosts a lot of assets. So I stay pretty simple, and then. I always recommend, obviously to make sure you understand the tax consequences, right? I mean, if you're, and how that ripples through, because it's not always straightforward when you're trading crypto, and ultimately that impacts your income.
Daniel, you guys actually have a fund. I'm assuming that you're going to tell people to allocate their assets as per your fund or something along those lines.
Or I think they can just allocate them to Daniel's fund.
Yeah,
he said he's not taking outside money. He said it's partners' money. Apparently, it's like $1 billion of like partners' money.
That'd be sweet. No, it's not that many commas yet. But so wait, hold on. Do I understand that it's 100,000 to get allocated, or my net worth is 100,000? Like what?
100,000 to be allocated, and that represents 10% of your net worth.
Okay.
And you,
all right.
And you're 35 years old.
All right. You buy a min ticket GBTC, and you forget about it, and you roll that in 6 months, and you keep doing that. you put 30 grand in ETH and you just lend it out. And then you take that 10% and I don't know, you spray and pray whatever like names you like that are hot that you think have some. And if you want to like take a more concentrated bet on an industry, like if you want DeFi, you go buy the DeFi basket curve backwardated on FTX and you just roll it as well. And you get some extra yield on top of it. I think that's how you do it if you got to put 100K to work.
Maybe I'm not understanding something, but if you keep rolling these contracts, are you're not paying tax every time a contract expires? Are you not getting taxed on income every time a contract expires?
Yeah, so I'm not a tax guy, so I might not be doing this efficiently, but maybe you don't roll it depending on like where your cost basis is. Like maybe you use the roll as like an efficient way to like harvest like your losses. I would also spend 1,000 of that 100,000 to get tax advice.
Okay, great advice. Paul, your portfolio, this guy, $100,000, 35 years old, coming in hot. Bitcoin's just gone from 9,000 to 11,000. He is coming in and wants to put his money somewhere. Where does he put his money?
So I think, to echo what the guys have already said, I think it's pretty consistent, right? I mean, the majority, say 30 or 40% has to go, within Bitcoin and ETH, probably overweight Bitcoin. I think the next 30 to 40%, I think you really got to think about ventures, actual companies that, again, if this is gold rush, you want picks and shovels. Ironically, I didn't know, Robert from Lukka was going to be on the panel. Lukka is one of these companies. They're an accounting, audit, tax firm for the blockchain and crypto industry, and in fact, it is in XBTO's ventures portfolio. So it's actual companies like that. We're big in the derivatives space. We think, again, entrepreneurs stepping in to fill the gaps that are not there. Great, elegant technology solutions such as Paradigm, which is a crypto institutional OTC chat and settlement for derivatives. X margin is another good one that is, basically a zero knowledge margin calculator that makes basically trading and collateral efficiency across counterparties. So you really need the ventures part. You really need further, out in the risk spectrum. And I would honestly, I would leave the last probably 10 to 20% to hedging. I mean, you need to hedge your portfolio, right? So, you want to go to Deribit and, get exposure to BTC and ETH options to hedge the beta, right? You want to maybe go to the CME. You want to maybe use X margin, which actually now you can actually do bilateral options trades efficiently through X margin. So again, I think.
But I mean, you really need to know what you're doing to start hedging a crypto portfolio. Most people that are coming into the space now, when you're talking to them about hedging on Deribit, I mean, that sounds like a place I don't really want to be swimming in.
Okay, fair enough. So there's an offshore market and there's an onshore market as well. So then, other entrepreneurs stepping in the space, for example, the SKU platform, which is a very elegant crypto volatility analytics platform where you can get exposure to the CME, which is the onshore cash settle product. Of course, you need, an FCM.
I was talking to the PhDs from MIT. There are a couple of them out there, I know it.
Yeah. So
got it.
I guess, Ren, it's just about, I always think things from a risk management perspective and that it's all about capital preservation. You want to get the right exposure. You want to have defined levels on the top side and the downside. And then we've all spoken about position sizing, which I think is the biggest part of any portfolio, because it really is about, how you think about position sizing and risk, and then managing the difficult, the various factors that you have exposure, within that portfolio. So I think that has to be it could be a small part, but it could also be a big part as well. Because, for example, you could have an options portfolio that is strictly, have exposure to the top 10 coins, right? Again, through, this elegant new live solution called X margin, you can go to the bilateral market and get exposure to the top 10 coins potentially just on an options basis, right? This is getting a little bit more down the rabbit, but
that's too far down the rabbit hole for this 35-year-old. So we've got a few minutes left.
I would tell people that the options in general in life, when you're trading at 50, 80, 90 vol, you don't make money on. There are very few people I know that have made it.
It's a casino. It's a casino.
80 vol for options.
Yeah.
So you can, if you cut your timing exactly perfectly. And so I think you've got to be, if you're a retail investor coming in, you want to participate in crypto, to some degree, keep it simple, stupid, and don't think you're going to become a billionaire overnight.
Exactly.
Well, and like you want some quality of life, right? Like you don't want to be like watching this thing in the middle of the night. Like I mean, it's like
what do you mean?
$100,000. Like,
what do you mean? I thought that's all we do in lockdown is watch the prices go up. People ask me, "What are you doing tonight?" I'm watching Bitcoin go through 10,000 again.
And you got to look at Bitcoin as look at Bitcoin as a multi-year bet. I think we could get to 20,000 literally within a year. Maybe by the end of the year, things all happen right. We're in this weird macro world where things are shifting quick. That's close to double your money, but it's not 10 times your money. Right?
Mike, I'm going to challenge you on that point specifically. And I have a theory. I want to run the theory by you, and then I've got two questions that I want to ask all of you guys. So my theory is that if you look at commodities, you look at silver, you look at gold, those silver and gold trades have run way past their all-time highs. They've broken through all resistance levels. Gold's trailing on $2,000 where it's never, ever been before. Bitcoin seems to me like the digital version or the commodity that hasn't even retraced to 60% of its all-time high. Don't you think that when the gold price gets too high, when the gold price gets to 2,200, 2,300, institutions are going to look at this, and they're already doing this, and say, hold on a second, gold's too expensive, it's run too much. Silver's too expensive, it's run too much. Copper going through the roof. There's another option out there which is still at 60% of its all-time high. And the amount of money that we need to get Bitcoin way past the $20,000 mark is insignificant in the big scheme of things.
So here would be my counter, right? Like if you pitch that to me and you're like, buy this thing, it's 60% from its high, but this other stuff's at its all-time high. I'm just like, I'm not saying this is how I agree with it, because I actually do think some of that like thought process will stick and it'll carry it. But you could just be like, this thing's clearly a dog. Why am I going to buy it? It's lagging everything else, right? Like, well, I'm going to stick with the winners and I'm going to run with the stuff that's clearly working and like the thesis I have. So like, it's not necessarily like a home run just because it's lagging.
But it's a great alternative to the existing hedges that they're applying to the equity portfolio, right?
I think it's hard to get people to even buy in that logic already, right? Like, I don't think it's just like a foregone conclusion that you're like, oh, like I can just swap gold for Bitcoin. Like, I think that takes a little bit of work still to get through. Like, I don't think you've even like converted that.
Yeah, I think, listen, gold, I think should be, given obviously the macro environment that Mike spoke about, should be in everyone's portfolio. And I think, listen, we're trying to prognosticate, as best we can, which is obviously very difficult, right? But I think, listen, it's all about proportion and sizing, right? And then managing your downside risk. So I think if you, get that, say quality exposure, which is one of the factors you want to look at besides like size and momentum, it could also be a momentum factor, right? So depending on, how you define these factors and then, how you size these, position sizing, some type of Kelly criterion, it's really all about position sizing, knowing your downside risk, having whatever that percentage size with a defined downside risk in your portfolio. I think, I think gold's got to be in there. And, obviously digital gold, which I'm partial to, has to be in there as well.
Okay. Rob, your thoughts. Can Bitcoin break the all-time high just because we're comparing it to a gold safe haven?
Sure. I don't know if it's because of the fact that it's considered a gold safe haven, but I do believe that it'll break anything that we've seen before. When, I have no idea. But I do believe that'll happen. I mean, I think it's inevitable.
Okay, fantastic. Now I was hoping to get Mike back, and he seems to have logged off the call. But I want to ask you guys, we're all deep down this rabbit hole. We're far down it, and our lives are all around crypto and blockchain. What percentage of your personal total assets today are exposed to this industry? Bitcoin, crypto, VC. I'm trying to get a feel for how responsible we are, having gone down this rabbit hole. How much conviction do we have in the space relative to our total asset base? And I'm going to ask Daniel, you go first.
Yeah, so I'd say I'm probably the most irresponsible. Besides my like residences, I own 80%. And like 80%. Probably more if you like consider any like equity value on CMS.
Okay, Paul.
Yeah, it's not as high as Dan, but it's definitely north of 50. I mean, it's, you know, I'm a big believer in the space, and, you know, it's not only about timing, but how long, you know, your time horizon is. But yeah, I mean, it's north of 50. I'm a believer in the space. It's not going away, and we're really in front of really almost a tsunami, almost a wave that will never break. We're all still in front of it, even though we're, you know, even a decade in.
Robert, over to you.
Yeah, I'd say I'd have more in if I could sell a couple of my investment properties right now. But outside of the properties, I'm all in. However, the majority of that is in the venture side.
Wow. So I'd love to know what Mike's answer is to this, but it seems like we've lost him, and I guess he's going to leave us guessing what his what percentage of his personal wealth is not in crypto. I imagine it's very, very high. Gentlemen, thank you very, very much. It's been an amazing, amazing panel. You guys have given a whole lot of great information helping people build up their crypto portfolios. And I look forward to catching up with you guys again and finding out how good all this went. Thank you very much.
Thanks, Ryan.
Thanks.
Sorry?
I'm going on to share screen. Is that okay, just to check with you guys? Because I've got a short presentation, or would you rather keep it just me talking?
Yep. Hi, guys. So welcome to our next panel. On this panel, we are joined by Stephen Goldstein, performance coach, managing director at consultancy firm Alpha R Cubed. So welcome, Stephen. Thanks for joining us.
Absolute pleasure. Pleasure to be here, guys. Okay,
so, Stephen, sorry.
Yeah.
I'll just briefly introduce you. So Stephen is going to talk about the metagame of trading, which is the human and behavioral aspect of trading, an aspect that it's as important, if not more important, than the technical strategical one.
So before we hand the floor over to you, I just want to remind everyone who's watching throughout the presentation, make sure you're asking questions in the chat. We'll be looking in the chat and we can ask them directly to Stephen. If you're enjoying the show, please hit that subscribe button so we can bring you more awesome events like this. It's been really cool to watch so far. I'm really enjoying it myself, and I hope you guys are too. So now, without further ado, Stephen, please share with us all of your knowledge.
Okay, well, good afternoon. Welcome to sunny London. I'm going to talk for about 15-20 minutes on the metagame of trading. I'm just going to do a switch to a presentation which will go alongside this. So if you just bear with me 1 second, that shouldn't take long. So are you seeing this now?
Loud and clear.
Lovely. Okay, so as I said, this is about the metagame of trading. I'm going to give a short talk. It aims to keep to about 15 minutes. I've built in about 5 minutes for Q&A that we can bring in as we're going through it, or we can wait to the end, or we can do a combi of both. The short talk which I'm about to give, I feel maybe just perhaps possibly the most important short talk you have ever heard about trading. And I know that's quite a big and bold claim, and I'll give you the reasons why in a second. The long and short of this is that success comes from developing your metagame. But first a quick introduction as to who I am, so you've got something to go on. I work as a performance coach, an executive coach, a systemic team coach, and I've been doing so for the past 10 years. I coach many people at some of the world's largest investment banks, hedge funds, commodity and energy trading firms. And as a coach, I work on developing people's risk capability, helping them develop themselves as risk takers and risk managers, and improving and finessing their risk processes and their metagame. And essentially helping them to become their edge themselves. Now, I've been coaching, as I said, for 10 years. Some of my clients are portfolio managers at some of the world's largest firms, and these guys are managing capital measured in the hundreds of millions of dollars. Other clients are private and retail traders keen to help themselves grow and develop and give themselves a far better chance of succeeding. And just to give you an essential guide to the sort of people I coach, they're very high caliber individuals. 3 of my private trading clients are featured in the next Market Wizards book, which will be released later this year in November. Now, before becoming a coach, I was a trader myself. I worked for almost 25 years, starting in the mid-80s at a Japanese bank in London. I then worked for most of the 1990s at the Swiss investment bank Credit Suisse in the area of interest rates, derivative and FX trading. In the late 90s and early noughties, I worked at the German investment bank Commerzbank, and then finally the banking arm of American Express until 2009. I also host a podcast called the Alpha Mind Podcast, which explores the mental, emotional, psychological, and behavioral challenges people face in trading. And I'm actually the co-host on that. And I also lecture on behavioral finance. So I hope that you can see some of the background I've got and some, hopefully, of the credibility I have to make this pretty big statement, which is that the metagame is the most important part of trading. And I hope that's got your attention. Now, the term metagame describes the game beyond the game. And the prefix meta is broadly means to transcend, to rise above, or go beyond whatever aspect it refers to. So meta knowledge is not knowledge about a particular field or type of knowledge. Meta awareness is the ability to observe your your thoughts, feelings, and your impulses and your emotions as they're happening in real time. Metacognition would describe awareness and understanding of one's own thought processes. So these are all parts of the metagame. And I find that people who are incredibly successful at trading are incredibly strong in these aspects. So describing the metagame is not always the easiest thing to describe. So I'm going to compare it to the known game, the parts of trading that you will be familiar with. So strategy, tactics, the mechanics of trading, the playing field, the market itself, the rules, resources, information and knowledge about markets and tools and instruments. And of course, you have to be strong in all these areas, the known game. You know, for example, if your strategy is flawed, you won't win, full stop. So
it looks like you're muted, Stephen. Yeah, we're just going to take a moment to get Stephen's audio back. Not exactly sure where your audio. There you go.
Yeah.
Yep, you're good.
Okay, not too sure what happened there. So as I was saying, if you want to succeed as a trader, you have to have a sense of where the market is heading. I mean, after all, that's why you're at an event like this. But that is not the game. That might sound strange, but the game is monetizing the market moves, not just knowing where it's heading. And where the market heads, really, in the big picture, that is short-term noise. Whereas winning the metagame ensures you can turn that noise into profit. So being strong in the known areas, essentially that's the baseline. You have to be good at those things. That is a minimum requirements. But the known games aspects, they cannot be your edge, because the known game aspects are rarely unique. If it is unique in some way, then it has a limited shelf life. I mean, you're competing against millions of other people, literally, and they're all like you. They're smart. They know the known game. They have good strategies that maybe feel unique, but almost certainly isn't. And your knowledge and your insights of the markets aren't unique either. And even if they were to be unique for a short time, it's for a very short time only. They don't remain unique. There is a decay to uniqueness. So your known game is not your edge, but your meta game is. So I use a comparison of poker to sort of bring this to life a little bit. You know, knowing the value of hands is a must. That is a known game of poker. Knowledge about poker, about the other players, you know, the value of the hands, that is important. But it is your meta game as a poker player that wins the game for you. So the meta game, it kind of exists above and around the known game and within it as well. And as I say, if you want to succeed, you have to be strong in your metagame. You have to have a strong metagame. Now, right now, you might be thinking, okay, so I get this, but what is the metagame? And some of you might be thinking it's trading psychology, but that's really just a lazy definition of the metagame, of the non-tangible aspects of trading. The metagame consists of many aspects, and everybody has a metagame, and everybody's metagame will be slightly unique and different. The important thing is their metagame strong? So some of the aspects which are a part of your metagame could include preferences, beliefs, philosophy. It could be affected by your formative experiences, decision-making skills, quality of decision-making skills, your learning experiences, if you learned from a good mentor, ability to think in terms of probability, personal psychology, relationship to uncertainty, and lots of other aspects, including emotional management, ego management. So it covers a whole range of areas. Now, as an analogy, again, to try and bring it out, I like to compare it to business culture. You know, two businesses can be virtually identical. They can have virtually the identical strategy. And yet one can have a great and supportive culture which drives the success of its strategy. And the other one can have a weak or poor culture which undermines its strategy. And culture is often considered the secret source of great business. It's unique and often, you know, becomes impossible to replicate. And it's why the legendary management consultant Peter Drucker said, culture eats strategy for breakfast. And if you think about your metagame eats strategy for breakfast. It is your secret sauce. It becomes your edge. And in effect, you become your edge. So I'm going to try and bring it to life with an example from my history as a coach. And this is based on a true story of an individual who came to me a few years ago. This guy worked at a hedge fund. He joined the hedge fund after 12 years at an investment bank, working in their bond trading division, where he'd been incredibly successful. He'd been well sought after by many funds for many years. However, he'd been at this fund 3 years, 12 quarters, and his performance had been mediocre at best. He'd managed to produce positive returns, but they were in the mid single digits, about 5% per annum on average. And not a particularly great sharp ratio, the ratio of volatility of drawdowns either. So both he and his employers were disappointed with his performance during that time. And he came to me saying, I've really got to do something because, this isn't good enough. I'm not going to survive another year. That is a huge difference between actual performance and real performance. And, he's a very diligent record keeper. And I said to him, go back and look at all your performance. That's where we got this what if P&L from, this 40% figure. What if you'd executed everything you said you wanted to do, everything that your strategy identified, the opportunities that you'd found in the market? So he came up with this diagram that you see in front of us. And this is just a representation of it, where his annual average P&L was about 40%, ranged between about 25 and 60 per year. But his actual performance, as you can see, was very, very low, about 5%. And this difference, this represents money left on the table. And in effect, his metagame wasn't strong enough. Your metagame is always changing depending on the situations. It has to meet different challenges. And it hadn't adjusted for when he'd moved to the hedge fund from the different culture, the different environment in the investment bank and the different pressures that put on him. And this is what we worked on. We worked on developing his metagame. Now, this is representative of his P&L the next year. His actual P&L was 15%. His what-if P&L, which we tracked as well, was, I think it was close to 27%. So he'd massively closed that gap between the two. I think eliminating the two would have been impossible. But he was actually the top performer at this fund, which was a very large fund the following year. And, ever since then, I continue to work with him, and he continues to pretty much hit the ball out the park. So that kind of gives you a sense of what the metagame, developing your metagame is. And really, great performance demands a strong metagame. I think within the confines of this 15, 20-minute presentation, I can't really describe it fully. Probably take a few hours. But a strong known game is vital. That's base cap. That's the baseline. A strong metagame is what gets you over that line and keeps you there. And they are interconnected and independent. Now, I have another analogy here, which is what I call the performance improvement call option. So I'm sure most of you are familiar with a call option diagram and a call option payoff diagram. But I use this here to kind of emphasize the importance of putting time and energy in developing your metagame. It won't happen overnight. It takes a long time. So time is the horizontal axis. But once you start working in it, slowly your game gets better. It starts to develop. And I want to show you another analogy I use, which actually comes from my own career as a trader. So I worked for almost 25 years in the markets. And the first 13 years working in investment banks, could pretty much say I was okay, probably mediocre. I probably survived, had some good years, some very good years, but had far too many mediocre years. So I never quite fulfilled my potential as a trader. And then I purchased my call option here in the year 2000. I went into a coaching program with one of the best coaches in the financial markets. And that changed everything for me. At that point, I was looking outside of myself for the answers. I'm looking at, how can I be a better trader? How can I do what they're doing? How can I make myself do that? How can I be like that? You know, I was always into self-development, but it never really made a difference. I was an avid reader. But once I started working with this coach, I started looking inside. He kind of introduced me to myself. He kind of introduced me to my metagame, which I didn't really know the term at the time. And I don't think he fully knew the term at the time. But that was effectively what he was doing. I started to look at my risk processes, what I was doing it, how I was doing it, how I was bringing the best of myself to my risk processes, where I was weak, where I could mitigate some of those weaknesses. And you can see this is my own personal rating of my performance over the years. And, you know, scoring it out of 100. And that was reflected in my P&L in those years afterwards. That was reflected in my performance. Far more consistent, far stronger, far better. Pretty much coming in at the start of every year, trusting myself to produce strong performance that year. It doesn't mean I didn't have bad years, or bad times rather, but it meant that I bounced back from those bad times. You know, you're always going to have periods where you lose money. That's the nature of this job. That's the nature of trading. But I was far more resilient to those setbacks, bounced back far quicker, made money far quicker in those following years. So that hopefully puts some emphasis on what happened for me. I just want to put some examples, because people were asking how they're going to do this. How do you develop your metagame? Trading and risk are performance activities. They're not just intellectual pursuits. So it's starting to think of it like that. Start think of it as a business, and also think of risk as a process that has a sequence of different processes in it, and how each of these processes, both the tangible side and the non-tangible sides, work on starting to try and improve those. Don't just improve your analysis where you find value, improve the actual risk management processes and how you manage and execute risk, and also how you leave those risks behind, manage yourself during those processes, and how you bring yourself to finding value. Even before you do that, how you are, your personal state. Now, great performances, as I say, they work on developing their game and their self. They develop their known game, and they develop the person behind that known game playing that known game. They develop their metagame. And this is one of the things that I've found with the great traders over the years that I work with. And that they're not even conscious they're doing it, because they just do it. So they wouldn't turn around to other people and say, this is what you do, because they're assuming they're doing it as well. But these guys are doing the hard yards, the extra stuff, the stuff you don't think of. That's what great traders do. They do not just turn up. They turn up fit and prepared, and they're always seeking to grow and cultivate their edge. And one of the things that people come to me as a coach is they come because they want to get better. They don't come because they think they're flawed. They believe they can get stronger. They believe they've got more potential. I very rarely work with people who would come to me and say, look, I'm broken, I'm struggling, I need fixing. It's usually people who want to improve. Gaining an edge, developing your metagame. How do you do that? Reading, do some needs analysis, goal setting, keep a track of your own growth. Go to subscribed learning, classes, courses, events such as this. You know, listen to other people, smart people. Track yourself against them. Do development programs. Meditate, mindfulness. Great thing for focusing, dealing with the stress and the mind fuck that this job is. I hope I don't. Apologies for the swearing there, but that's what trading is. And do some guided deep learning. That's where you go to a higher level, working with a coach or a mentor. Think of them as personal trainers. I'm just going to talk very quickly about performance coaching, because that's what I do. It's a journey of self-discovery. It's raising a self-awareness. It helps you explore, make sense of your risk process. It helps you uncover your metagame and supports you to develop it. It helps you cultivate the unconscious, making the implicit parts of how you are far more explicit and uncovering your own secret source. it resources you, it catalyzes your growth and awareness. It helps you discover, refine, and sharpen your edge. It supports you to develop, embed, and sustain change, make behavioral improvements, improved habits, and a better mindset. So that is what performance coaching delivers. So as I said, it's a short presentation. Time is limited. That's a little bit of details about who I am. I have a podcast, the Alpha Mind podcast, so feel free to check that out. We have some great interviews with some incredible individuals. We have a blog. We're soon going to have a newsletter. But I'm going to sit back now and open myself up for some Q&A from you guys.
Thanks a lot, Stephen. That was very interesting. Before we move on to the questions from the audience, actually, I have a question from myself about this metagame trading that you've been explaining. So I'm very fascinated by the psychological factor of trading. And I was looking at a recent tweet that you posted when you talk about emotions in trading. You said that if you aim to suppress your emotions as a trader, you are also giving up vast amounts of opportunity which your emotions will identify. So it's interesting because a lot of people in trading say that in trading, there is no place for emotions. If you follow emotions, you're going to get wrecked. And you are saying that actually emotions can be actually helpful in some situations if you handle them properly. So can you explain a little bit how?
Yeah. If anything, develop your relationship with your emotions, because, you can't suppress your emotions. You can try, and some people do, and they mix emotional management and emotional control with the idea of suppressing your emotions. And your emotions are the source and the seat of great decision making. So sort of being able to have processes that can help you manage them is vital. But trying to lose your emotions is like it's like trying to lose your shadow. It's an impossible act. It's part of who you are, and it's a key part of who you are, and it's a source of your strength. So if the great traders I work with, they work with their emotions. They are, as I say, they are a source of their strength. Your emotions find value. Your emotions give you signals, your feelings, your intuitions, you cannot just do it like that. The great traders I meet, and some of them are highly intuitive, some of them are highly logical, but they all work with their emotions. And in fact, my most recent podcast last week, the not this week's one, the one a couple of weeks ago, talked about risk personality, and people can take a risk personality test where they can see where they are in terms of emotions. And some of the best traders we work with, the most successful ones, would say they're highly emotional. And yet in their trading, they're not, they're calm. They work and they manage to limit those emotions. They don't suppress them, but they have rules and processes and guidelines which give their emotions a place in how they are. And then when they leave the trade, they work on making sure that, their emotions are not firing off all over the place. And if they are, which you can't help, they won't take the next trade. They'll wait till they've calmed down again before moving in. And a lot of them, they practice mindfulness as a way of not suppressing their emotions, but as a way of working with their emotions.
Yeah.
So do you have a follow-up?
No, actually, we can move on to the question from the audience.
Yeah, there's a question from the audience from Wook Chewy, who asks, do you see a meta difference between someone who is self-educated versus a formal financial trading?
Yes, not exclusively. Obviously, if you had formal training, you improve your chances of succeeding significantly. Some of the it's almost like, having a mentor is the best thing you can have. Finding a mentor is probably the hardest thing you can do, because there's not many of them. There's some brilliant ones out there. I'm not a mentor, I'm a coach. So I tend to work probably a little bit later in the process with people. But most of the people that I know who achieved incredible success have had some sort of mentor, someone that gave them some guidance early in the process. Some of them had several mentors. Education is important. Finding good education is challenging. I came across an article a couple of years ago from an individual who's a very successful trader who worked at a prop firm in America. And he'd analyzed how many people succeeded that came into this firm. And he reckoned that the number was about 4%. Roughly 4% he considered success. But when he looked at those who'd actually had formal mentoring of some sort, he found that the number was about 8% of those who had formal mentoring succeeded. So if you use that as a kind of analogy, it doubles your chances of success. Now, again, with the clients I've worked with, many of them, obviously, they have the coaching through the companies they work at. But a lot of people I know, they hire me as a coach themselves, and they have significantly greater success. And we have some examples of it where people were just performing, a little bit mediocre within the firm. They were okay, but their manager always said to me, I felt there's a lot more to come from this person. We're not seeing what they're capable of. And then when I've worked with them, their profitability has significantly improved in the years after that. And when we're talking about millions of dollars improvements, when we're talking about investment banks and hedge funds and energy trading firms.
Yeah. I had another question. When would be a good time to start really paying attention to your metagame statistics? I mean, is there a certain point in your trading career where it might be more beneficial than at a different point?
Yeah, day one. Day one. Some of the guys, as I say, I've got 3 guys featured in Market Wizards. These guys are incredible traders. They're private traders. One of them, who I've been working with for the last 4 years, turned £30,000 into £10 million. He's paid himself a lot of money in that time as well. And he has a lot of dealing costs. He's got his own analysts now. And, he's got some heavy subscriptions. This guy is incredible, and he's tracked his performance from day one. And the other guys have as well. This is, if you want to run a marathon, right, you can't just turn up. You've got to do the hard yards. Great marathon runners, right? They go out and they beat the tracks for miles and miles before their day starts, and they go to work. The great traders I know, they do the hard stuff away from the screens. You have to do it. I mean, how are you going to know how good you are if you're not tracking it?
Gotcha.
All right. So that was it. I think that we need to wrap up the panel. That was great to have you on, Stephen. Thanks for sharing your knowledge with us.
It's an absolute pleasure, and well done. A great event, guys.
Great. So
Hello, everyone, and welcome back as we continue on this Cointelegraph live stream that's all about trading. And we have an amazing panel for everyone that will focus on technical analysis and where to go. We got three awesome panelists. John Bollinger, who I'm sure everybody knows from Bollinger Bands. We got Charlie Burton, who manages money. And we also have Mr. Chonis, who is pretty popular in the crypto trading game. I'm gonna let everyone introduce themselves and feel free to mention what got you really hyped about trading and technical analysis, especially for the first time in your life. I think it's an honor to start with Mr. John Bollinger. It's an honor for me to finally meet you and have an interaction. So we'll let you kick us off.
I don't know. The seminal event in my investing life was when my grandfather gave me some shares in a company called Fruhoff, which was a tech play in its day. And over the next 5 or 6 years, it promptly went to zero. So that should have dissuaded me from being interested in markets and trading and stuff, but it did exactly the opposite. It got me really interested in markets. And I've been going down that path ever since.
Gotcha. Let's head over to Charlie Burton. Tell us a little bit about you and tell us about Easy Trader as well, real quick.
I started in '97, went on a trading course like so many people do, and with an American company actually that taught me the basics of looking at a chart and trading the options markets and whatnot. And that's what stoked my interest. I had no interest in becoming a full-time trader at that point. I just wanted to trade because I was interested in it to do on the side, like so many people. And then 5 years later, I ended up going full-time. But and then Easy Trader, my company, came along years later. We started writing an investment newsletter. And as technology has progressed, as the years have gone on, we have live trading rooms and swing trading apps and all sorts of things. And I manage money. I'm an FCA regulated fund manager here in the UK as well. So that's basically it. So 23 years in now, but still learning every day.
Quick question. Do you remember the name of the company that taught you how to trade? Because I did the same thing, but it was in the early 2000s. So I guess you have a few years on me.
It was John would probably know, it was Tony Robbins' organization. Called, and I can't remember what the course was called at the time. It wasn't Tony Robbins himself. He had trainers who used to do, I think it was called Wealth Mastery at the time. And so you had trainers who would teach you. I mean, it was really, really basic when you can look back now and say it was very, very basic. And the one thing that I never learned from that was risk management, to my own detriment in my first year of trading.
We're gonna get into
It's funny because that's the only thing you should have learned.
I know. Yeah. So I learned the hard way.
And one more quick question for you, Charles. Do you focus on options or position trades?
No, it was only in those first few years because that's all I knew. Is what I was taught is basically buying shares and writing covered calls against those shares. So that's how I sort of started. But then gradually as the years went on, I started to just buy literally, in those early days, puts and calls. These days, I just trade directly into the FX markets using, futures, FX, and CFDs.
Gotcha. All right. And Chonis, tell us a little bit about you and what made you fall in love with technical analysis.
Hey, Tom, thanks for having me. Yeah, so I've been day trading full-time for about 7 years now. I've been trading for almost 10, though. When I first started, I didn't know anything about TA. I was kind of heading into what I was seeing online, what people were talking about, tickers, stocks, etc., and made some money and then lost it all and basically decided that it was high time I learned TA and really how it can help me. And basically what it's been able to do is allow me to set rules for trading and the guidelines that I like to use for my everyday, trades I do. What's so cool about TA in regards to crypto is that I do feel that TA can be extremely useful in charting Bitcoin and other cryptos and use it in terms of setting the bias you want to set for your trades if you want to go long or short. So I think it's great that even though crypto is an extremely unique asset class, that I feel that classic TA applies very well to crypto and Bitcoin, and I love using all the indicators I like, especially the Bollinger Bands.
I'd like to follow on that. I think he's exactly correct that TA works quite well in the crypto space. And it's one of the reasons I got as interested in crypto as I did, is I took a look at it and saw that these tools were working very well. And I have a theory as to why that might be. We in the U.S. have the most arbitraged, the noisiest markets in the world. The U.S. stocks and futures have many kinds of professional interactions involved in them, very few of which have to do with what we would consider to be the classic price setting mechanism, supply and demand. They're mostly derivative functions that just add noise to the market rather than adding information to the market. And I think the opposite is true in the crypto space. I think in the crypto space, it's a much cleaner market. I know we have futures on cryptos now, but it's still a much cleaner market than any of the developed equity markets. And because it is, the signal to noise ratio is higher. And since TA basically is a signal to noise ratio detection mechanism, TA works really well in the crypto markets.
I can have a follow-up question for you, John. Like I do agree that TA works well, but I always prefer TA, and I'm a TA trader myself. I always prefer TA on the most liquid markets. And while I really like doing TA on the Bitcoin market, I hate looking at TA in anything other than Bitcoin because it's just too illiquid. And it feels like penny stock trading, which I hated doing TA on as well. What are your guys' thoughts on what John just said? I'll let John kick us off as far as, well, if TA on crypto works well, I personally think it begins and ends with Bitcoin versus the dollar. But maybe you guys have different thoughts.
Tone, I'll just start. Yeah, I agree that TA for me works definitely best just using Bitcoin kind of as my standard there. I agree that a lot of the altcoins, especially the ones that have a lot of low liquidity, do trade and do look a lot like the penny stocks, which you really can't get the best TA on because you get wicks in crazy directions and you don't have really the volume that shows you the true price discovery you're looking for. But in terms of Bitcoin, when we just start with basic TA, moving averages, exponential moving averages, all the oscillators we use, they're very clear, I feel, in terms of what they're showing in terms of patterns. And most recently here, when we just had this breakout, everything was kind of lining up that we would kind of have a very volatile move. The Bollinger Bands, of course, on the daily chart were extremely tight, pinching and showing that we were about to get something. And then when you see where we are in terms of the moving averages, how the price action has been above the meaningful ones, 50-day, 100 and 200, it seemed like the bulls had the upper hand on this, and that's what we saw in the price action.
Charlie, do you have anything to add on this?
As far as I'm concerned, yeah, I mean, I'm a technical analysis trader myself, but really it's the one thing that I find out there, it doesn't matter what market and what type of trader you're talking to, they all want to be right as much as possible. But I don't care about being right as much as possible. And we all know that you don't have to be right that frequently. And I think that's the main thing for me with technical analysis. It's not necessarily about trying to be right 80% of the time in your analysis. I'm quite prepared to be wrong as long as my risk reward is there for me. So if I can get a half decent risk reward on some of these moves that are there, then does it matter if I'm wrong 50% of the time or even 60% of the time? It doesn't. One of my best technical analysis strategies I have is actually about 45% success rate, and yet it's the most profitable one that I have.
Yeah. So if you think about it, there are two major avenues to profitability in technical trading, in all trading for that matter. One is your frequency. What percentage of wins do you have? Can be 40%, can be 60%. It's just a number. And the other is the size of your winners versus the size of your losers. So I'm guessing that Charlie has a system. If it's only 40% effective, and but yet it's making money, so probably has a win-loss ratio of 2 or 3 to 1 in terms of the size of the winners versus the size of the losers. And if starting traders would think about the relationship between those two sets of numbers and would really look at them in their own trading process, they would improve very quickly, I think.
Okay, so hey guys, so I am keeping an eye on the live chat. So if I see any good questions, I will go ahead and ask the panelists as well. But risk management was just mentioned earlier because technical analysis may not be the most important thing in a trader's arsenal. So before we get on to the actual technical analysis tools, I decided to really quickly grab a slide from a recent risk management workshop that I did. And in this slide, I'm literally, I grabbed a page from Wells Wilder Jr.'s book from 1978, New Concepts in Technical Trading Systems. And it was like a 70-page, basically manifest on technical analysis with one page being devoted to risk management. And here's what he writes. The message of this book is that there are 3 parts to a good technical trading plan. Using a good technical system, using the system on the right markets at the right time, and using a good money management technique. Of the 3, the third is the most important, being money management, the easiest to learn, and the hardest to do. And what I did with this slide, I basically said, hey, there are infinite amount of places where you can learn technical analysis. I teach technical analysis, and I do my best to teach you proper risk management and how not to lose your entire account on one bad trade, but it's gonna be the hardest thing for you to do. But number 2, I can't teach you. Using the right technical system on the right asset, on the right time frame. And I think that is also a challenge that a lot of traders need to solve. And those that can't solve it end up being followers of other traders. So what do you guys think about this dynamic of learning technical analysis, knowing how to apply technical analysis, and making sure that you have good money management and risk management? So let's head over to Charlie, and we'll start with you because you do have groups and newsletters. And what do you think about this dynamic, and how should a new trader manage this dynamic?
Well, yeah, I mean, I don't have newsletters anymore. That was years ago, but I do have groups. Yeah, I think there's a couple of things here. If you're talking about groups and followers and stuff, and we all have them, is that a lot of people are looking for help, and they're looking for people who have got experience in the markets for help. And so I'm quite happy to provide my experience in that regard. Wherever I can help people, then that's a good thing. But as always, it is the most important thing, as what we emphasize is good risk management. The problem that a lot of people have is they'll look at a chart, if they're a technician, or maybe if it's the fundamentals that are going on, and if they really believe that everything's lined up. And as you guys know, sometimes you can look at a chart and you can think, wow, that has got everything lined up. And what happens to those average traders? They bet the farm on it because they think, well, all of my indicators are aligned. The heavens have aligned for me. And that's the natural tendency for most traders, is to then think, right, I'm going to bet the farm on that. But so often the ones that we think are all lined up are the ones that actually fail, and the ones that we actually in our gut feel most uncomfortable about are the ones that actually work. So yeah, coming back to your first point about risk management, I mean, we just say to our traders, risk up to 1% per trade. And if you stay below 1% for every trade, then you're pretty much going to keep yourself safe. You can sustain a drawdown when drawdowns come along, but you can still make some decent gains and have some good results with that type of risk per trade. You can build your trades and build into them and do all of that sort of stuff. But if you start out at a maximum of up to 1% risk per trade, then I think that's always a good advice.
Hey, John, I'm sure you were probably met Wells Wilder in your days, or at least had interactions with him. I'm assuming you would. Maybe you can tell us a little more about this dynamic, and if you had interactions with him, just give us your views.
Well, he's still with us. You know, he lives in New Zealand.
I haven't seen him active much.
Well, I don't think he's active in the business anymore, but he's retired, living in New Zealand. I have met him. Very interesting guy. Wrote as you pointed out, a very important book in terms of TA that gathered together a tremendous amount of TA wisdom at one point in time, 1978 it was, and just pulled together a lot of threads and put it down in one book. I think it's one of the most important books ever in technical analysis, honestly. But there are two aspects to this risk management piece. Number one, Charlie touched a little bit on it. I have to disagree with him a little bit. It's the amount committed to each trade. And there are very good formulas for determining how much you should commit to a given trade. I really commend everybody the work of Ralph Vince. He's done more on position sizing than I think anybody else. It's very mathematical, and if that's a little bit too mathematical for you, perhaps another practitioner, Van Tharp, who has written extensively on position sizing, might contribute to that. The second thing is, second portion of money management for me, other than position sizing, is some sort of risk control. I personally like trailing stops. I've written a couple of my own trailing stops, but Wells Wilder suggested one. It's called parabolic. It's sort of a relentless approach to a trading stop in that it increments each and every period, no matter what. I prefer the work of Chuck LeBeau. These are called chandelier stops. And they progress as the trade progresses. So if the trade stalls, the stop will stall. That's the big difference between those two approaches. But they're both progressive levels that will keep you out of trouble. So position sizing is absolutely key. I think you should try to determine what it is in a formulaic manner. But a fixed number can work as well. And then the second piece is some sort of risk control, and for that, it's trailing stops for me.
All right, and Big Chonis, tell us about your any lessons that you in your you said you've been trading for about 7 years. Any horrifying experience of not following good risk management rules you want to share?
Sure, all the time, actually. Being able to control FOMO in this market is incredibly important. Bitcoin, for the most part, tends to range, and then every once in a while, like we've seen the past week or so, has a big move. So it's great that you're able to capitalize on those big moves, but during the times of consolidation and ranging, the wicks we see because of the leverage market that Bitcoin is in both directions can wreck an account, especially a account you use on leverage trading. So, in terms of me and how I approach risk management, obviously, never want to put all your eggs in one basket or one trade. There's always another trade. If you have a chart that you're watching and you miss your ideal entry, or it does something and you just aren't there to make the trade, preventing yourself from chasing into the trade after you've missed your ideal entry is so important. And the more I trade, the more I become more conservative. I've found in my trading, when you're new to trading, the temptation to up your leverage and to turn 1,000, make 1,000 look like 50,000 with like a 10x move or a 50x trade, and thinking about, oh my God, I could make a ton of money if Bitcoin has a huge pop there. But what the crypto markets tend to do is to kind of screw people on both ends of the trade. You'll get your Darth Maul wick that liquidates your longs, liquidates your shorts. And in the end, the closing body kind of stays more or less where it was. And that's what we continue to see in this Bitcoin market. So preserving capital risk management is the most important thing, because I think the term wrecked is thrown around a lot these days because people get wrecked very easily, and the volatility in these markets, especially in altcoins, can come so quick. And if you don't have a stop loss in, if you're not protecting your capital, and if you're not protecting your winners, it's okay to take a win. I think people, when they're up in a trade and they're not used to being up in a trade, don't know what to do. They're thinking they hit the generational entry, if you will, and they're kind of just let it ride. And those are never, they just never work out that way. That's why I look at trading as terms of, scalping and swing trading, and each trade individually. I'll take a lot of trades and try and make a few bucks on each trade, trying to go for that big home run. Those are the times where I think people put themselves out way too much risk and can get themselves into trouble. There's no reason to expose yourself that much in this market.
All right, Chonis, gotta move on. We gotta ask some TA questions. We're gonna kick this one off with Mr. Bollinger, and I'm gonna get very specific. We're gonna get right to the meat. What are your favorite technical analysis tools? But I'm gonna remove the obvious stuff. No candlestick patterns, no chart patterns like triangles or cups and handles, no moving averages. So we're talking straight up TA tools. Name 3. One of them can be an overlay like Bollinger Bands or Ichimoku clouds or parabolic stars, something overlays on the price. And 2 of them, oscillators. Your MACD, your RSI, your ADX, have at it. So what are your favorite TA tools that aren't obvious that everyone else uses?
So this is what we call a fat pitch, huh? It's obvious. For me, it's Bollinger Bands as the overlay. And then the 2 indicators that I would use as oscillators are %B, which tells us where we are in relation to the Bollinger Bands, and bandwidth, which tells us how wide the Bollinger Bands are. But having said that, especially in the crypto space, there are a ton of other TA tools that work really well. We talked here a bit about moving averages and such. They can provide some useful information. The classic overbought, oversold oscillators such as RSI and stochastics are quite useful. And I really like intermarket analysis in the crypto space. So I don't look at the tiny illiquid coins. I do watch an index of them, that shitperp index. I find that pretty useful. But I look at the other major coins where there's a lot of activity, Ether and Litecoin, stuff like that. And I think that work goes back all the way to Bill Ohama. Writing so long ago, he called it his 3D method of trading, is just look at related things and see if they're confirming your analysis. And I find that very, very useful in the crypto space.
All right, thank you, John. Charlie, let's go over to you.
Can I share a screen?
Sure. If you have permission to do so. If not, admin will need to do that. But I was able to, so you should be able to.
Let's see. Is that sharing? Okay.
Yes, it is.
Okay, so very briefly, I do use moving averages, so I've quickly taken those off. As you said, they're not allowed. But as you can see on the chart here, I've taken some moving averages off, but I use a MACD. I like using an MACD indicator for divergences. Find that works really well against support or resistance. So that's a favorite of mine. And just price action and trend lines and horizontal support and resistance, literally just putting on those horizontal support and resistance. This is a chart of, funnily enough, euro dollar. I know we're talking Bitcoin, but I've just brought this one up because I think this has been a beautiful pattern for such a long time. This building long-term trend line going all the way back to 2001. If I actually put this onto a maybe a quarterly chart, you'll be able to see it a little bit easier here. There we go. All the way back to 2000, this beautiful long-term trend line that we keep on coming back down and bouncing around. That's what we're bouncing off at the moment. Then we've got this declining trend line from the highs of 2008-9. And so that's to me is a beautiful chart there. And that's why I've been observing that. We've got a couple of horizontal areas of actually the first red line here, that first red line going back to 2015, that around 114 on euro dollar has been kept on coming back up to test it. And I love it when price comes up to a resistance level or a support level and just keeps on bouncing against it, because at some point it's probably going to break through, as you know, under technical analysis rules. So basics really: price action, horizontal support and resistance and trend lines, and a MACD. There you go. That's what I use. I'll turn the sorry, I'll stop sharing.
All right. And Chonis, what about you? What are your favorite technical analysis tools other than so one overlay and two oscillators?
So I try and find what are the best RR setups for me, you know, best risk reward. So I'm not kissing up here, but the Bollinger bands are a big part of my TA. I do like to use them. I have rules for how the price action responds on, let's say, the 1 hour chart, the 6 hour chart, and the daily chart. I'm very curious in terms about the higher time frames as well. In terms of my oscillators, I really like to use the RSI and the stochastic RSI. I adjust my RSI and Stokes settings slightly higher. The default for the RSI is 70-30, I go 80-20, and then the solve for the stochastic is 80-20, I go 90-10. And basically what that means for me is when the stochastic RSI, when both of our indicators are swimming above 90 or below 10, those are times when I'm saying, okay, is this an opportunity to long or to short? I do not long when the 15-minute RSI and stochastic RSI are above these lines, and I would consider a short, or I consider a long and would never short if they're on the lower end of the oscillator spectrum. And that just gives me a sense of where we are in the overall kind of wave pattern and where I can have my best chance to trade. When these oscillators are kind of in the middle, for me, that's kind of no man's land, and I don't see the clear signal to potentially take a trade. So I'm looking for extremes in those oscillators, mostly on lower time frames because I'm more of a scalper, and then try and take advantage of those. And those kind of offer me my best RR.
Can I just add one? I'd like to add one thing. I think that's unique to this market is that in a given day, 24-hour span, crypto really has three sessions. We have an Asian session, we have a European session, and we have a North American session. And I think, proper analysis of those three different sessions and the information that they generate can be hugely helpful. So we talked a little bit earlier about different time frames, looking at short, intermediate, long-term time frames, which I think is very, very useful. But in addition, I think we can decompose those time frames, especially the daily time frame, into subsections that provide useful information.
Charlie, you want to add something?
I was just going to add, actually, I was just interested in the overbought stochastics RSI. I mean, the one, just interesting, just because for me, I'll look at a chart like that if I put those types of indicators on. If I see them overbought, we all know that markets can remain overbought for longer than you think. So is there another trigger that you'll use? Because sometimes you'll get your RSI or your stochastic will get up there and it will sort of just wiggle along the top and as the market just trends. So do you use anything else to actually help you to decide that actually this is coming off and it's not actually just a strong trend?
So these rules work best for me in a 5 and a 15-minute time frame. I absolutely agree with you, especially in Bitcoin, that on the higher time frames, daily, weekly especially, you can have oscillators pegged way high. And that doesn't necessarily mean it's overbought, therefore I must sell. We saw clearly with the weekly stochastic RSI that it was pegged at almost 100 for weeks basically during the big run of 2019 and a very frothy RSI as well. So you're absolutely right that a market can range and still rise while these oscillators are at their peaks. But that's why I only use these specifically for the very lower time frames, because I'm not looking for a trend change. I'm looking for an opportunity of a scalp trade.
I'd like to tag on to that because that's a very interesting comment, but on the part of both guys, the idea that markets can remain overbought for longer than you have capital to resist them, and so on and so forth, it is a central idea. I like to talk about walking up the upper band or walking down the lower band. That's what happens in prolonged trends. So if we focus on those ideas, then we can see deterioration in terms of the trend. For example, in equities, we often see what I call 3 pushes to a high. In the initial impulse, you'll be able to get outside of the upper band really easily. And then a little bit later, you'll only be able to get to the upper band. And then finally, as the top develops, you actually won't be able to actually reach up and touch the upper band anymore. So you see that divergence building up all while we're walking up the upper band, and those oscillators are pinned at very, very high values.
All right, hey, thanks for all those comments, guys. I'll just throw one quick commentary in there. What John just said about the market staying irrational longer than you can stay liquid. When I thought I was like a really good trader, I basically ran out of capital shorting the real estate market all throughout 2006, and ended up getting a job at Bear Stearns, helping them build risk models in early 2007. So that's what happens when you slightly mistime the market, where that job went under a year later due to the real estate market that I ran out of money shorting the year before when I was just trading on my own. As far as just my TA, my overlay, my favorite overlay is the time to mark sequential, because I want that time element to trading. And on the oscillator side, I'm really falling back in love with Chaikin money flow, because it gives me that volume component into an oscillator. So that's a couple of the ones that I really like. All right, hey guys, so let's move on to this dynamic between fundamental trading and technical analysis. So technical analysis is basically a new tool, and the millennials and the new generation is falling more and more in love with it. But how much are the big institutional markets are taking TA seriously? And do you think that the amount of people that are investing in general is rising for the more towards the TA side, because institutionals are still all about fundamental analysis? And what do you think that dynamic is? And do you think an at-home retail trader even has a chance to compete in the fundamental analysis game? Because I honestly don't think he does, but I'm curious about your thoughts. So let's begin with John on this one, because you probably have the most experience of watching institutional traders still not believing in TA.
So years ago, I mean, decades ago, I coined a term called rational analysis, which is simply the juncture of the sets of technical and fundamental analysis. So you use the most useful fundamental tools and the most useful technical tools and join them together in a rational process. That's how you have to change that over the years as you know, we've gotten greater segmentation of the analytical person. Today we have quantitative analysis, fundamental analysis, technical analysis, and behavioral finance. So there's really 4 parts to the puzzle today. But you know, each of those have useful tools, and you can pick out the individual tools from each of those markets and combine them into a trading approach. And you know, the way I like to put it is, suppose you were working on a car in a garage, and there were 4 toolboxes leaning against the wall: a red one, a blue one, a green one, and an orange one. Somebody came to you and said, you can only use the tools in the blue one. You know, would you do that? No, of course not. You would go to the toolbox that had the right tool for the job, pull it out, and use it. And I think we shouldn't be prejudiced from one way or another. Technical, fundamental, quantitative, you know, behavioral. They're all useful ideas. They all generate information that can be used to make our processes more profitable.
Chonis, you want to chime in on this?
Yeah, the FA part of Bitcoin is really fascinating. It kind of there's so much more than TA that is available to analyze with Bitcoin. You know, on-chain volume and other indicators, miner profitability, all these things that you don't necessarily see on your Bitcoin chart, but can have a tremendous impact in the price action or determining what the future price action can be. I think a lot of altcoins tend to drive on news events, potential partnerships with bigger companies or something that tend to kind of move the price action sometimes more than the actual chart is suggesting. So FA does play a big role in this, and I think what I'm trying to do is enhance my FA side. You know, I feel like I'm pretty strong on the TA side, but in terms of the FA side, when it comes to Bitcoin, there's a tremendous amount that you can study that can give you a lot more insight and data, I think, than the TA side can necessarily show you.
And Charlie, what do you think about the fundamental analysis versus TA analysis? And what do you think about people tend to confuse news events that they hear with fundamental analysis? Because I always love to separate the two.
Well, yeah, I mean, I think it comes down to our innate human nature. We need to understand why something happened, and fundamental analysis sort of helps that inner desire for people to be able to justify why something's happened. One of the biggest questions I always get from traders is, Charlie, why did the S&P do this, or why did Bitcoin do that? And there has to be a reasoning and a sort of a fundamental reasoning as to why Bitcoin broke out last week or the beginning of this week. And I usually just say to them, yeah, there was more buyers than sellers, you know, but coming back to your point as well about fund managers and and this snobbery sort of element to, or where we don't use technical analysis, and yet you look at some of the greatest traders, you know, of all time, and you know, I always go back to the likes of market wizards, and you look at Paul Tudor Jones and Ed Sakota and Richard Dennis and some of these famous traders. They used a lot of technical analysis in their approach. So and I think certainly for the average retail trader who is probably trading over a shorter time frame, then market sentiment is more important in the shorter term than fundamentals, in my view. So, and you can derive market sentiment from the charts a lot of the time, and from obviously sentiment measures themselves. So I think for the big players, the big funds, then fundamentals are important because they're trying to understand those macro trends, which are important to the time horizon that they're looking at. But a trader who's looking to be in today and be out next week, I don't think it's as much, personally, I don't think it's as important.
So
I'm sorry. Hey guys, I am reading the chat, but I haven't seen any good specific questions about technical analysis. So feel free to throw them in there.
There's the point to make on Charlie's idea there is that, you know, there are no people that do not use technical analysis. It doesn't exist. There are no pure fundamentalists. They just simply don't exist. You show me a fundamentalist that has never looked at a chart, and I will show you a pure fundamentalist. But they all look at charts, right? So it's a really important point. They're all practicing rational analysis. They're all using technical analysis. They're just not admitting it.
That's a very good point.
It comes back to that snobbery sort of side of things, isn't it? They don't want to admit it. You're right. I mean, a friend of mine works at Bank of America in the city, and he uses all sorts down there. So, but they wouldn't admit it publicly, no.
All right, guys. So I'm gonna get you. So here comes a tough one to put you guys on the spot. If technical analysis is so great, how come people aren't rich and super rich, and everyone is so successful trading? And why is it difficult? I have my answer, but you guys are the panelists. Why is it so difficult to wrap your best technical analysis thinking into a script that automatically trades your market profitably perpetually? What is holding that up? So I guess, you know, let's start with Chonis on this one.
Yeah, it's understanding how to trade a specific time frame. You know, if you're using TA based on a 1 hour or a 4 hour, it feels like it's very important to have a sense of that particular trade. That's for me would be more of a swing trade. I would expect to be in this trade for hours, a day, maybe several days, because I'm on that higher time frame. If I'm on a lower time frame of 5 or 15, I'm looking for a scalp trade. I don't expect to be in this trade more than 10 minutes to a half hour, probably max, or else I probably didn't have like the best entry in it. It's a great question, because we have these tools that are supposed to show us the way. Either here's a buy signal or a sell signal, but the markets don't necessarily then trend in one direction, like straight up or straight down. Along the way, you get your troughs, wicks, stop outs throughout it. So even though you can have the best TA and really trust your tools, then you have the forces of other traders, bot trading, the exchanges themselves. And it behooves the exchanges to get you out of your position, so you're kind of fighting against all these things uphill. So I trust my TA, but you have to understand how to use it in the context of the time frame you're actually applying it to.
All right, Charlie, let's go over to you, and we'll save John for last on this one.
I'm gonna pick up on the first element of your question, which is why a technical analyst not rich, or whatever it was you said, something about the richest people.
Some of them are, but there's this expectation that if I learn technical analysis, I will be a gazillionaire, and there's reality somewhere in the middle between those two.
Yeah. I mean, well, certainly the average retail trader, the problem they have is they have a very short time horizon. They think that they can read a book and then become as you said, a gazillionaire, and they forget about this whole thing called volume in the market, and that they think that if I just carry on compounding at 10% a month and I start off with my £10,000 or $10,000 account, then yeah, I'll be worth trillions in a few years' time. It doesn't quite work that way. But the other thing with most technicians, well, as you said there, the good guys either just carry on just trading their own money or actually become money managers. And the very wealthiest people, traders out there, are money managers. Just mention any name. And John, I'm sure you've been a money manager, and maybe you still are. Sorry, yeah. So the wealthiest guys tend to manage other people's money because it's the easiest way to trade very large sums and to derive performance fees on the back of that.
I would say that the reason for lack of success, whether it's huge success or just success period, there are two reasons. First of all, discipline, specifically a lack thereof, and emotions, which cause a lack of discipline. Though that's the big problem for traders. And then, if you want to have one more piece in that puzzle, leverage kills. It just does. Every time you look at every major financial problem, and the bottom line was leverage every single time. So the overuse of leverage, allowing emotions to rule your process, and the lack of discipline, those are the reasons that people don't get wealthy or even rich or do well or lose all their money.
All right, I have a follow-up question to money management, but we have a good question from the audience that fits into exactly what we were talking about. Are bots better than humans at trading? Are emotional trades a good thing for market volatility? So what are your thoughts on putting your ideas into a bot versus doing it yourself? Or does it depend on the person?
Bots are fine. They work perfectly well as long as the market remains kind. When the market turns wicked, the bot dies. That's just it. And if you're fast enough to turn it off and pick another approach or another bot, then you can be successful at that. But bots only are able to trade the markets that they're matched to, and markets evolve and change all the time. So there you go.
And how do bots affect technical analysis, do you guys think? Charlie, go ahead. Feel free to answer both questions.
Yeah, I mean, I've never been a fan of bots. You look at the institutions, they have very, very deep pockets for developing all sorts of elaborate quantitative systems. And yet you get your average retail trader who want to develop a bot and have it scalping all day long. And the problem is with very short time frames is that there's always going to end up being execution errors at some point, even with a system. So my view is that yes, they are useful, but as a supporting tool to the trader. So they can be a great support tool from a testing perspective and from an alert perspective. But the trader still uses their skills to then take the signal and decide whether that signal is a good signal or not. Much like any discretionary trader, anyone here who we are all looking at the charts. I'm a top-down trader. I use the higher time frames and go down to the smaller time frames, and you can make that decision based on your experience as a trader. But if you're just letting a robot just trade, it's not really going to be able to do all of that. And as you said, they can come and go very easily with the market environment when that changes, just like what we saw back in February, March of this year. And so I'm more pro full automated bots if they are trading off of higher time frames than if they're getting caught up trying to scalp all day long, which I think are much more dangerous in my view.
I have two more good questions. So Chonis, if you're good, we'll move on. And so one of them is you guys both mentioned good traders eventually become money managers. And but doesn't that completely change how they're trading? For example, I've been a swing trader using mostly TA, though I do have a lot of strategies that surround earnings announcements, but they're still designed for a small amount of capital. Like none of my trading scales to large money management accounts. So how does that transition take place? And this is why a lot of people think that, well, if you're a young trader and you're making that, 40, 50% a year, why does that eventually fail and your strategies are completely useless with large pools of money? So John, maybe you can tackle this one.
It's just a matter of scaling. Some things just don't scale. Take people who successfully trade penny stocks. You just can't put a lot of money to work in that environment. That's one very simple example of that. But I think more importantly than that, it's people. Managing money for other people is a very specific discipline. It's a very specific approach, and it has its own problems that are not related to the market. So, while somebody may be a superb trader, they could be a terrible manager, and a great money manager could be a terrible trader, but he knows how to employ good traders. It's just, there's not an identity to it. Some good traders can become good money managers, but they're completely different disciplines.
All right, Chonis, let's go over to you on this one, and then we'll have Charlie close us out. So you're basically an independent at-home trader, your own capital. Are you itching to try larger pools and maybe become a money manager one day? Is that something that you are thinking for your future?
So it's an excellent question because I am an independent trader, but I've been approached by numerous people over the past few years who want to send me Bitcoin to trade for them. And there's a lot of conflict in that, obviously. When it's your own money, when I'm trading my own capital, there's a relationship, obviously, I have with it. I'm much more conservative, I feel, with it. If I'm using somebody else's capital to trade, either in a fund or for them or offering them advice and stuff like that, I don't know that if I have the same discipline that I would have if it was all my own money. And I'm humbled in the sense that people think, oh, I want to send you Bitcoin because you seem like you know what you're doing and everything, and you can make money for me, and that is possible. But the mentality approach that I would attempt to trade is completely changed if it's not my own capital. I'd be wanting to do a trade, but thinking about how conservative I want to be in that trade because I don't want to fail on other people's money. And just real quickly here, when John mentioned penny stocks and how you can't, how you devote the capital you want into it. Being nimble in this market is incredibly important. Things change so fast, and the market we have now in Bitcoin is not the same one we used to have in 2017 and 18. So even if you're new to the market now or have been in the market for years, you constantly have to adjust what's happening. Where are we on the hype cycle of this market? And that consistently changes.
Yeah, I agree with that completely.
All right, Charlie, go ahead. Close us out on this question.
I guess it depends on ethics. So I've met plenty of money managers who lack a moral compass, shall we say? So because, like you just said, if you are ethical and you care, if you're going into the money management perspective, then that can create all sorts of pressures because you don't want to let your clients down. Like you've just said, if people want to give you money to trade, ethically, you want to do well for them. You want to keep them safe and all of that. But that can have all sorts of detrimental effects. I've met people who have tried to jump over into money management and they couldn't deal with the pressure of, one, trying to perform, but two, of trying not to lose. And unfortunately, you have to be able to put money into the market and take on risk in order to potentially make money from the market. So certainly I've seen people who are unethical in the markets, who don't care about their clients. All they're in the business for is collecting commissions, and they'll trade and trade and trade and won't really care about the results. And then you've got the other guys who can't handle the pressure to perform, but they could actually be very good traders on their own accounts because they feel that that's okay. So there is that element. As far as size is concerned, then yeah, and performance, you mentioned like 50% a year. The average retail trader could smash it out of the park and do 100% or more. But yes, it does change, as John said, about liquidity essentially, and you can't go into the market with a 10 pip stop or 10 point stop, putting millions and millions into a position, and that's the difference. And so the big difference that I found is you just go up your time frames. So I manage money, but the money I manage, that I'm not trying to trade off of really small time frames because that's a risk. If I'm putting stop losses into the market 10 ticks away, that's potentially going to get seen in the market. And so what you can do as a money manager, though, if you've got stops which are a lot further away from where the market is, then it's much less likely the market's going to work its way down to those stops if they are that much further away. So, but if you're trading with much wider stops, then it's going to take longer to get to your profit targets as well, and everything's that bit slower. And as a result, usually the average annual return, even in a good year, is going to be less because you're just having to trade in a different style.
All right, guys, we have about 5 minutes left. I have one good question from the audience, but I'm going to ask it at the very end as a lightning round. So this is my last question to you guys. And you know what? Let's kick it off with you, John. If you can go back in time and give a young you, some advice about technical analysis, what would it be, and at what point in your life?
It would be to get much more serious about technical analysis much sooner, and to pay a lot of attention to the classics, those books that were written 50, 60, 80 years ago by the likes of Wyckoff and Drew and
Edwards and McGee,
like that. That would be me.
Charlie, how about you?
To my young self, I would say focus. One thing that I did, like most traders do in the early years, is I was a searcher. Like so many people are. And I went from system to system, from indicator to indicator, and never really got anywhere. And the late Mark Douglas, I met him in, maybe 20 years ago, and I remember him saying to me, if you locked yourself in a prison cell for 6 months, and I just gave you a 10-period moving average, I bet you after 6 months, you'd be able to make money, because that's all you had. The problem we all have nowadays is so much choice that we just jump around too much. So if I could go back to my former self, then I'd say focus on a few things and get really good at those.
Yeah, that's a very excellent point. Excellent point. Chonis, how about you?
Knowing when to take a win has been one of my things I've been battling with as a trader for a while. When you're in a winning trade, protecting that is so important. I can't tell you how many times when, as a young trader, I was in a winning trade that became a losing trade very quickly because I just didn't want to take the win. I wanted higher, I wanted more, and in waiting and not selling, it just cost a lot of money. And real quick, scaling into trades, you never will hit the nut bottom or the nut top, but if you don't scale in, if you put all your eggs in one initial entry, you don't have the leeway to dollar cost into that trade more effectively. So nibble into a trade, nibble into a position, and you'll have more options on how you can trade it.
All right, and I'll get you guys out of here on this. Do you think that the future of trading is AI and quantum computers and self-learning machines? Are you scared of that future? Do you think that future is going to affect TA and retail traders with everyone scared of the future of like the Terminator world, but instead of killing machines, they are trading machines? We'll end this one with John. So go ahead, Chonis, you first. Then we'll go over to Charlie.
In some ways, it almost feels like we're there. I mean, there's so much bot trading and AI trading. It seems like already when a stock has a news event that it can pump on, or there's money flowing into it, everybody begins to crowd into it. It becomes a crowded trade, and that necessarily doesn't mean that it's the best thing to be involved in. So yes, I think we are heading in that direction. I think the advancement of computing processing power will allow more automation in trading. But the human element, the FOMO element of that is still incredibly strong, especially when you get more retail into this space. Even with all the AI and the bot trading, I think just the average person at their computer will still have a large effect on trading for some time.
All right, we got 2 minutes to go, so go ahead, Charlie.
I'll be really quick then. Yeah, I mean, again, brings me back to Market Wizards. I remember in some of those interviews in that book, and if people haven't read it, you should read all the old Market Wizards books amongst everything else you read. But they were talking, we had automated trading in the late 1980s, and so and everyone was talking about automation back then, and it was 30% of the market. By the end of the 1990s, it was, I don't know what the percentage was, but it was a damn sight higher. So it's always been there, and in recent years we've had so much chatter, talk about high frequency trading as well, and that's gone a bit quieter at the moment. But so do I think the future is there? Of course, 100%. But like with all of these systems that have gone past over the last several decades, it still comes from a human in the first place. It's still a human being that's actually saying, right, I've got a style, I want to program this, then get the AI to help develop it. But it still comes from one person or a group of people. And you're still going to have different groups of people who are going to identify different things in the market anyway. So I think the market is can cope with a lot of AI, which is already there anyway.
All right, and John, we got 1 minute to go. Final word on AI.
So, markets are made by people. They're price discovery mechanisms, and they're made by emotional people. And as long as that's true, and that will be true as long as there are markets, then we got a job. And machines aren't going to change that. They may change the dynamics around it, but the basic core function of markets are as a price discovery mechanism, and we're just participating in that price discovery.
All right. Hey, thank you so much, guys. We are done right on time. Let's make room for our next panel. Once again, we had Big Chonis, Charlie Burton, and the one and only John Bollinger. Thank you so much, guys, for joining this Cointelegraph trading experience. It's been awesome. Thank you, guys.
Ta-ta.
Thank you.
Thank you.
Nice to meet you guys.
Yeah, nice to meet you guys.
What's up, everyone? Welcome to our next panel. My name is Jackson, and I'm here with Giovanni and none other than Pirus Crosby, who is a general manager at TradingView. How are you doing today, Pirus?
Good. Thanks for having me, guys.
Yeah, it's great to have you on as well. For those who don't know, TradingView is one of the top charting providers and is more or less a social network for traders. And the topic we're going to be discussing today is general trends in the trading tech world.
And also, I would like to remind our audience that this is an interactive show, so please write your questions in the chat. We're going to pick the most interesting ones. We are going to ask Pirus about them. Also, don't forget to like and subscribe on our channel. The floor is yours, Pirus.
Would you like to describe a little bit about, like what TradingView is, what you do, and that sort of thing?
Sure. So, high level, TradingView is, again, as you guys said, kind of a technical analysis platform, but we do a lot more than just charts these days. Funny enough, we were just talking about live streaming. We've actually launched live streaming on TradingView as of 2 months ago. Broadly speaking, our aim is to provide as much as we possibly can for the average investor at the lowest possible price point. So we continue to add more data, more capabilities, and the majority of the product is free. Upwards of 80% of the product today is still free and ready to use for the average customer. My role, so I joined about 2 years ago to spearhead, general strategy and kind of larger go-to-market approaches. We work with a lot of different folks, and so really we're trying to figure out where we kind of make our stake, if you will, for the next couple of years to come. We work with everybody, but we're always kind of expanding that. And so we've just launched a global partnership with FactSet. We're working on a much larger build out with probably one of the top 2 trading providers in the world. And we continue to kind of expand that funnel overall. So great to be here. And broadly speaking, I think, we definitely just want to, emphasize kind of our interest in being kind of the provider of record for a lot of the crypto world. Just for background, crypto makes up roughly 40% of our total audience today on a global scale. And that's 14 million users as of today. So 14% or 40% of 14 million gives you the rough estimate of the folks that are using our product primarily to trade cryptocurrencies and the whole crypto world. So we're definitely a big fan. And I think, based on, what you see in the industry overall, people more and more turn to us for their kind of crypto needs. I think we have something close to 30 crypto data sets integrated today, but we do aim to add more over time. And so one of the big initiatives that we've been working on is integrating a lot of the crypto brokers so that you can trade directly through TradingView. And that's definitely something we can dive into more if you guys want. But yeah, generally glad to be here, and it's been an awesome show thus far. John Bollinger is I'm a huge fan, and to be honest, he's probably the greatest of all time in terms of technical analysis. So I try to just add as much as I can here, but obviously standing on the shoulders of giants. A lot of these guys have been doing great stuff. So.
Yeah, actually, thanks again for being with us. It's interesting because I've been using TradingView myself at the beginning to learn how to trade. And I found out that it's a great resource for people that want to learn how to trade. So it's like it also contains some educational material, right?
Yeah. More and more we're trying to provide that as well. We brought on a couple senior people to our headquarters in London as of about 3 months ago. Their main role is to invest more in the educational side of our business. There's a lot of people out there who provide kind of really, really in-depth services and research, especially around the crypto community. And, we aim to both amplify them as well as kind of educate the beginners in order to know how to even use that research in the first place. So we want to partner with the pros on one side, but I do agree with you that there's a huge trading audience out there that's basically looking to learn how to invest and trade. And so it is our role to kind of educate them to make sure they don't, blow up their account, as soon as they start investing. John was just talking about how leverage kills, and it's really rough to see brand new investors and traders join the space. Maybe hook up one of these derivative exchanges or one of these maybe not very reputable trading exchanges, and all of a sudden they're using 100 times leverage and buying altcoins, and all of a sudden they've completely wrecked themselves and are completely wiped out of the industry. So our goal is to really make people last and really give them the tools so they can make more informed decisions, if you will, prior to going 100 times leverage. But you can see, like, I don't know if you guys are big fans of Reddit. Wall Street Bets is always something that we run into. These guys are kind of the autists of the trading world, and we aim to be kind of the opposite of that, right? We want to provide people really the tools so that they do not end up taking these crazy YOLO trades. I mean, they're funny to look at, and believe me, like, I'm on there all the time. But the reality is that these are people that are kind of crushing their own financial well-being for not just the near term, but the next 5 or 10 years to come. So we aim to kind of be the other side of that. And so we're doing a lot more around resources, as well as we're actually launching an editorial initiative ourselves in the coming months. So looking forward to it.
Yeah. I love going on that Wall Street Bets subreddit as well. It's like watching a bonfire from afar. It's beautiful and hysterical. But the topic of this panel is general trends in the trading tech world. So I'd like to give you an opportunity to maybe talk about, and this is a admittedly broad question, but what are some of the trends you have seen in trading technology and how it's developed over the years?
Yeah. Well, I mean, it's a great question. I think, I've been in the space for about 8 or 9 years now. Before this, I worked at Reuters, so I obviously know the trading tech from the Reuters side of the world, and then spent some time at StockTwits building a brand new social network for investors and traders. So being kind of deep in the space, I can definitely see what really is happening is a decentralization of trading tech services. Even 10 years ago, there were probably 2 or 3 products out there that did 90% of what you really needed. And that was kind of the one-stop shop that you'd go to find investing tech. So the Bloombergs and the Thomsons of the world basically dominated 80 to 90% of the market. What we see now is that more and more services are interoperable. So what that means is basically small pieces of tech that can to other, and you can get a majority of what you might get from a really expensive product through the financial web. You don't really need a enterprise license for Bloomberg or for a Thomson Reuters. You can get it all in one place, and that's kind of the value of the internet is, ultimately you can find all these services around the web. So, one good example I can give is a company called OpenFin. So they basically pull together a lot of advanced technology, and they are actually not a provider of the technology themselves. They just snap together all the different elements that you could find from these unique companies. So whereas, historically you might have gotten your charting, your order management system, your, data, et cetera, from a Bloomberg, we now think that you can snap together 80 to 90% of that, with iframes, with, enterprise licensing of all these other data services into a single place. And interoperability is a mouthful, but it really does explain kind of the natural transition that we've seen in the industry. For a lot of those folks out there who use different crypto trading platforms, whether it's Binance, Bittrex, you name it. I mean, Bitstamp is a good example over in Europe too. We power all of them. So tradingview.com is a great service, to visit and obviously to get your research and chat with your friends. But when it comes to using all these other companies as well, keep in mind that we are now powering the majority of the industry from an enterprise perspective. So all their charting, et cetera, comes from TradingView, and we're not alone in that. There's a ton of companies. I can think of Into the Block is a very well-known company down in Florida, actually, that's doing a lot of that as well. And so we're big fans of pulling all the elements together.
So it seems like one of the things that you're describing is a greater access to trading technology from a wider range of people. What kind of effects do you think that will have on the trading sphere now that more people have access to all of these different kinds of technologies?
Yeah, well, I mean, I think that more trading isn't necessarily better, right? So we do see, obviously it's a double-edged sword to give people access. And I think, one of the biggest innovations that the folks at Robinhood really came up with was the concept of free trading. While initially we thought that was great, as you can see, it doesn't make people better traders to make trading free. It actually reduces friction and can cause more harm than it can cause good, which can be an issue. Ultimately, I think more access, generally speaking, comes down to cost. And the more we can eliminate costs so that people can educate themselves, the better it is for the wider world. I think if we can basically give away the majority of what you would pay for free, you're basically giving people access to financial education that even if they don't trade, they definitely know how to, and they definitely have the tools to do it at their leisure. But no, I mean, generally, one thing that we're also thinking about as a company is how do we build more investor tools rather than just trading tools, and investor tools are very much a different set of skills and a different set of kind of needs, and so we're very much starting to build for the investor audience and investor segment to accommodate for their workflows, which are very different than a trader, somebody who's trading time frame or looking at hourly bars. I mean, that's going to be a very different workflow than somebody who's looking at a long-term investment for crypto or any other asset class.
Yeah, so I want to remind our audience also that if they have any questions regarding the functioning of TradingView, and also, like what kind of technological advancements are coming into the trading world, they are welcome to write in the chat. We're going to ask Pirus about it. I think we have something already from the audience.
I haven't seen too many questions relating specifically to general trends in the trading tech world. So it'd be great to hear some of those from you guys. I'd like to kind of also piggyback a little bit on what was being discussed last panel. They were talking about algorithms and bots. And I think this is, technology enables automation of certain processes, and it creates greater efficiency. And we're seeing that, that has been a trend in the trading world over the past years. So do you have an idea of like where this is headed, what the next step in this endless stream of automation efficiency? Are certain processes going to be cut out or combined? Where do you see this kind of this thing heading?
Yeah, great question. And I definitely liked the topic or I guess the perspective that John had on the subject matter, which is, bots work all the way up until when they don't work. Generally speaking, at TradingView, we do have a very strong community of people who basically build scripts. So real-time scripting for trade automation based on, things like price levels, volume, different strategies that can be built based on, standard moving averages or custom scripts. Those are all built by our community. And I think, before I joined TradingView, I actually had no idea how vibrant that community is. But trade automation is the natural evolution of retail investors, basically allowing them to be much more sophisticated than, even a couple of years ago, when you actually had to log into your E-Trade account to place a trade. Very much now you can do that by just creating a bot that automatically trades on your behalf. or at least alerts you as to when certain rules and conditions are met. And that's what we really think of as valuable, is when that rules-based approach really kind of takes hold. And yeah, I mean, there's just much less, I guess, well, I mean, there's much less room for error if bots or kind of automatic strategies are running things for you. And so we do think that's kind of the natural evolution of TradingView is much more automation. Yeah, the strategy tester, just so you know, I mean, people are coding up over 10,000 strategies per month. So if that gives you a sense of just how many of these people are building, a lot of them share them publicly with the community as well, which is pretty wild, because this is, considered proprietary code that, if you worked at a hedge fund, you would never disclose this type of information to the public. So, but broadly speaking, it's a natural evolution, I think. Yeah, I mean, bots are definitely working, but you got to constantly be building new ones, right? Each strategy that you build today will be out of date tomorrow, and so there's a need to kind of continually update and modernize the bots that you built yesterday, because ultimately those strategies go away, and thus efficient markets kind of take hold. That's the way it works in the industry. Yeah.
Mm-hmm. So. I actually have an unrelated question, because I just saw that TradingView had a partnership with Real Vision. I'm asking that because we had as a guest, we're going to have also Raoul Paul, which is the CEO of Real Vision. And I wanted to ask you more about this partnership. What kind of additional value has brought to TradingView?
Yeah, I mean, so I'm a big fan of Raoul and Real Vision in general. For those who don't know, before Real Vision, he worked at a company he basically founded a sell-side research company producing macro research that was probably the best in the industry at the time. It still exists, and I'm sure he still has tons of clients there. Broadly speaking, Real Vision is fantastic. I'm a big fan of what they're trying to do in deep dives. For us, the angle that they really played was providing a window into the institutional investor world, and how institutional investors really feel and react to markets. And that kind of content and information is extremely valuable for our users. So, I mean, it was a great, first run. I think we can do more with them for sure. But we really thought it would be actually best if we create video natively on TradingView. And so we've actually gone out and built basically what we call Twitch for traders. So it's a real-time streaming. And so this event is actually streaming on TradingView right now. So it's a real-time streaming platform that basically allows traders to go live at any point in time and talk about what they're trading, how they're investing, et cetera, et cetera. And I do hope that some of the institutional guys that Raoul, talks to all the time end up streaming on TradingView. It'd be awesome. But that's really been our approach is, again, decentralizing a lot of what you might get from a CNC or Yahoo Finance, something like that. Focus being this, let's actually make it readily available for the individual, and make them the next guest on CNBC by giving them the tools.
Yeah, that sounds really awesome. It looks like we got about 4 more minutes, so we have probably time for a few more questions. We've got one from the audience who's asking, well, let me start. You mentioned that 40% of the people on your platform are crypto traders, correct?
Yep.
Yeah. So are there any specific things on TradingView that are built specifically for crypto traders?
Yeah, I mean, a lot of the oscillators and strategies that people build on TradingView are built specifically with crypto in mind. I think that we tend to try to build tools that apply to all asset classes. So when it comes to specific tools that are crypto related, we don't do too much just for the crypto world. But important to note that like I said, we have 30 plus data feeds, and not just price data, but we actually have things like on-chain data and a lot of these kind of nuanced data sets that allow people to do that deep dive analysis that they need to. But yeah, I mean, we try to build products that are, I guess, multi-asset, and it's tough for us to build for a specific class. In the equity world, we have the same problem. There's a lot of like specific products that only really apply to the equity world. But for us to, kind of invest a lot of time in those specific products is going to basically make them kind of prioritized versus others. So really we have to build products for multi-asset kind of approaches. And yeah, there's a couple exceptions. I can't talk too much about it because not of it is public, but ideally we will have more custom workflows in the near future. But near term, we try to build, like I said, kind of for universal investing. And the thing is, most general investing principles apply for all asset classes. So especially around charts and technical analysis, it doesn't matter what data set you're plugging into that, the output is the same. You're hitting your 52-week highs, 33% retracements, moving averages, et cetera. All these apply across, every single asset that's out there. I mean, we recently added like all of the data around coronavirus, as well as some other viruses and infectious diseases. And so it's definitely something that yeah, we continue to add more data there.
Mm-hmm. Great. I saw a question a while ago in the chat also that was asking if you guys would bring order books to your charts. Is that something that's possible?
Yeah. So order books really depends on the level of data that the broker partner or the exchange brings to us. So we are building order books, and we actually have built an order book for TradeStation, which is the first partner to have it on TradingView. But we would love to build order books for broader asset classes. It really comes down to the quality of the APIs that the partners have. So we kind of are in a bit of a holding pattern until we see a lot of the brokers basically roll out their order books. Yeah, I mean, it's definitely something that we'd love to add in the near future. TradeStation has been great in that regard, and their order books are all available via TradingView.
Awesome. So I think that it's time to wrap up the panel. So thanks a lot for participating. It was cool to have you with us.
Yeah.
Pierce.
No, thanks guys, and awesome show. Glad we could pull together short notice, and yeah, keep me posted if I can be more helpful.
No, it was great to have you on. So make sure everyone who's watching this stick around for the next panel. We're going to have one of our very own writers, none other than BJ Pirus, who will be moderating the next panel. And that panel is called Hodling. Is it the best trading strategy? So make sure you stay tuned for that. He will, our writer will be joined by Edward Cooper, who is the head of crypto at Revolut, DataDash, Sunayna, Tuteja, I'm sorry, I butchered that one, and Eric Benz, who is CEO at Changely. So thank you guys. Make sure you stay tuned for that, and we'll see you soon.
See you.
BJ, way of life.
Okay. Hey everyone, and welcome to another panel as part of Cointelegraph Crypto Traders Live. My name is BJ Pirus, Cointelegraph reporter, trader, and host of Crypto Secrets of the Trade podcast. On this panel, we cover long-term crypto holding, also called hodling, compared against trading. If you bought Bitcoin in its early days at around 3 cents, you'd be up roughly 305,000% in profit today. Is hodling the best strategy though? This is a hotly debated topic in the crypto space. And to speak on the subject today, we've got Edward Cooper, head of crypto at London-based fintech giant Revolut, Nicholas Merton, crypto trader and host of the DataDash YouTube channel, holding 348,000 subscribers, Eric Benz, CEO of Changelly, a non-custodial crypto exchange platform offering more than 160 assets, and Sunayna Tuteja, head of digital assets and distributed ledger technology at mainstream online broker powerhouse TD Ameritrade. Welcome, everybody. Thanks so much for coming today. Edward, let's jump right into it with you. Can you give the audience a brief background on yourself and your experience with, hodling versus trading and the things you've seen doing both of those things? I'm sure you've done both.
Yeah, sure. So, Ed Cooper, head of crypto at Revolut. My journey started at Revolut 5 years ago. I started off as head of mobile there, but literally in the first kind of set of interviews, we were a very small startup back then. It was just the five of us. The guy I interviewed after me, we kind of bonded because he was into cryptocurrency and I was into cryptocurrency as well. We both like guitar, right? So I was like, okay, we have to hire this guy. He's great. And so that's when we kind of hatched this plan in 2015 that we wanted to incorporate crypto into Revolut. And that kind of led us on this 2-year journey. It actually took us to 2017 to get the kind of sign-offs that we needed, because it was tough, right? We're not only a startup, but we're like doing traditional finance, and then we're trying to incorporate crypto. So combining those, tough, but we managed to get it done, which was cool. And then I transitioned to head of crypto in 2020. And then on the personal side, I've been into crypto since about 2013. And I've definitely hodled and I've definitely traded. And interesting experiences with both.
Awesome. Yeah, you got in pretty early, so I assume you've gotten a hold of some of those massive gains. But
I still want to know.
I've taken some losses though,
I still want to know when Revolut. Edward is probably a big fan of this, but when are you guys adding Dogecoin already?
Oh, it's in the pipeline. It's on the roadmap.
Nice. Perfect.
Awesome. Sunayna, do you want to answer the same question? A little bit on your background and then hodling versus trading and your experience.
Yeah, happy to. Hi, everyone. My name is Sunayna, head of digital assets at TD Ameritrade. I know we've got a bit of a global audience, so brief primer. TD Ameritrade is one of the largest brokerage firms in the United States, and the prime constituents that we serve and have been serving over the last 40 years are really the retail investors, the active traders, and the RIA community. So when we think about our journey into digital assets, it's very much myopically focused on how do we build and serve those clients and unlock instruments and on-ramps that welcome them into this asset class. I know there's a lot of talk about when will the institutions get in, and there's a lot of great work going on in terms of encouraging hedge funds and endowments and other big players into crypto. But our focus is very much on how do we serve the needs of the active traders, the investors, and the RIA community. I've been with TD Ameritrade about 5 years, came in to kind of build our mobile digital practice and then kind of built our emerging tech practice. And part of my portfolio really was, we did a lot of work on commercializing things like AI, machine learning, and blockchain was a subset of it. But about a year or so ago, we decided that there was a lot of potential, both in terms of harnessing and applying the technology of blockchain, but very much, in the space of, democratizing investing in digital assets, that we kind of said we are going, kind of gave up the rest of my portfolio and, said this is what we're going to focus on. Personally, I've been, reading, learning, exploring, dabbling in the wonderful world of Bitcoin since 2012. So, as others have said, have definitely seen the ups and downs. But I think that one of the cool things, coming to your question about hodling versus trading, is it's fascinating that we can actually, probe that question today and have a debate on that question. I remember in the early days, 2012, 2013, it was a Herculean task just getting your hands on some Bitcoin and all the the hoops you had to jump through. And the ecosystem has come such a long way that we can create that diversity of use cases. So if you are a hodler, all the power to you if that meets your need. And if you're more of an active trader, all the power to you. So I think it's fascinating how far we've come. We believe there's still further to go in terms of usability and other things that we can touch on.
Awesome. That's a lot of great intel. Thanks so much. Nicholas, what are your thoughts?
Yeah, I just want to do a quick intro. As BJ mentioned, we met a while ago. BJ mentioned, I'm founder of DataDash, one of the larger YouTube channels for cryptocurrencies, and I also founded my own cryptocurrency startup called Digifox. It basically aims to be an all-in-one finance app, so you can earn interest on your crypto, you can buy crypto, and you can also send payments across the globe. But yeah, I've basically been in the space for the last around 3 to 4 years. And taking a look back, I've had about 9 years of experience through traditional markets as well as I used to do individual trading. The interesting perspective that I really want to push throughout this as we go through this discussion is that, as you introed me, BJ, you talked about me being a trader in this space. I do much more active trading, not so much day trading, but more swing trading. I like to trade cycles in crypto. As Bitcoin goes through these parabolic rallies and these big corrections that it has over very long time periods. And outside of that as well, I like to kind of go in and out of Bitcoin to altcoins. And I talk about how I actually go about doing these strategies on the channel. But the thing I want to emphasize today, make very clear, is I think for the vast majority of people, hodling, as boring as it can be sometimes, is actually usually the best model for most people. And there's a lot of key principles that I'll espouse, some that maybe people have heard before. Like the vast majority of traders end up usually losing in the market. And this just not only goes for crypto, but a lot of other markets as well. And outside of that as well, we've seen like a very large growth in the community of platforms that are basically aiming on providing ways to increase risk in the market. And what we've seen is a direct correlation with increased risk-taking opportunities like leverage trading, inevitably leading to people getting liquidated, inevitably leading people to losing all their money even quicker. So again, I think we need to see a revival in the space of encouraging people to focus on the long-term perspective, because Bitcoin is a very cyclical asset. It has these crazy rallies. It also has very sharp corrections. But all in all, the point that I always see constantly is that if you take a look at the long-term chart rather than the minute chart or the hourly chart, you see a consistency of higher lows and higher highs. And as a macro trader who's traded in traditional markets, there's no market that has the growth potential of Bitcoin and other digital assets that also shows this exact kind of correlation with each cycle, where it has these parabolic rallies time and time again. So a bit of a summary there. I'm happy to dive into it and hear any contrarian viewpoints and stuff. But I think it's definitely a great discussion to have, especially as we're warming up for what I think many of us can agree is the next cycle in the crypto market, which is really exciting.
Awesome. Thanks so much, Nicholas. To touch on something you said as well, just for listeners, let's just go with the concept that hodling is maybe holding an asset for like a year, between 1 and 5 years or so. Just because, scalping is taking trades like intraday, like anywhere between like short-term positions, and there's swing trades that can last weeks, position trades can last months, but hodling is more like long-term holding and not really doing much activity. So just to clarify, because it kind of depends on who you ask as well in the industry. Like some people will call like holding something for 2 months hodling, if they're used to really active trading, versus somebody who's not. It varies. So let's say hodling for this purpose is like between 1 year or more, let's say, or maybe 9 months or more, something like that. Eric, you want to weigh in on your background and kind of your experience?
Yeah, absolutely. Thank you so much for having me here today. And, obviously being in this space now since 2012 as well myself, it's been quite the ride. Obviously my background is actually in consumer behavior. And so I've applied a lot of my knowledge and experience in that field to basically help build out a lot of different crypto businesses and projects over the past few years. I actually started the UK Digital Currency Association here back in early 2013 as a result of, Edward, you know this, but the HMRC, the different bodies here obviously ruled at that time that every Bitcoin transaction would carry a VAT charge with it. So what we decided to do was create an association, as they say here, to basically lobby and overturn those decisions in lieu of creating a very large community to support a lot of crypto businesses. And I've been fortunate to be involved with a lot of those early crypto businesses here in the UK specifically. And obviously, with Changely overall, it's been 5 years now. We recently just celebrated our 5-year anniversary, and Changely has done a remarkable job to basically provide the easiest, most efficient on-ramps and off-ramps, I think personally, no bias obviously, but in terms of entering that new ecosystem and providing both traditional experienced traders or customers or users the ability to purchase as well as withdraw, but also the new incoming customers, because it is such a wonderfully designed, easy to use platform that we've spent a long time building and obviously making sure that things work. With all the tech, this blockchain and crypto ecosystem, because at the end of the day, we're still building. I mean, we're still creating, and we're still coming up with innovative concepts and tooling in order to further facilitate and promote the benefits that obviously cryptocurrencies and blockchain technology provide. And Changely has been a forefront company in providing the growth for the ecosystem. We have both a B2C market with Changely.com, as well as we have a B2B offering with our API, to where we power most of the large wallets in the space for their swaps. So, our partners include Exodus Wallet, Coinme, BRD, My Ether Wallet, and the list goes on from there. And we're very excited with our our partner network, which is now 40 plus partners, and being able to provide those partners and their customers the ability to exchange and swap digital assets and help them provide with that functionality has been a phenomenal feat for us, and continues to help grow the business model. And recently we've just launched Changely Pro, which is our first foray, as you can say, into the custodial space. So we're really excited about that product. We've been working on it for about 2 years now. And if you want to check it out, then please go to pro.changely.com.
Awesome. Thanks so much. So as we get into the meat of this here, I'm really interested to hear all of your opinions on just this concept. So I know the numbers say hodling is probably one of the best strategies given Bitcoin's performance. I mean, it's like one of the best performing assets of all time. But given that, do you think those golden opportunity days are gone of getting in early? If someone buys Bitcoin today and holds for the next few years, will the gains really outperform the average trader? Sunayna, do you want to weigh in on that first?
Yeah, I think, one of the things that fascinates me about Bitcoin is that in its decade plus of existence, the number of narratives that have been ascribed to it, right? Everything from it's digital gold, it's uncorrelated, it's a safe haven asset, and it's a payments network. And I think in a way, Bitcoin has become our Rorschach test, and we all see in it the value, the opportunity, or the downside that we want to see in it, right? And I would say, given recent macro events and the first part of 2020 has actually stress tested a lot of those narratives ascribed to Bitcoin, right? And it's punctured some of those narratives, right? When a lot of the thesis behind for many investors or traders, but getting into Bitcoin was it's digital gold, it's uncorrelated, I want asset allocation diversification, and suddenly, Bitcoin is moving in tandem with traditional markets. Everyone, of course, we start to get a lot of shade about, oh, what happened to Bitcoin's value proposition, right? And, my retort was, A, this is the first time, you know, Bitcoin has led its existence in a complete bull market, right? Starting in, you know, since its genesis. So this was the first time it was really being stress tested, and it was only fair that some of those narratives would be punctured and, you know, we would have to retest, right? Now, I like to remind those same people with the data from the last few days where it is acting as an uncorrelated asset and more, you know, in tandem with gold versus the S&P. And I share that because I think there's a lot of noise in the system, and it's also early days. I mean, you know, gold has existed for hundreds and hundreds of years, and during the, you know, the meltdown in March, it was, you know, in tandem with the traditional stock market, right? But nobody's questioning that gold still maintains its virtue as, you know, a safe haven asset. So I think some of it is just where we are in the timeline. And if the existence of Bitcoin. And I think the second thing is just, you know, it's an asset class that's new and it continues to mature. You know, if you paid attention to what was happening in traditional capital markets in March, there was a rhetoric that, you know, the markets were behaving like, you know, toddlers throwing tantrum, you know, waiting for the Fed for its next injection of the money printer go burr. And, you know, I started thinking about how's Bitcoin acting? And in a way, Bitcoin was acting like an awkward teenager. It didn't know what it was wanted to be. Some days it was correlated, other days it was uncorrelated. So I think there's an element of, there's still a lot of noise and, you know, a lot of panacea that's attached to Bitcoin. And there's a level of maturity it has to attain. So for folks who are thinking, I mean, again, I want to be very, you know, clear. I can make my compliance and legal people happy. Nothing I'm giving here is investment advice. But, you know, I think for folks contemplating, do I get in now? Is it worth it or not? You know, you could have asked yourself that question, you know, on Black Thursday, you know, not so long ago, just a few months ago. And, you know, what I think the last data is read is, you know, Bitcoin's been one of the best performing assets of, you know, 2020, 50% up. So, you know, so I think I worry less about the timing. And, you know, when people ask me the question, I ask them, what exactly is your goal, right? What are you trying to achieve by, you know, engaging with this asset class? And really, I think that ought to, you know, direct their investment thesis. And from there, they can double click into, do I want to actively trade it? Do I want to be a hodler? But I think it has to start with that quintessential, what is the problem I'm trying to solve for myself or for my institution if I'm looking at Bitcoin?
Awesome. Yeah, that makes a lot of sense. Part of the reason I asked that was just because, I mean, if you got in super early, like, I mean, you have all been in the industry for a long time. If you got in really early, the gain potential is quite a bit. But now if you pull a 10x, you're only going to hit kind of a 100,000.
It's still early, man. It's still early.
Totally, I agree.
I think if you, it's like this conversation, you know, I've seen it played out many times over the different highs and lows. And I think we're just in another one of those, right? I've seen people, you know, it was like $1 to $10 and a load of people got in at $10 and then it crashed down and they're like, oh my God, this is a disaster. It's never going to get to $10 again. I've missed out. There's no more opportunity for me, right? And then it went to $100. And then all those people at $10 who kind of held strong, they're like, oh my God, that's actually now pretty life-changing for me. But then there are a ton of other people, actually, 100, it's ridiculous now. It's never going to get higher than that. Like, there's no more upside here. And I think it's just actually that psychological effect of just each time you push through a new boundary, you have to kind of reset your the way you think about the asset, right? So from my perspective, I think we're just in another one of those cycles. You've got this kind of all-time high, which is people's psychological barrier. Let's see if that gets broken, because if it does, again, it's that kind of thing of like, what happens now? And every other previous time, it kind of breaks a new barrier and everyone kind of resets, you know, what is good and what is not. I mean, I remember even, you know, 2018, people were like, oh, it's a disaster. Bitcoin has fallen below $5,000. And I'm like, come on, that is insane that it is still this high. You know, it wasn't like 12 months ago, we were amazed that it was above $800. So I think in terms of, yeah, the question was, can hodling still work and is there still upside? I think if you believe in the long-term fundamentals of the asset, the fact that it's a scarce asset, the fact that the opportunity to build a lot of tools and services kind of mirrors what was happening in the internet in the early days, and the stuff that we can't even imagine in 5 years from now that can get built. Yeah, there's big upside. And yeah, hodling, it's not that exciting, but for me, it can definitely still be a very successful strategy.
I don't know about you guys, but I don't have time to trade my assets. Like, hodling for me is like a no-brainer. It's one of the easiest things. Like, keep it secure, don't look at it, don't even think about it, and just check back on it in like 2 or 3 years. And every 2 or 3 years now for the past 10 years or 8 years or whatever it's been, I've been like, okay, all right, not bad. So like hodling is like, if with everything else going on and trying to build usable technology in this ecosystem for users and partners, I just don't have time to trade. I mean, I'd love to. I'd absolutely love to. But at the end of the day, providing the tools and services, I think for us and for me, myself, especially with all the previous companies that I've started in this community, has been the priority, is just to provide usable technology in order to kind of create this beautiful, innovative ecosystem. And the thing is, like, we're just scratching the surface. That's the exciting thing. We're just scratching that iceberg, and we when we break through and when we see all of what we can do with this technology and with the assets that are created using this technology, it's just going to blow everyone's mind and bring the world closer together. And it's basically, we're in this transitional state right now to where the whole model of what we know, of what we're comfortable with, of what we think right, is just being flipped upside down on its head. And that process is quite enjoyable to see.
Yeah, I wanted to actually build on 3 different points. Each of you made a really valid point that I always try to emphasize to people. So Eric, in your case, you were mentioning about the stress factor that comes with trying to trade in markets and the time consumption. I always bring up to people, one thing that they don't consider is that even if you can master the markets, if you're a part of the 5 or 10% or maybe even less percentage of people who actually do make money trading actively on a daily or short-term time frame, the points I always bring up to them is that maybe you made money, but check what you would have done if you would have just simply held the asset. And if you're not outpacing it, then don't trade. And the second thing too is, was it worth all that stress and time you put into it? Were you able to really time the market well? And most people tend not to be able to. Edward, you brought up a really good point about kind of like the new goalposts being set. A lot of people were actually commenting the other day as I was saying the target for the end of this year would be 20K. They're like, Nick, is that when you're going to sell? And I was like, no, that's when we revisit those cycle highs, that's when everyone starts to get interested. That was the time I got interested in 2016. Was when we came back up to 1100. I remember watching the Silk Road, watching Mt. Gox, and then finally seeing it get back up there. I'm like, okay, this thing's resilient. I need to understand what it is. And that was what, as a macro trader, I finally actually read into what Bitcoin was about. And Sunayna, as well, you also brought up a really good point as well about, people constantly over the last few months, as things have been really volatile again, or well, they were previously volatile back in March and kind of the first and second quarter of the year. The constant point that I kept hearing from people is that, oh, it's correlated to the S&P 500 and now it's more correlated to gold. That time horizon is not going to give you the true visual of what Bitcoin is. In fact, if, as you mentioned, you just take a look over the last decade, Bitcoin's been its own monster. It really is its own uncorrelated asset. Nothing has had the kind of parabolic returns that Bitcoin has had. And this kind of constant cyclical process formulated around a monetary schedule like the halving event that Bitcoin has every 4 years. It really just brings in something entirely new. We've never had a mainstream liquid asset that's finite in supply. Now, just to kind of, again, maybe to mix things up a bit here, because I know it sounds like from all of us, I know BJ is probably interested in this as well. We all kind of take a kin to the idea of hodling. I think hodling has proven itself very well. And even though the returns this time around are going to be probably much smaller than the previous cycle, which was 100x from the bottom, I think that at the same time, my target's $100,000. I think that's great. I think there is still value and the opportunity of trading. And that more comes in the format of swing trading, because the longer your time horizon is, the more likely you are to generally profit in a market that has historically gone up. And then outside of that as well, just hodling Bitcoin really limits yourself from diversity. So I'm really interested, in what's going on in the decentralized finance space, what's going on in enterprise blockchains like Ethereum, and just really seeing kind of a new competitive front come up outside of just Bitcoin. So I think that, again, that's maybe somewhere we could dive into. BJ, I don't know if you wanted to explore that, kind of dabbling into altcoins and cycling in and out, riding the waves of excitement. And yes, definitely speculation at the end of the day. There's a lot of it.
Yeah, yeah, definitely. We'll touch on that. One question I had still on this, sort of writing this topic though, is, I mean, at what point do you sell your long-term hold positions or portions of them? What do you sell those assets into, given the current economic situation and everybody's talking about inflation? Weighing all of that together, if you just held Bitcoin, if you bought in around 7,000 and you held it for the last 2-3 years, you would have missed out on a lot of major swings between, I mean, anywhere between 3,800 and 14,000. And you're just sitting there for 2 years. Well, I mean, you're missing out on profits. And then, like I said, when you do sell some of your position, alternatively, like when do you take profits and what do you take them into? Because again, the dollar, if the dollar isn't the safe haven it used to be that everybody is going to, I mean, I don't know if you want to weigh in on that. Eric, you want to go first?
Yeah, I mean, you know, look, the swings definitely, if you're hodling, it's like unfortunate, and you know, you can think and play with your mind and play those games all day long, you know, as much as you can. And I think it's also a bit of a situation where there's not, you know, back in 2017, 18, during those swing periods, there just wasn't enough knowledge in terms of like other businesses to use that can manage your portfolio and trade for you, or, you know, there wasn't a lot of options and educational material as much as there is now. I mean, just in the past year and a half alone has been an explosion in terms of being able to provide materials and knowledge base to people to obviously understand about this market and so, you know, obviously, you know, I'm one of those people that play mental mind games a lot. Being a poker player, you know, and all that, mental sport is obviously, you know, very interesting for me. So unfortunately, but fortunately, you know, obviously allowed me to build some great businesses and provide some phenomenal services to a growing customer base. But at the same time, I didn't catch those swings and wasn't really in a position myself to do that. And did I think about it and, you know, kick myself in the ass as a result? Yes, of course. But at the end of the day, like, it is what it is. And as they say in traditional finance, money is a circle and it goes around and around and around and around. And so is Bitcoin. I mean, it's more than money, as we know. But one of the applications and one of the most important applications is money. And it will come and go. It will go around and round. And the interesting thing with money, as you all know, is this has been a problem that we have been trying to solve. Revolut's done a great job, but I'm talking about pre-Revolut now. We have been trying to solve this problem with money for 2,000 plus years, right? So this Bitcoin that comes around and just changes every aspect of our knowledge around money and how it can act and how it functions is phenomenal. And it's we should never forget that. And the whole principle around why Bitcoin began and how it affects the global economy is really empowering, and we should really not lose sight of that. And I mention that because obviously trading and hodling and, you know, doing all these things to make a small fortune is exciting, but understanding the true innovation and the power around what Bitcoin does is motivating and really special. And we should always remember, as CEOs, entrepreneurs, visionaries, and leaders in this space, that we should always be highlighting that and really providing services to bring in new users and traders and media support and everybody that we can to really start moving that mass adoption forward. That's what's most important right now, you know.
Beautifully said, Eric. Beautifully said.
Sunayna, you want to weigh in on that?
Yeah, for sure. I think the question about, you know, do I take profits and do I, you know, diversify my allocation, you know, it's not dissimilar to the dialogue that we're having on the traditional capital markets, right? You know, there's no surprise that FANG stocks seem to have no limits these days. And, you know, a lot of clients and, you know, investors and traders are asking the same question. Do I get out of technology? But where do I put the money? Like, there's so much cash, you know, in the world today, sloshing around, looking for a home. So, you know, I think, you know, one of my favorite things to read every day is Money Stuff by Matt Levine from Bloomberg. I don't know if you guys read him, but he made a really, as he tends to do, witty remark a few years ago where he said, Bitcoiners are simply relearning the lessons of financial history, but just at a much more accelerated pace. And and that quote resonates with me, that as different as digital assets markets are, there's a lot we can actually learn and glean from traditional markets and take the best of it. And this is one of those scenarios, and kudos to you guys for picking the timing of this summit to line up so nicely with the recent rally we're seeing with Bitcoin. I mean, what other superpowers do you have, right? So, as I watch the current rally of Bitcoin, but also we're seeing it in Ethereum, and, happy 5th anniversary to Ethereum today, one of the things I'm paying attention to is, it's great to see this price action. It's great to see the volume kind of come back. But what's driving it, right? Is it FOMO driven? Is it all this excess cash that people just want a place for it to go? Is it narrative driven? Or is it driven by, those foreign fundamentals that are necessary for the ongoing growth? And one of the things that, comforts me is, as I talk to our own clients or just, people I know, is this is, again, becoming a catalyst for new market participants to enter this ecosystem, right? Sometimes you need these, momentum-driven markets to maybe get those folks who've been on the sideline and maybe dabbled in digital assets, but now are more committed to it, or people who've been sitting on the sidelines and are like, don't know when to get in, and this might become the catalyst. So for me, the demand that we're seeing from our clients, be it active traders, be it long-term investors, but also our RIA community, in terms of their appetite for wanting to learn about this asset class and wanting to access and engage with it, I would say is at an all-time high, which is really good to see. And I think it's healthy for the growth and sustainability of the ecosystem.
Awesome. And so Ed, I'm gonna alter this question a little bit, and then Nicholas, you can come in after Ed. I'm gonna include altcoins in this. So let's go back to, at what point do you sell your long-term hold positions in Bitcoin or other, include all assets, and then how do you manage that and when to exit that in cash? So we're talking about Bitcoin and altcoins.
Yeah, so it's a great question. And I think you need to decide the answer to this question before you trade, right? Your biggest enemy is your mind. Certainly in traditional trading, there's this famous saying, it's 90, 90, 90, right? 90% of retail traders lose 90% of their margin within 90 days. It's not because they're not talented. It's not because they're not intelligent. It is literally because we are hardwired, our brains, unless you coach yourself and train yourself, you're hardwired to pretty much do the wrong thing at the wrong time. Okay. So if you actually have a strategy and you decide what you're going to do and just follow those rules, that can, to a certain extent, set you up for success. And it means that when all the emotions are flying, you just literally follow your playbook. And so what I would, the kind of strategy I would do is, okay, we know hodling works, so that should be a part of my strategy. But you're right, you're going to miss out on some gains, and there's some great stuff you can do with string trading and stuff like that. So I would kind of then apportion, I've got this block of crypto, and I would apportion some. It's like, okay, here's the really long-term hodl position. So when do I sell that? And I would then have a set of rules for when I sell it. And it might be, for the really long-term one, I'm just going to hold it until we go past the previous all-time high. And then I've got some kind of model where I kind of think that I'm not going to try and pick the top of the market, because it'll be very difficult to sell there. But I'm going to basically pick some number where I'm going to be really happy to sell half that position. And I'd always recommend just keeping some, because even with that bigger position, if you always keep some, if you get it wrong, the emotion is less, it's less painful, and it's less likely that you're going to do the wrong thing. So you sell half, it's called top slicing, right? You just take some off the table, you lock in that profit, and then you need a strategy for that profit as well. So as we were saying, what do you do with that? So in that really long-term thing, I wouldn't be going to altcoins or anything like that. You go back to dollars, and then you have a strategy for getting back in. It's like, I am now going to hold this until the retrace, maybe it's long, it's like a year. We go back to the previous all-time high plus, 15%, right? So it's very, very long term. And then you've got your kind of okay, hodling, and then I've got hodling plus. And then if you want to go hodling plus, then you go, okay, my time horizon now comes down to this. I'm going to take a much smaller chunk of those assets, and I'm going to be willing to trade. So again, you're helping yourself because you've got these long-term assets that you don't need to make a decision on until you kind of like, it's that 4-yearly cycle when you're blasting past the all-time highs and stuff. So that's just sat there, and you're going to have less FOMO, right? Because you're like, that is making me money, or like whatever. I don't have to think about it. I don't have to make a decision. Now I've got this smaller set of chunk that I'm going to start to trade on. And then again, you start to just like build a strategy, right? So you can say, okay, I'm going to now try and look at like the kind of like 3-month time period. Where was the last high? Where was the last low? Start to try to do some swing trading. And you can look at other assets. You can see like what kind of altcoins are undervalued. Build a strategy, make the rules. But the fundamental, like the one thing that you need to do is make the rules before you've got any skin in the game, and then just follow the rules. Don't mess it up. You've got to follow the rules. And like a great piece of advice that a traditional trader told me, like very successful traditional financial markets, they keep a trading diary, right? Trading diary, you write down your decisions, and it forces you to confront mistakes and learn from them, and so you can iteratively get better. It's like it's kind of like calorie counting. If you force yourself to type in the calories like that you're eating into an app, you're going to lose weight, right? You need to like prevent yourself from making mistakes by doing this trading diary and then reviewing it. Okay, I messed up here. What was my decision? What did I do wrong? And then you can get better. And then yeah, so I would say those are the two things. Like take a different time horizon for different parts of your like crypto holdings. So you got the really long-term one. I would use some kind of strategy with all-time high plus, and then do a top slice. And then I would like bring the time horizon in, take a smaller amount, and you'll be willing to trade with that. And you can then take a smaller amount. So the smaller and smaller amounts, you can bring in the time horizon shorter and shorter, because it's more likely that you'll lose money until you get better, until you train yourself. But always having that kind of big long-term hold there with a set of rules behind it will give you less FOMO, and it will set you up for success with the other trades that you're doing. I guess in a nutshell, it's hodling plus.
Yeah. That was fantastic. Before we get to you, Nicholas, I just want to ask the audience, if you want to post in the chat when you first bought crypto and whether you started trading immediately or hodling, and if there's anyone who still has Bitcoin after buying it 10 years ago, 8 years ago, post it in the chat. Also, post questions and we'll get to those when we can. Nicholas, sorry, go ahead.
No worries, man. No, I think it's awesome, BJ and stuff. Yeah, definitely want to hear from the community on this one. Just to build on what you were saying, Ed, I agree with the 2 points you brought up. Not only obviously setting like take profit levels in this case, basically, and where you want to start taking some of your positions. And this, along with that, as you mentioned, planning what your time frame is on this kind of hodl. I think, as you mentioned, BJ, the term hodl is or holding long term or hodling, whatever you want to call it, is can be very subjective. Long term can be completely subjective as to what the user is looking forward to do. Are they looking to make money over the next few months? Are they looking to hold this for the long term as a part of their diversified portfolio? But in regards to just kind of like what I can share and my mentality of observing this market from a data science perspective, taking a look at it and kind of observing price action like I would normally in other traditional markets, I take a step back. And when I think of the term hodling, I think about looking at the long-term cycle and thinking about how can the average Joe accelerate their kind of returns from this cycle rather than just holding long-term. And this is the first step I would say to take. If someone, again, I can't provide direct financial advice, as Sunayna said as well. Yeah, we can never give direct financial advice.
This is all personal experience.
Yeah, exactly. Yeah. So this is basically, if people want to know clean cut how I'm approaching it, this is how I'm going about it. So I look at the long-term BLX chart. BLX is an aggregate indicator by a company called Brave New Coin. They created a Bitcoin index that shows you a very long-term horizon for Bitcoin's price, all the way back since late 2010. So some of the most accurate price data we have to work with. We can see here that Bitcoin goes through these very cyclical processes. It has these very exponential returns. The important takeaway that people don't focus on, though, is how long those cycles are. So it tends to be that Bitcoin, every time it has a new cycle from going from bottom to top, it's an 11 to 13 month expansion on the previous length of the last cycle. So the first one was 11 months. After that, you basically added another 11 to 13 months. You can rough it off basically to a year added each time. So each cycle adds about 12 months on average in this case. So if we take the last previous cycle, we add an additional 12 months, we get a top out date around November of 2022. You've been hearing probably a lot of people say that the top is going to be in 2021. And, again, I'd love to talk to you guys about that as well. But I guess just kind of sticking tuned to this thesis, it's about focusing on the major cycle here, right? If you're not just going to hodl, the first thing to focus on is trying to understand when generally the bottom's going to come in so you can re-enter in and then ride in that crazy wave when it gets towards the parabolic highs. Now, when do you know when the bottom is in and also when the top is in? For the bottom, I generally look for about an 80% retracement. Historically speaking, if you look at that long-term chart, you don't need to overcomplicate it. You can see that generally you get about an 80% correction with each cycle from top to bottom. And then the second thing is, where do you find the tops? The tops are a bit difficult to spot, I think, for some people for their first go around. But it's when you go from, for example, in the last cycle, levels like $10,000 per Bitcoin within a matter of 2 weeks up towards 20,000. And you really start to understand that the market has scaled up towards exponential levels. These are usually double-digit returns from the bottom. So a 20x, a 30x. These are the kind of levels I start to get a little bit wary and concerned. And I not only, as Edward mentioned, basically consider not only having some take profit levels way in advance, but also you can use what's known as a stop limit, basically raising a sell order that will get triggered if the price comes down and hits that level. So these are some protective measures you can have. But a very simple way to protect yourself is if your grandma is talking about Bitcoin, then it's time to probably get out of it.
Yeah, you hit on the golden question that everybody always asks is how do you know the bottom and how do you know the top? But I mean, a lot of times you're almost never are you gonna pick the exact top or the exact bottom. But if you can carve out some level of profit in between and make good decisions, then I would say that's probably what it's all about.
Yeah, to build on that, one last final point is when you're taking into account picking that bottom and top, if we understand that Bitcoin usually has these massive corrections where like a good chunk of its gains, in this case, 80% historically speaking, the number one goal is just to make sure that you generally pick the range of the top. You don't need to get the exact top and never go back on a trade. Like if you are confident that the high has been set in and there's no justifiable reason to enter back in, again, stick to your trade, wait periodically. It's going to take some time. But eventually, wait about 1.5 years to 2 years to 3 years, however long it takes to get down to that 70%, 80% bottom. And presto, whether you've picked the exact bottom or not, you've picked it at a consolidated corrective range where you can likely assume that you've gotten a better steal in this case and you've increased your Bitcoin position. That's the key goal. If your long-term strategy is just to own and acquire Bitcoin in that case as a long-term investment.
For sure. Eric, coming to you here, I just want to ask, a lot of people are in our industry are talking about like a complete financial revamp and seeing Bitcoin as the ultimate new gold, new safe haven asset, all of the above. And what I'm wondering is like, when does that happen? And at what point do you start keeping permanent amounts of, and of course this is based on you personally, what point do you start keeping Bitcoin permanently and money permanently in Bitcoin as soon
as Revolut supports it?
Thanks, man.
I mean, that would be like a dream come true for someone like me, being in the UK and knowing that product like the back of my hand. And using it since the beginning. I mean, my first office we launched the first government blockchain platform called Credits years and years and years ago in 2014. And I remember, Nikolai and gang starting Revolut, and we had offices next to each other in level 39. And, what they've been able to create and do for financial service has been phenomenal. And they are the precedent and the authority on, innovation and being able to bridge what is this Bitcoin and crypto market together with traditional finance. And it's really been nice to see. And, my hats goes off, being in payments for so long, my hats goes off to Edward and team for achieving that and understanding what they've all gone through for that to take place is just, wow, it's a big deal. And so as far as, when I'm looking at things, that's a good indicator as to where we're going and how, even with the announcement recently in the States, I might sound like an American, but I am British. I like having my American accent because it allows me to do more work. But at the end of the day, like what the announcement that they had in the States recently, that all banks are now able to hold custody of crypto assets. I mean, that's huge. No one's talking about that. I mean, that's what this pump is about, right? I mean, that is what people are really excited for. And, you know, I think that indicator right there is the fact that, you know what, like Bitcoin is not meant to be stopped. Bitcoin and I mean, there are other crypto assets. I don't want to get into it on this call. If you want to talk about altcoins, I could do it all day long. That's what we do. But, you know, with Bitcoin specifically, it's been designed by its very nature to not be stopped, to not be prevented. And you can apply regulatory measures and different things to Bitcoin, but overall, it will always find a way. And what we're seeing is the resilience that Bitcoin has. And we're only getting a small sample of that resilience right now. Because when it comes down to brass knuckles, and in the next 2, 3 years, 4 years, whatever, what we're talking about now is going to be such small potatoes, like complete, like an amoeba, like this, like we're right now, we're the size of an amoeba in terms of the actual real financial ecosystem. If everybody here doesn't know what an amoeba is, it's smaller than a flea, right? So right now we're this like amoeba that's been formed like a microorganism, you know, for the past decade or so, and we haven't even grown into a flea, let alone a bee or a beetle or like a bigger animal. Like, you know, this beast is going to be huge. And if you just wrap your brain around that for 1 second, like we're just at the beginning of this amazing adoption curve. And I'm really excited to be a part of this. I mean, you can hear it in my previous talks I've done. And, you know, I've always been a visionary, and I've always been a fan of technology and, you know, providing a better experience within the financial services sector. And Bitcoin and crypto assets and blockchain overall just allows me to create an experience that I know.
Awesome. Sunayna, let me consolidate that question a little bit for you. So basically, when are you looking to hold Bitcoin like permanently as a sort of gold? Like what factors are you looking for, and when are you looking to do that? Because it's still highly speculative versus, you know, a store value.
I mean, I might, you know, gently kind of push back and say I think it's always been a good time to, you know, hodl Bitcoin, and you know, I do ascribe to the narrative of, you know, digital gold, and, you know, to the point made earlier, I don't know if it's a good or bad signal that my mom's all into Bitcoin now that I've explained to her how it compares to gold, and she's Indian, she understands gold, so now she wants digital gold. So I don't know if that's a good or bad signal, Nicholas, for you, but, you know, there you have it. But, you know, so I think again, if I look at it through the lens of the clients that we serve, that are traders, retail investors, and the RIA community, you know, I think for, you know, where maybe the early market participants into digital assets and Bitcoin that came in were perhaps driven by ideology or were more technically savvy. And, you know, we all said we got in 2012, 2013, and we were willing to jump through our fair share of hoops to test and learn, you know, this new asset class and technology, not knowing, you know, what, you know, like people, like you, the earlier question you asked is, you know, is it worth getting in today if my return is 10x versus 100x? You know, what I would say is, you know, the folks who got in early, all the power to them. They deserve that 100x, if nothing for all the, you know, probably abuse they took from their friends and family who were like, Bitcoin, what are you doing with your money? What's wrong with you? Just for that emotional, you know, roller coaster they went through, they deserve those returns, hopefully, if they hodled. But I think when I look at our clients, yes, you know, one of the things we did about a year ago is on all of our platforms, and, you know, we have millions and millions of clients who use our platforms every day. We said, let's gauge kind of where our clients are on this, you know, on this spectrum, right? Are they crypto savvy? Are they crypto curious? Or are they just straight up crypto skeptics, right? Let's get some, you know, and we cater to clients every day and we have direct interaction with them. So the voice of the client is the best gauge. And, I said, so let's put it on platforms and just say, do you trade crypto? Do you want to learn about crypto? Would you trade crypto? And I said, listen, if 100 people answer it, great. It'll further solidify our business case, to the board and our constituents, and we'll take all the tailwind we can get. And what's fascinating, BJ, is thousands and thousands and thousands of responses every day. And I would say that persistent, consistent demand from our clients has been the biggest reason that's kind of driving our entry into this ecosystem. It's kind of sad that even in 2020 on Wall Street, the notion, it's a contrarian notion to say we love blockchain, but we also love Bitcoin. People still try to separate those two, which I never understood and don't think I will ever understand. So for us, a lot of this entry is predicated on client demand. And when we talk to clients about what's driving that demand, it kind of ranges that spectrum, right? I think, again, it goes back to points that others have made is ultimately we're serving clients who have a finite amount of investable assets. And when they come to our platform, they are investing that money to meet certain goals that are important to them, right? Our job, and has been for the last 40 years, is how do we kind of democratize investing, and that notion of kind of bringing Wall Street to Main Street by giving everyday consumers access to the same technology and information and data that otherwise would only, be at the hands of the institutional investors. So when we think about digital assets and, when is the right time to hodl or trade, for us, it's the same mental model, which is when you come to our platform, my mission really is, my team and I, what we're striving towards is when you log onto our platform, you have a finite amount of investable assets and you have a goal for that money. On one end is your fiat portfolio and all the different instruments and on-ramps through which you can engage with capital market. And what we want to do is present to you an analogous crypto, marketplace that has all those same on-ramps and instruments, right? So maybe you want to buy and hodl, but today you can hodl, but then also engage with crypto markets with options and futures that didn't exist just a few years ago, right? So for us, the more choices you can offer that end investor, the healthier it is for the ecosystem, but it's also in the best interests of the end client, because at the end of the day, I'm not going to tell you what to do, when to do it, how to do it. My job is to make sure you have all those choices in front of you, complemented with all the credible education. And I think the other signal I really pay attention to in terms of the growth of this ecosystem and new market participants coming in is also just obviously regulatory clarity, which you touched on, but all the building that's happening. But more importantly, just think of the Cambrian explosion in terms of content and education. I remember, again, 2012, while I fell into this esoteric thing called Bitcoin, there wasn't really a lot of, I read the white paper, and again, I will confess I had to read it multiple times to fully understand it. I wasn't one of those people who read it and Eureka, the angels started singing to me. I had to do a lot of research to really kind of get around to understanding it, but there weren't a lot of resources. Today, I can barely keep up with all the podcasts and the newsletters. So I think that's a very strong signal about kind of the expansion of the marketplace, but also the diversity of market participants that are coming in with different goals and kind of, different ways to engage with it.
Awesome. Thanks so much. Nicholas, what you got?
Yeah, I wanted to build on some of the points you made, Sunayna. Basically, the education improvements has been awesome. Outside of that as well, there's something you mentioned earlier as you asked the question, BJ, which was basically, whether or not, it's just good to hold Bitcoin or basically even have it as a portion of your portfolio on a fundamental basis. And I think you're right. Not only once you kind of go through that white paper a few times, you start to understand the fundamental narrative, but also I was just actually checking at lookintobitcoin.com, which is like a public data science website for crypto. 97.7% of the days throughout Bitcoin's history, all the way back since its inception, if you bought Bitcoin on a public market, you're up on your money. So 97.7% of the history. The only two periods where it's highlighted in the red where you've actually taken a loss is between basically a 3 or 4 week period during the hype of 2017 towards December, and in a small period back in around in June of 2019. So talking about this, honestly, on a data basis, on a fundamental basis, Bitcoin obviously kind of provides a clear picture in the sense of whether or not you should hold it as an asset, maybe long-term. During the bear market, for example, I held a little bit of Bitcoin, even though I took a big partial share of profits out of altcoins. I still held some Bitcoin. The one thing though that I want to emphasize here, I think to your question, BJ, just kind of to twist it a little bit, is, you know, as many of us here, right, who are on this call and stuff, we're probably in crypto right now. The question that I think many people are very curious about that kind of fits in this category is, when is it going to be that institutions treat it like everyone needs to have that 1 to 3% exposure? And if you count pension funds, you know, it's a multi-trillion-dollar market. US, from last time I checked, it was $42 trillion back in around 2018, 2019 when I was talking about this data point, but probably around 50 trillion now with the equity markets and how they've been. But let's say, for example, right, 40, $50 trillion. If you tackle 1% of that, that's $400 billion right there of buy-side potential for Bitcoin to go up as an asset. That's huge. That's massive amounts of liquidity, more than we've ever seen before. And as Sunayna basically mentioned as well, you've got all these different types of financial products that are coming out that are going to make that easier. But keeping that in mind, what's that point where you're going to start to see that liquidity inflow? And it's really going to be at 20,000. The reason I say this is it's the perspective I've learned from it myself. And I know many other people who are in the same exact shoes where they followed Bitcoin. The first time I heard about it was in 2011. I never read the white paper. I thought it was a big scam. I was a big libertarian at the time. And I was like, these guys are playing on me. They're playing a trick. They want me to spend money on it. And who would spend $3? And the first time I saw it was on Bitstamp when it was $3. I thought, who in the right mind would pay for some digital token scam? This doesn't make sense. But when I finally understood it, you know, in 2016, when we got back towards around 1100, that was the market incentive for me to go, okay, I need to look into this. All the hedge fund managers, all the pension fund managers, all traditional finance as a whole, when they see that we got back up to that crazy number of 20K that everyone thought was just a mere bubble, you expand to a larger and larger base. And again, I don't mean to build too much, but today, again, another point you brought up earlier about basically these waves are cycles of adoption. We went from practically no one owning crypto to about a little less than 1% of the world owning crypto in the previous cycle. This time around, we're probably going to do another 10x on adoption. So we'll probably go up towards around 8 to 10%. And then after that, we go up towards 20, 30, 40, 50%. And inevitably, it's like all technologies. The internet goes through, you know, went through an S curve. We're going to see multiple cycles for not only traditional technologies, but for crypto as well as an asset class. So, you know, I think we're seeing with gold and equities as well. But, you know, again, there's these market cycles that happen over time. And I think, again, every time you break up to new all-time highs, it sets the new goalpost, as I was talking about with one of Ed's points earlier.
Awesome. We need to wrap up really quick here. Thank you so much, everyone, for coming on. It was a pleasure chatting with all of you and so much great insight. Again, thank you so much. And thanks so much, audience, for listening in. Make sure you catch the next one on derivatives and leverage trading.
Thanks,
right, see you guys.
Nice seeing you.
Bye.
Take care,
See you
everyone.
later.
Hey everyone, and welcome to another panel as part of Cointelegraph Crypto Traders Live. My name is BJ Pirus, Cointelegraph reporter, trader, and host of the Crypto Secrets of the Trade podcast. During this segment, we'll hit on the topic of leverage trading and derivatives trading. At its simplest, leverage trading essentially means borrowing exchange money to make trades on a per trade basis, while derivatives include products built on assets such as Bitcoin that trigger profits or losses based on certain parameters. Leverage trading and derivatives trading has exploded in the crypto space in recent years, with a number of crypto exchanges offering futures and options trading for various crypto assets, while mainstream giants like CME and Bakkt have also entered the space with Bitcoin derivatives. To chat on the subject, we've got Dan Gunsberg, co-founder at Hero, a gamified crypto trading and derivatives platform. Clark Reed, head of trading at Switzerland-based global digital asset trading platform Shapeshift. Paul Eisma, head of trading at New York-based crypto finance company XBTO. And Joshua Lim, head of derivatives at New York-based mainstream brokerage firm Genesis Global Trading. Hey everyone, thanks so much for coming on the event. Let's jump right in here. I know you all come from pretty sizable mainstream financial backgrounds. Can you just give the audience a briefly overview on some of your past work and lead into what your thoughts were when you entered crypto derivatives trading when you came into the industry? Dan, let's start with you.
Sure. So yeah, Dan Gunsberg, CEO and co-founder of Hero. I've been involved in derivatives markets since I started on the floor of the Chicago Board of Trade in 1998, actually, and started my career then and have been at it pretty much ever since. I first got into crypto. I was a principal and chief operating officer of a proprietary trading firm here in Chicago, and we started getting more involved in crypto in small size in like 2013, but then really more so in 2015, 2016. Eventually started a trading desk there, and 2017 I left to go into crypto full time. Actually, what led us to really create Hero was when I first really started trading on crypto derivatives markets. I was really noticing the kind of the nascency of them, and you know, if you really weren't a professional trader, the retail users of those platforms, you know, we were just watching the amount of rinsing that was going on kind of both ways. And a lot of it because, you know, really just that overall lack of liquidity relative to legacy markets. But, you know, my first instinct of it was that, you know, very early, very nascent, but very open for experimentation. I thought that the crossover, you know, from, you know, platforms like BitMEX and then kind of evolving into what you see today is a really good sign for kind of what's to come with it. And, you know, one of our goals is really to try to create more kind of retail friendly ways of interacting with the market and being able to express a view on derivatives that otherwise would be really esoteric, and allow kind of more of a smaller group of people to really capture edge from them and really understand them and really open it, but really take those and simplify them down, deliver them in a fair and transparent way, and really kind of try to open it up for the rest of the world. Oh, BJ, I think you're on mute.
Oh, sorry, thank you. Paul, do you want to just give a quick background and then how you saw crypto derivatives coming into crypto from mainstream?
Yeah, sure. So I actually originally started on the floor of the American Stock Exchange trading equity options as well. So I have a floor background, very similar to Dan. Moved upstairs, worked for 2 investment banks and a couple of funds, basically trading macro vols, so both vanilla and exotic. So you know, FX, rates, commodities, vol, which are essentially all the macro products. Got into by accident. The XBTO family invited me to join their team, and I can think about the derivatives market was like when I first joined within crypto, because it was not really one to speak of, to be honest. I mean, if you want to define derivatives from a linear or delta one perspective, sure, there were futures, The perp swap was, an interesting product. But, I think when I think of nonlinear, which is obviously options and structured products. So, we at XBTO have been involved on Deribit, both as liquidity providers and takers, and supporting their growth since almost the beginning. And let's just say, Deribit and the derivatives market and the options market has grown quite a bit, not only this year, but I'd say, in the past 12 to 16 months. Sorry, 12 to basically past a year to year and a half. We have a couple of onshore products, as well as CME product, the backed product, to complement the primary market, which is Deribit. And then you also have some really elegant solutions to trade and access these markets, such as Paradigm and X Margin, which is recently launched. So it's the infrastructure is better, the technology is in place, whether from an onshore or an offshore perspective. So I think 2020, regardless of how extraordinary this year has been, I always thought it was a very pivotal year for the options market and derivatives. And halfway through, we'll see how it plays out.
Great. Thanks so much, Paul. Before we get to Joshua, audience, I just want to make sure you guys are posting questions in the chat. I will try and get to those as quickly as possible. Joshua, can you weigh in with your experience in derivatives and crypto?
Yeah. Glad to be here on the panel with a couple of guys that I know pretty well. I work at Genesis. I am running the derivatives business here. My previous background outside of crypto was as a trader at a couple investment banks, doing sort of equity derivatives, and then more focused on the exotic side of things. So everything kind of in the OTC space. I got into crypto in 2014. I worked at a company called Circle way back in the day when it was sort of a big on-ramp for a lot of people to access cryptocurrencies. And then as part of that role where I was sort of helping source liquidity for the retail guys that were trading on the platform, really got plugged into the community to trade OTC with other dealers and other sort of suppliers of crypto, miners, corporates, all kinds of other guys out there. And so that's kind of how I got more deeply involved in, I'd say, like the institutional space for trading. And that's, in crypto, that's sort of a newer concept, the idea that, you have larger market participants that are more professional, that are more kind of savvy and actively involved trading larger sizes. And that's kind of how I ended up at Genesis. So Genesis has been in the space for a long time as more of an institutional provider of services. So Genesis kind of acts a lot like a sell-side firm. Like we, are focused on providing like high touch services to funds and to, corporates in the space, and really structuring or creating sort of customized solutions for them. So derivatives kind of fits into that picture. I think Genesis in the space is kind of pretty well known for being the largest lending book in the space. So we're already sort of working with a lot of market makers and funds and, long short guys to finance their books. And so, adding sort of this layer of derivatives, helping them to, whether it's sort of to express certain views to, in going into catalysts, things like that, or whether it's to generate yield or other things, is a pretty natural sort of outcome for the rest of our business lines. So yeah.
For sure. Thanks. Clark over there in the Wild West. You keen on the Wild West crypto theme there?
That's it. Nice to meet everyone. Thanks for having me. I share a similar macro trading background to the rest of the panelists here. I started my career at Lehman Brothers about 15 years ago and traded at a number of different banks in New York and Singapore over the years, mostly FX products, cash and derivatives, but some interest rates and commodity stuff as well. I joined Shapeshift about 2.5 years ago. Shapeshift is a retail platform. It's a gateway designed to make crypto self-custody and trading very easy and digestible for the kind of the average person. In that vein, we just recently launched a full-featured mobile app on Android and iOS. So we're really trying to be the gateway for retail users to institutional liquidity, like the liquidity that firms like XBTO and Genesis are offering to institutional partners.
Awesome, thank you. So let's dive right in here. Paul, heading back to you, just a simple question here. Do we need derivatives in the crypto market?
Yeah, sure. I think if you, look at the traditional asset classes, and if you look at the growth of how it's evolved over time, going from a spot market to then having a product such as a futures market or even an options market to not only speculating to hedge for commercials and for funds and for retail and for, have this one big liquidity pool, I think it can only help grow the space and be beneficial to everybody involved. It's particularly challenging, obviously, within the crypto space because of not only the volatility but just familiarity. People, I think, derivatives has a negative connotation. I think that may be a little bit naive, and I think just having an open mind and learning not only about crypto and this need, so to say, of derivatives within our market will help benefit and grow the market because you have treasuries, you have funds that have portfolios that need to naturally hedge risk. You have miners, as Josh was mentioning. You have all these different types of counterparties or clients, so to speak, that could benefit from learning and using derivatives within their portfolio.
Right, and it just, I feel personally, I think it just gives, more options to everybody involved. Clark, what do you think?
Yeah, this might be a lightning rod for any maximalists out there, but I kind of view this whole space as a transition from analog finance to digital finance. That's true whether we're talking about marginal changes like increased efficiency for financial product settlement. It's also true when you're talking about potential sweeping changes like untethering assets from any specific jurisdiction or even displacing the USD as the world's reserve currency. So we're still very early and things have moved very slowly in this space in particular due to the slow pace of financial regulation change. But ultimately, I think it's inevitable. It's analog to digital like every other industry.
I'll say one thing is that so many people in crypto think about derivatives for the most part as a way to speculate on up, down, on higher or lower, on price leveraged. And I think, the four of us on this panel all come from backgrounds where when you come from legacy markets, you don't necessarily always think about the front month. Like most of the products that you're trading have curves to them. And some, like, you've seen BitMEX start to put duration on, duration-based futures on their platform, or FTX is doing it. And, like a lot of my background was a little less about focusing on up, down, and a lot more focused on like trading slope or curvature or just different ways of looking at and isolating risks in legacy futures markets. And what that really creates ultimately is liquidity. Because when you have market makers or you have traders that are able to trade in futures markets or in derivatives, nonlinear or linear, and they have different liquidity touch points or different reasons for doing business, it just creates better price discovery and more volume. So I'm more of a proponent of the more touch points that can be created and the more creativity you can get around it, the deeper the liquidity ultimately is going to be, and getting true price discovery is going to be much more efficient for the market as a whole.
That makes sense. And playing on that, as you're saying, just developing a more well-rounded market and all of that. We have an audience question coming in. Do you guys think crypto will become the next stock market? Joshua, do you want to weigh in on that?
Next stock market. I guess there's two ways to answer that question. One is like, obviously we're all kind of watching like this sort of retail, like Robinhood driven equity rally going on that's sort of backstopped a little bit by Fed money. I think, I think eventually, right, like we're all kind of probably hoping that a lot of that money goes back into crypto in terms of like the speculative like fervor that retail is kind of participating in right now. I kind of think that, you're kind of seeing the beginning stages of that, right? Like we've had this sustained rally above 10K. We've broken out of this, like really the doldrums that we had like earlier in the summer where we were just stuck in this range between 9 and 10K. I think that's one answer that, certainly it's becoming that format. I'd say the other answer is that, you're already seeing sort of instruments evolve in the crypto world that are, analogs to like basically equity-like instruments, right? So you have a lot of these tokens, you have governance tokens that give people the right to vote on protocol changes. You have, tokens that give people, essentially rights to cash flows, via the buyback and burn mechanisms on exchange tokens and other things like that. So I guess both of those answers are yes, right? It's evolving to become more sophisticated and more interesting.
Paul, I'm going to add to that a little bit. When I first got into the space in 2017, I thought, wow, this looks like the next stock market to me. I saw all the assets and trading and everything, bringing in derivatives and all of that. Do you ever see, again, building on that audience question, do you ever see just a single marketplace that includes like blockchain-based stocks and equities and stuff matched with crypto all in one big market?
That's a really good question. I think over time, listen, Clark spoke about something really important, which is about regulation. And, fortunately, unfortunately, at least onshore, that's going to take time. So I think we could work potentially towards something like that in the future. But I think the very nature of crypto in general that involves, with the technology and coins and tokens and, transfers and, I think it will have that analogy to the equity markets. I think there will definitely be some attrition with, with so many liquidity pools worldwide where, I think over time, when I first got in the market, my principals were telling me it's like FX was like 30 years ago.
Yeah.
And, I didn't really know what what they meant by that. But then once I started trading it, seeing the fragmentation, seeing all the liquidity, I can see that. And you can see from traditional markets how it starts fragmented, matures, technology comes about, liquidity gets better, and then liquidity actually begins to aggregate. So I can see, these scores and scores of liquidity pools globally, worldwide, either, merging or, I guess if you're asking whether there's going to be some, main New York Stock Exchange or American Stock Exchange or like a NASDAQ that has, less than a handful, I think it may not be that small, but we're definitely going to have a decrease in the amount of liquidity pools in the future, just because, I think it's a natural attrition for any new and burgeoning market.
Dan, do you want to play on that at all?
Yeah. I think Paul really said it. My thought when I first got into crypto, I remember looking at like Bitcoin trading on like GDAX, for example, and thinking, God, this reminds me of like trading Cisco on Instinet and Island or something like that, and like during the internet boom bust. And so I definitely can see the parallels in terms of the evolution, but I really think crypto, the way that liquidity is kind of structured now, is very similar to FX. And also there's just more of this international kind of geographic crossover that you really get in the FX market, the 24/7 nature of it, the way liquidity pools work. There's a lot of upstream and downstream relationships between the same two counterparties. And it just has those really good basic building blocks. I see it evolving more in the same way that FX evolves more than equities. But it's not to say that the products that aren't created, who knows how STOs are going to evolve or security tokens, other types of tokens. There's just so much innovation, and it runs in crypto years. Like they're like dog years, and the most amazing thing about it is the speed at which everything is done. And it is just the tip of the spear for finance right now. And I think everyone just needs to step back and remember, like, it's just so damn early.
Yeah.
We're all frontiering still, and we're 10 plus years into it. So,
and I have heard that correlation quite a bit to Forex, and that leads me to my next question. How does leverage and derivatives trading impact the industry? And I'm saying that partly because I know charting, I've heard different theories on Forex charting. It can be difficult with stop hunts and stuff like that. And personally, I think, leverage and derivatives have to play some part in that. But all that being said, going back, how does this all affect crypto? Clark, if you want to weigh in on that.
Sure. Yeah, I think you have to kind of break it down to the baseline level of what are these derivatives products used for, right? And so naturally, with the development of crypto, it's been largely a retail phenomenon thus far. And so you can see that it's people who want to take 100-to-1 long shot on BitMEX, right? Versus if you look at traditional markets, there are all different types of use cases for various derivatives, whether it's hedging commodity mining flows, whether it's rebalancing equity portfolios, interest rates, credit, my background in FX. So I really think that as the marketplace continues to mature, you'll start to see more liquidity and more price transparency come up within crypto derivatives. But for now, liquidity is a big issue. And, the disparate kind of information sources for market data and what kind of margining rules are based on that. You end up with a lot of flash crash type situations, people getting delevered. We saw that back in March, obviously, with the big move happen. So it's just a function of the immaturity of the marketplace and the structure of what people are using these tools for at the moment, in my opinion.
For sure. Go ahead. Sorry.
I completely agree with that. But I also actually think that derivatives in the crypto market in particular has something very, particular to do with the way market structure has evolved in crypto, right? Which is that most of the exchanges in the early days and even now are fully funded exchanges that require you to pre-fund trading. So this is kind of a concept that's like very different than like other asset classes where you separate the idea of like custody from execution. So I think it's almost like a vital lubricant for the entire sort of marketplace in crypto that you have the ability to execute on leverage and get sort of get the size that you want without tying up a ton of collateral on exchange. I think that's like, the natural outcome of what's, how the market's evolved over the last couple of years. And I think maybe over time, if you see a lot more of these solutions available to institutional investors that allow you to sort of like improve your capital efficiency, whether it's like, leveraging assets held at a custodian as buying power on exchanges, things like that. Or this idea of like prime brokerages, right? Like you read like all these press releases, like every single company in crypto now is like trying to become a prime broker, including Genesis. But yeah, like that's like this idea, right? Like improving capital efficiency for your clients. That is fundamentally going to change how people interact with derivatives and probably start using derivatives more in the way that you would use in traditional markets to really like express views and to sort of like, exchange your time duration for various sort of like trades that you're putting on.
I think that's also going to massively improve overall liquidity as well, because like, what Josh is kind of referring to in the legacy market is that like if I have a position in crude oil futures, for example, on the CME, and I'm trading that against a position on ICE, like my bank may look at the position I have on ICE or on the CME and then lend me the capital to carry the position on ICE, for example. And so doing that in crypto, I think because of the nature of like everybody complained for so long that like, I have these two trades on, I have this basis trade on spot versus futures, and then I have to like move, 100 Bitcoin to this other exchange, and then the network's clogged, you have all these issues. So solving those issues, I think, are going to be so valuable to the, first to the more institutional clients, obviously, because those are kind of the guys that are going to have the most benefit from that initially. But over time, that does feed down to the rest of the world in that there's better liquidity, there's more efficiency around pricing. You're going to see less of these like instances where there's a complete vaporizing of liquidity, and suddenly Bitcoin's from 12,000 down to 6,000 for 30 seconds, and you're going to see a lot less of that over time because of the fact that capital in the system will be more efficient.
I want to catch this audience.
Yeah, just to, sorry, I didn't mean to jump in there. To just follow up on what Dan and Josh mentioned, I think it's a very important issue, right? There actually exists a software, an elegant software solution called X Margin that just launched. And it's basically, its goal is to basically disintermediate this central clearing and this capital multiple counterparty issue, right? It's essentially a zero margin calculator that enables derivatives trading across multiple counterparties. Settlement is automated, your capital is efficient, and meanwhile, you can maintain your assets at a custody you trust, for example, at a Fireblocks, right? So that if I have a trade on with Dan, and if I have a trade on with Josh, if I have a trade on with Clark, we can actually, all through the X Margin platform, be able to get margin relief so that we can free up that capital to then go put on more trades. So I think this issue that, Josh definitely mentioned and Dan spoke so eloquently about, actually there's a solution that just launched. It's called X Margin. If you go to xmargin.io, the CEO is Darshan Vaidya, and it's a very elegant solution. They partner with Fireblocks, and everybody on this panel is very familiar with the tech. But again, this is innovations that are coming within not only the crypto space, but this is something that can also be used in legacy markets. So this is again, it just went live honestly about a week to 10 days ago, and it's a really exciting product in the space.
I want to catch this quick audience question here. Chinese Checher wanted to know, with the recent rise in decentralized markets, what are your guys' long-term outlook on the balance of centralized versus decentralized derivatives trading? Clark, do you want to start off with that?
Sure. I mean, just my initial reaction has been the lack of transparency is really scary to me in a lot of this stuff. Decentralization as a virtue is fine, I guess. But when you think about people just tossing stablecoin or tossing Bitcoin into one of these decentralized protocols without really understanding what the risks are on the other side of that trade, really you can kind of package and securitize anything to generate yield. And the average person who's throwing USDC into a decentralized lending protocol doesn't know the difference between the risks associated with one platform that's offering 2% and another platform that's offering 15%. One could be secured by bank deposits, the other could be secured by subprime auto loans or something, right? So I think that transparency, more transparency, obviously, I guess part of the reason why that might come into play is with more regulation, and that's kind of at odds with the whole decentralized mentality. So it's just that fundamental balance. We've got to find an equilibrium on that spectrum to protect the average user and at the same time blow up the stranglehold that the oligopolistic kind of traditional finance model has on things.
Right, and it's a delicate balance at the moment just because it's such a new industry and everything is so just working out the kinks and all that. Joshua, if you want to hit this next one from Balapur, he asks, do you play spread with futures basis trading?
Like me in particular, or
just the panel, but I singled you out first.
Okay, all right. Yeah, I mean, I think it's like in the last 3 or 4 years, like this idea of like spread trading, basis trading is maybe even a core strategy of most of the hedge funds in the crypto space these days, right? Everyone is sort of trying to play this interest rate arb between futures and perpetual swaps and the funding that you get from the perpetual swaps from like spot. And I think, it's funny. It's like, it used to be so inefficient that you could just there was many opportunities for you to sort of capture like market dislocations or just, discrepancies between one market and another. And now it's become a much more, it's a much more difficult game. I think a lot of it is about speed, but also a lot of it is about sourcing like the cheapest cost of funding. And so, that I think that's an advantage that, a firm like Genesis has is, we do have a lot of access to funding. We have a lot of visibility into where forward curves are and things like that. And we have access to term funding and we know where that should price. So, we're better sort of able to price futures and things like that. And I think that's, that is something that is it's just an inevitable part of the way the market's structured. And you have to have some exposure to basis to be able to run a loan book efficiently, I think.
Dan, have any thoughts?
Yeah, I mean, I think it's I actually think it's a better way to trade, like even from a speculative perspective, because you can tie some level of like what is fair value other than just purely technical. And a relationship of A to B, although it's not as like, you know, I mean, look, I founded Hero, and Hero is, you know, has a lot of the kind of the dopamine rush type of elements to it, but, you know, that you would get from if you were just like outright speculating on front month stuff. But it's a little bit more of a boring way to trade, but it's a smarter way to trade in my view, because it's just looking at the market through a different lens. There's different ways to capture edge. You can create much more hedged books, which ultimately, when you get into like things like lending and you start getting into like risk-based margin financing, like the entities that are going to be providing that are going to give you more rope effectively, because you have a more correlated hedged position. And when they're running those through risk metrics, it's just a little bit of a safer way to trade. It's a little bit more boring, but the guys that I have seen historically, the best traders that I know in the legacy market worlds, outside of just like spot equities and stuff, they're all running some, like, you know, similar to what Josh is saying, they're running some type of basis trading, they're running some type of correlation trades, they're running some type of pairs trading, and they're either more high frequency trading around these like core inventoried spread out positions, or they're using to take some type of actual view on, you know, on basis or duration.
Paul, I wonder if for our newer listeners, you could maybe, in your simplest terms, kind of explain the concept of spread futures and basis trading.
Yeah, no, again, these guys have, you know, both Dan and, you know, Josh have, you know, hit the nail on the head. I mean, you're simply just looking at relative value relationships, for example, between two assets. I mean, it could be as simple as that, right? Whether it's asset A, one's going to be, has I guess a traditional sort of factor relationship that you can statistically model and look at over time, and then you know, understand where there could be different regime changes, for example, within the relation within those two assets, whether it be, you know, a curve or two assets in the you know, in the space. But it's really nothing more simple than that. You know, they're going to have different fundings, obviously, as you go out the curve, but I wouldn't make it any more complex than, you know, you're looking at two different assets over time and over some type of term structure that is going to have, you know, different values and fair value, and you are either speculating or hedging those relationships.
So I'll let you start off this next one as well. What's your opinion of adding high leveraged trading pairs to small illiquid altcoins?
You know, that's that's almost adding leverage on top of leverage on top of leverage. Sure. I think as you further go out the risk spectrum, you know, away from, let's just say, the blue chips or even digital gold and digital silver, you know, these are sort of leveraged, you know, plays anyway, right? I mean, there's barely any liquidity, and you know, the convexity that you may get exposed to in these extreme price moves, you know, you already have an inherent leverage built in, right? And then to add, you know, an extra actual, you know, 10 to 1, 50 to 1, 100 to 1 on top of that is, I mean, hey, this is the reason why potentially that, you know, we're still in unregulated land, right? And it's actually one of the biggest struggles that when I think about what is really going to mature this industry, because yes, there's this sector of you know, the ecosystem that does love leverage, does love gambling, but I think to bring the traditional players in, to bring in the, you know, the volatility per se, we may have to take away some of that margin and that leverage. So I you know, I'm cognizant of you know, all our, you know, sort of partners in the ecosystem, but it's something I do struggle with. Exactly your point, putting, you know, leverage on top of already a leveraged asset.
Clark, do you have any thoughts?
Yeah, you know, I think it really kind of comes down for the average retail trader to just really kind of craft the narrative of what your trading strategy is going to be, and then structure the position around that while being cognizant of all the risks. So just as Paul mentioned, if you're talking about doing a levered bet on an asset that's already highly levered, due to its fundamental characteristics, and the risk reward is probably skewed out of your favor, right? The cost structure for putting this kind of thing on is very opaque. Retail users are basically just set up to fail with these types of things because of the expensive cost structure around it. I mean, there are enough issues with price discovery and transparency in spot crypto that when you lever it up additionally by adding a derivative layer on there, those issues just become more magnified.
Awesome. So we have about 5 minutes left. I want to hit this one really quick. Joshua, if you want to just go over kind of some of the pros and cons of leverage and derivatives trading in general.
Yeah. So like I said, I mean, and the biggest thing is, you know, if you don't have capital in the right place at the right time, derivatives afford you a way to get the risk that you want quickly. And, you know, then you can transfer your funds later if you need to, that sort of thing. I'd say the other thing that, you know, has come up more and more in my conversations with clients is like, you know, people want to use derivatives because it gives them, or, you know, in particular, nonlinear derivatives like calls, right? It's a way to sort of get the leverage that they want without exposing themselves to liquidation risk, right? Which I think post-March is kind of top of mind for a lot of people. So yeah, I mean, people are sort of looking at longer dated calls and things like that as a way to sort of put a small amount of notional down as premium and then you know, magnify that as exposure without, you know, the risk that you get liquidated and you lose that exposure entirely on one sort of gap move, right? So those are two advantages, I guess.
Dan, you have anything?
Yeah, you know, I think there's a couple ways to think about it. One is if you're thinking about it in the context of like, you know, 100x leverage or kind of the things that have kind of been the marquee ways of looking at leverage from the kind of the retail perspective, you know, exactly what Josh said, like there's other ways to get exposure. Like one of the reasons we created Moonrect actually was a way of just giving somebody exposure that really didn't benefit from like or hurt you from volatility. It just was really more of a pure way of speculating on price in a peer versus peer way. But you know, I think one of the more important issues around it, and maybe this is a positive or negative, is like kind of just the lack of education and understanding for the rest of the world of how this works. And these are not easy things to explain when you get into leverage, or like how the four of us all came from backgrounds that you have to understand this stuff in order to make a living at it. And so, or to kind of understand where the edges are because it's so stinking competitive. And it can definitely be abused. And when leverage is available and gets in the wrong hands, it's really a suicide mission. But it can be, if it's presented and it's the end user of it, and I'm speaking more to the retail world because I'm assuming that a more sophisticated investor is going to take the time or at least have the resources to understand it. They need to be explained. These otherwise esoteric elements of derivatives, linear and non-linear, need to be explained to the rest of the world in a way that like a 5-year-old can understand it. And if you can give them that and you kind of have confidence that you're delivering that to your user base, I don't think it's a bad thing. Like trading is a game at the end of the day. And it's like the ultimate game. And there is this element, especially nowadays, and I think Josh was talking earlier about like, you know, kind of the advent of the Robinhood trader and things like that. Like leverage is okay as long as like, and those guys are gonna take advantage of it because they're gonna want to use it to speculate. The more sophisticated guys are gonna want to use it for more sophisticated trades and capital efficiency. But I don't think there's a con to it unless it's abused. And I think and also if it's left opaque and you're putting it in the hands of people that haven't been educated on it prior to using it.
Great, that's really great insight. I think we need to wrap up here as we have another panel coming up in 2 minutes. Thank you so much, everyone, for coming on. It was really a pleasure to chat with all of you and just so much insight from every one of you. So thank you so much.
It was great. Real pleasure.
Thanks, BJ. Take care.
Thanks, BJ.
Thanks, guys.
Just tell us when to go.
I'm good whenever you guys are. Yep.
We are ready to start?
Go.
Okay, so welcome everyone. It's still here, Giovanni and Jackson, hosts at this crypto live stream. And then we have with us keynote speaker Robert Materazzi, co-CEO at Lukka. Lukka is a blockchain native company providing software and data solutions for institutions, and it is also a sponsor of this live stream. Robert will be delivering a presentation about his company. So thanks for being with us today, Robert.
Yeah, thanks for having me.
And just remember, guys, before you get started, that if you have any questions about the presentation, make sure you add them in the chat, and we'll be reading it and asking those questions directly to Robert. So without further ado, there you go, Robert.
Great. Thank you, everyone. And thanks for having me. I'll share my screen. And so as I mentioned, I'm the co-CEO at Lukka, and we're going to overview today a couple of the challenges that we're helping our customers solve, specific around data challenges for post-trade operations. And so we have a few slides, and I'll be happy to answer questions. So Lukka, just a little bit about us. So we are a data company, and we are focused on blockchain and tokenized asset data and cleaning it up to help support normal, typical business operations. So we collect data from all of the various exchanges or trading venues that people are used to receiving. Often it's privately held data and not off of an actual blockchain, although we do accommodate actual blockchain data as well. And we pull it in, we normalize all the data so that if Kraken uses XBT to represent Bitcoin and Coinbase uses BTC, and now you multiply that times the thousands of assets and all the different sources that are out there, we have data products that help to clean all that up so that when our customers, which are a lot of the big exchanges and institutions that are serving this industry, are solving their financial requirements, we cater to those needs and help them close their books, if their funds strike NAV, pass audits, and do all of the other post-trade operations that businesses require. And so we have a suite of products. I'll just touch on this really quickly. We have our Lukka Crypto Office product, which is really our main enterprise institutional software. It's very feature rich. It collects all the data, and that's the one that we offer to a lot of the businesses that are out there. And then we have two data products that we created to support the software. The first is Lukka Reference Data, and the second is Lukka Prime. And those are the two topics that we'll cover in today's presentation. And then additionally, we have some tax-specific products that are catering to 1040 filing. Our Lukka Tax DIY, which is a retail similar to a TurboTax, except for your crypto side of things. And then we have Lukka Tax for Professionals, which we're partnered with CPA.com. Which is for tax professionals that are servicing their clients. And then we have a thought leadership subscription that talks a lot of the unique intricacies and such as tax treatment, but it's a lot more comprehensive than that. So accounting, data challenges, and a lot of the other things, and it's a content-based subscription. So those are some of our retail products at the bottom. Today's focus, though, we thought most relevant, we wanted to cover our reference data and Lukka Prime products. And the importance of the challenges that they're solving. And so the first one, why is reference data needed? And for those of you that aren't familiar, I mentioned this a little bit, but there's thousands of crypto assets, as everyone are aware, some a lot more common than others. These are offered on various different exchanges or OTC desks or other businesses that are offering them to all the traders that are out there. But all those exchanges or trading venues get to pick their own tickers and their own ticker symbols. So that creates a lot of complexity when you're combining this, particularly when individuals, in order to acquire some smaller coin, might need to purchase Bitcoin on a large exchange like Coinbase that they bought for US dollars, transfer it to somewhere like Binance to trade for some other coins. And then do the reverse all the way back, to turn it out to cash. And when you when you multiply that times all these different exchanges, all the different assets, it creates a lot of complexities when people are trying to do things that should be very simple, like pay their taxes, or what a lot of the businesses are accommodating in financial statements and passing their audits. And today there are no unique identifiers that are specific across the board. So there's no standard setters that are driving this currently. There's exchanges obviously all over the world that people have access to. And so all of these unique challenges really forced us to create a data product so that we could make our software work. And that's when reference data was created. We were our first customer at first. And now it's very popular among a lot of the large institutions. And so our reference data is the golden standard of digital asset data. So we create this master listing of tickers. And really it has, so we have over 80 entities. So an example of an entity would be Coinbase. The second one would be Kraken. An entity could also be a pricing source like CoinMarketCap. We've mapped over 26,000 assets that create the 5,000 plus unique assets across all those exchanges. Over 10,000 unique trading pairs. We have, additionally, we've recently added over 27,000 derivative ticker symbols to our reference data as well to accommodate that. And then we can, so we incorporate this into our software, but also institutions or businesses can license it to us as a direct data feed through something like an API or flat files, or all depending on their requirements. And if we, here's an example of some of the tickers that are out there. So we create a unique ID for each of those assets. And then in the background, we're mapping it to all those various exchanges so that from the customer's perspective, they're just using a single ticker for each one of their assets, and they know Bitcoin is Bitcoin. And this is incredibly important when creating tax lots, particularly with higher volumes of activities where you can take advantage of tax strategies by matching your acquisitions, potentially that you're trading or acquiring on various exchanges. The next product is our Lukka pricing product. So this one is, so when we say pricing, we mean for valuation purposes. So when you have a crypto trade, so Bitcoin for Ether, and often you're charged a fee that's also in a cryptocurrency, it creates some unique situations where for tax or compliance or financial reporting purposes, we need to determine your cost basis or proceeds, so the value of that transaction at that point in time, so that we can do normal tax or financial calculations. And what we do is we will bring in a pricing source. It's very often that services will provide pricing sources such as VWAPs or average prices, but for tax compliance purposes, that's not considered a best practice. And if you're a business and you're complying with GAAP or IFRS, if you're overseas, it explicitly says that you should utilize actual executed exchange prices and avoid things like VWAPs or averages. So those are usually for the pre-trade side of things. And so what we have done is we've created Lukka Prime and a number of other pricing products to create flexibility for these businesses, so they can select from a menu of different pricing sources. They can bring in a VWAP if it's appropriate for what they need. We also have a Lukka Prime product. Lukka Prime uses a unique methodology that's designed to be aligned to GAAP and IFRS guidelines. And what it does is, using a bunch of qualitative and quantitative factors, it selects a actual executed exchange price based on those factors. So for every point in time, you're using an actual exchanged price. So it's selecting one of them from many exchanges that are out there. And that supports all of these tax or audit use cases. We also do custom pricing, so we can create an average based on parameters if a customer needs it, or we can feed in third-party pricing data on a case-by-case as well, just to create flexibility. So that's the end of the presentation. Happy to answer any questions or dive into anything.
Great. We have an immediate question from Roger Brown, who asks, why is the Lukka pricing product superior to those offered by a VWAP?
Sure, and I wouldn't necessarily use the word superior to be tactful. I would say that it's more appropriate for audit and tax use cases. So specifically, if you're post-trade and you're a financial controller and you are going through your first audit as a business and you need to value your assets for books and record-keeping purposes, using an executed exchange price aligns to accounting standards, in short. It's also not formal guidance, but in the FAQs, the IRS is stating that you should utilize executed exchange prices. That can be very challenging to do, particularly when you're trading across a bunch of different exchanges. And so these are satisfying all of those requirements, where the VWAPs are very logical for other use cases, in market data and other pre-trade operations. So it's just two very different separate uses, which both are required.
Thanks, Robert. I also have a question from my side. Since you are dealing with taxations, I was wondering, are your customers all U.S. companies or also companies based in other countries, other jurisdictions?
No, we absolutely do service globally. I'd say we're U.S. based, so we have the majority of our customers are U.S. based, but we absolutely have many customers overseas and are happy to work with them. This pricing product, for example, we did design to accommodate IFRS, which is an international accounting standard opposed to U.S. GAAP. So we absolutely cater to companies overseas.
Great. We've got another question from the audience. This one is coming from Whoop Chewy, who asked, there are not many trustworthy data oracles which are widely accepted at this time. How do you plan to keep the competitive advantage?
Can you repeat the first portion of the question?
Sure. He asks, there are not many trustworthy data oracles which are widely accepted at this time. How do you plan to keep the competitive advantage?
Sure. I mean, I guess with any business, competition is usually good for the industry. So, I'd say anyone that's operating a business should encourage that. It helps the consumers. It helps the customers that are out there. We've I'd say, for our own competitive advantage, we have a special emphasis in catering to what our customers are asking for, and that's part of our culture. And so I'd say that, that keeps our customers happy, which keeps our business profitable.
Thanks. We also have another question. What kind of target market does Lukka have?
Target market, sure. So I mean, all businesses that have financial transactions in digital assets. So anyone that's trying to solve those pricing and reference data are only two of the challenges, but ultimately managing all of that data for post-trade operations is very challenging, can be very costly. So our goal is to reduce those costs for businesses that are out there.
Great. We've got another question from Roger Brown as well. He says, does or will Lukka support thinly traded crypto assets?
Yeah, that's a great question. So our Lukka Prime today covers the more liquid assets that have higher volume. And we're absolutely in the process of rolling out. It's not available yet, but it will be very soon, within months. We will be adding a number of assets to our pricing data in order to accommodate the more thinly traded assets that are out there. And we'll have white papers and thought leadership, and would love to discuss that with anyone that would like to reach out to us.
Cool. Awesome. Yeah. So I think it's a great time to wrap up.
Yeah.
Thank you so much for that presentation. I hope you guys out there listening to this learned a lot about Lukka and their products. And thanks for sharing your presentation with us.
Yeah. Thanks for having me.
Hi, everyone, guys. Welcome to our panel of our crypto trading event. This time we are joined by Dana Cavalea, former performance coach for the New York Yankees and author of the book Habits of a Champions. So Dana offers high-performance life coaching to athletes, but also business executives and traders. And today he's going to talk a little bit about how to be a champion in trading. Welcome, and thanks for joining us today, Dana.
Thanks for having me, guys. I appreciate it.
Yeah, and before we turn the floor over to you, I'd like to remind our audience that if you're enjoying the stream, please hit that subscribe button so we can bring you more awesome events like this. I hope you've been watching all day so far because it has been excellent and I'm really enjoying it myself. So it's great to have you guys out here. And yeah, so Dana, please tell us what it takes to become a champion trader.
Yeah, well, listen, to become a champion in anything, it's hard, right? It takes discipline, it takes focus, it's an attitude. And most importantly, I always say it takes a champion's mindset because there's so many ways for us to get off track. And one of the things I love most about working with traders is they remind me a lot of athletes. Every play matters. Everything you do matters. So it's really important that you're able to maintain your focus both in the short term and in the long term. And that's very difficult for people. And the one thing that athletes do really well, that great traders do as well, is they have an ability to separate from their emotions. They don't make decisions based on emotions. They make decisions based on their instincts. So if you're so emotional, you cancel out and you can't hear your own instincts and you can't feel. You lose your touch and you lose your feel. And to be a great trader, you have your data and you have your knowledge and you have your education, but without your instincts, you're dead in the water. And if you allow your emotions to take you over, your trading journey is going to feel like you're going to go up, you're going to go down, you're going to go up, you're going to go down. And what happens is, and this becomes particularly dangerous, is you base your self-esteem and how you feel about yourself on your results. And that's another part of trading where we have to teach the trader to separate. You know, when you play the game of trading, you have to know the rules of the game in which you play, much like baseball or soccer. These rules have games. And I always say in baseball, for those that are familiar with the sport, no hitter gets a hit every time up. But what the great hitters do is they're competitive every time they get up to the plate, knowing that there's a chance that they could get out. And the same is true for trading. You're never going to trade to absolute perfection. So stop trying. Stop trying to be a perfect trader. Be a competitive trader that uses instinct and education and acquired knowledge to be great. And that's what I always say. Now, how do you separate from your emotions? How do you do this? And I have a simple diagram that I put together. And I say, to get to that state, right, you have habits and you have routines, and those determine your results, right? If you have negative habits and you have negative routines, you're going to get negative results. If you have positive habits, positive routines, the chances of you having positive results go way up. So as a trader, how are you approaching your day? What is your approach? You know, trading, I grew up, you know, just outside of New York City. And the typical stock trader is somebody that we say burns it at both ends of the candle. They stay up all night, they party, they go hard, they spend their earnings. And then the next day they come into work sleep deprived. They haven't trained their physicality. And it's dangerous because as you fatigue, you start to listen to your emotions more. You become more emotional, right? When you don't sleep, how do you feel? You don't feel energized, excited, and great. You feel vulnerable. And that's a dangerous place for any trader to be. And I want to point that out. So what do? We start teaching habits. What time do you wake up? What time do you go to bed? Very important. And then what do you do to train your body, train your physicality? Because trading is competitive. It's going to call upon you in a very deep way, in an emotional way. if you're strong and physical and you train your body, in turn, you're going to strengthen your mind and you're going to feel more comfortable separating from your emotions. So positive habits, what you put in your body, how you train your body, how much rest you're getting on a day-to-day basis is very, very important. Now, some people may be out there and saying, wait, this guy's telling me I have to be in great shape to be a trader. And I'm telling you, yes, because you're going to have to be in great shape physically and mentally to endure what it is that trading is going to give you and bring you. Both the positive in terms of the financial gain and the success, but also the negative, which is going to strip you naked and make you feel very vulnerable at times. So you have to be ready for both. Get your habits right, and then you have to be consistent in those habits. And that consistency in your habits, that becomes your day-to-day routine. Your routine is what you do Monday, what you do Tuesday, what you do Wednesday, Thursday, Friday, how you prepare for a trading day. All of these things are super, super important. And you have to remember that. It's very, very important. So if you get your habits right and you do them with consistency, you create a great routine, and then you're able to get more predictable results. Now, players like Derek Jeter, some of the greatest players in the world, they know that there's going to be times that you're going to fail, but that doesn't mean you're a failure. There's going to be times as a trader that you get bad results. It doesn't mean that you're a bad trader. It just means you didn't have a good day. That's the sport. That's the game. That's what trading is. But trading is also an average. It's not what you do today. It's what you do over a 365-day year, or it's based on what you do every day you sit down to trade. That's what it's based on. And that's what I speak a lot about. I try to talk to traders to grab a hold of their emotional state and not allow outcomes to drive their decision-making and not allow the outcome to determine who they are as a person and who they are as a trader. And it's super, super important to grab a hold of that. I work a lot with traders and I talk to them about trading when you're at your best. So when do you trade best? What time of day do you trade best? Do you somebody that wants to trade all day, or are you somebody that trades best in shorter and smaller intervals? When I work with guys, I talk to them, are you somebody that stays in trades, or are you an in and out kind of person? You have to know the kind of trader that you are. And that first starts by knowing the type of person that you are. The greatest traders, the greatest CEOs, the greats of private equity, the great athletes, they are all very secure in who they are. And they realize that there is no amount of wealth that they can achieve that will make them secure. Security starts with yourself. And that's how great traders become great traders. They're not looking for a big score to feel great about themselves. They expect a great score over time because they have great habits and they have great routines, and they're very secure in themselves. So that's a big part of my game. And when I coach people, listen, if you're somebody that says, hey, I'm a little bit insecure, I chase the money, we got to figure out why you're so driven to chase the money and why that's determining who you are and determining your personal security. When you get that personal security right, then you have the opportunity to be a great trader. You take your instincts, you take your energy, you take your data, and you apply, and you become a great trader over time. The other thing I say is you got to know why you play the game that you're playing. Why are you trading? How much do you need to earn to live the life that you want to live? These are all really important questions that most people don't ask. Most people go out every day and they try and hit a home run as a trader. But remember, if you are positive today, that's a good day. If you're positive tomorrow, it's a good day. I work with guys that say, hey, I made $4,000, and they're upset because they didn't make $5,000. I said, well, you could have made $0, or you could have lost $4,000. So you got to realize that we're like, at the casino, right? We're trying to take all the chips and we're trying to pull them over to our side. But sometimes we take just a couple chips. Sometimes we take them all. But you have to be okay taking 1 chip, 2 chips, 3 chips. And over time, you start to stack your results. And when you stack your results, over time you become a success. So that's how I look at it. And I know it's a very different thought process. I come from the world of sports, I come from the world of business, and I come from the world of coaching. But I do hope that everybody that's listening to this can find some application to their own life and realize that trading takes discipline, it takes focus, and it takes you to be in a neutral state of emotion. You can't get super high, you can't get super low. You have to play that midline. Find your way to play the midline. When things go great, that's great. You expected that. But when things don't go great, you expected that too, because you know that that's a part of the game. So that's really what I want. That's the basis of what I wanted to share with everybody today. And if there's any specific questions, I'm happy to answer those as well.
Yeah, thanks for sharing that. And as he said to the audience, guys in the chat, if you have any questions for him, make sure you write them in the chat. We'll be watching, and we'd love to ask you to them. And you know, I saw a number of comments in the chat when you started talking about physical health in terms of trading, and it reminded me of Garry Kasparov, who was the world reigning chess champion for a number of years. And one of the things that he said was that he was the most fit chess player out of all of his competitors. And he named that as one of the main reasons why, or one of the reasons why he was able to work harder and win more, was because he kept himself in very good physical condition. So I saw a lot of people who were kind of, you know, reacting to that in an interesting way. And I wanted to follow up with a great example of how, you know, physical condition can impact something that isn't usually deemed as a physical kind of sport. But I am curious, you know, you've been talking about routines, habits, and consistency. What does a day look like for you in terms of your routines and habits?
I'll tell you this, my worst days are the days when I give myself an out, where I say, you know what, I don't have to work out today. And I tell you what, I feel weak all day, mentally weak. I don't feel as sharp. I don't feel as good. Like today, I've been coaching all day today. And my energy at 4:15 Eastern time in New York is as good as it was at 6 o'clock when I got up. That to me is because this morning, first thing I did when I got up, right? Hydrate, bang, workout. I do a competitive 20 to 30 minute circuit where I'm pushing myself, a mix of conditioning, core training, lower body and upper body, all calisthenics and body weight. So I sweat like a pig. My heart rate's elevated. I can't talk. I'm pushing myself to the point where, you know, it's difficult for me to speak, but now I'm ready to go out and compete all day, right? I get a great return on my energy. I call it ROE. So if I put the time in to train that 30 minutes, again, I'm going hard. So 30 minutes, oh, coach, you only train 30 minutes. I'm going hard. And I'm getting great energy from that workout so I can compete all day, right? So that's how I start my day. I get up, I train. I have a blog that I write every day, all about motivation, inspiration, and encouragement to help you optimize performance. And then bang, shower up, eat, and I start my day right around 9 o'clock. So
you said eat, you know, physical fitness is incredibly important, but so is diet to feeling healthy. Do you have any recommendations? Is that something that should be structured along with fitness?
Yeah, well, you know, again, there's a lot of talk today about fasting and all that. I'm not a big fast type guy, especially for, you know, people that need a strong energy reserve. So if you're heavily overweight, fasting has a place for a short period of time, but it's not something you would do long term. But I absolutely believe what you put in your body is super important. Now, does that mean you have to eat to perfection every single day? No. But the majority, I say you have to have a strong eating average. So if you eat 3 meals a day, 7 days a week, that's 21 meals a week. Did you go 21 for 21 with great eating? Did you go 18 for 21? Or did you go 10 for 21? Right? So I always say, what's your eating average? So if you think consciously like that, you're eating a diet that's got good amounts of protein, where most people are deficient, you have moderate carbs, and a small amount of fats, you're going to do all right. Now, some people say, hey, well, I do keto. That's a different story. We would manipulate those macronutrients different, but you have to fuel your body for performance. And with athletes, think about it. They get paid for for performance, but so do traders. So you have to fuel, you have to train, you have to mentally strengthen, and then you have to recover at night. When you're done, you're done. Pull out.
So yeah, I also have a question for you. Actually, your speech reminded me of another guest that we had on our live stream, another coach, actually, Stephen Goldstein, who also coaches traders. Mm-hmm. And he wrote a very interesting articles about the power of letting go, which is the actual power of champions. So as you said, when you lose a game, that shouldn't affect your performance overall. So one of the greatest characteristic of a champion is the capacity of walking away from a lost game without letting that lost game to affect the whole overall performance of his lifestyle.
Yeah.
So that reminded me of that. What do you think?
So I have something I call it's an exercise. It's called the horizon line. Okay. So it's simply this, right? When we look out at a horizon, what's above the horizon is the sun, right? The sun is above the horizon. So we look at the sun as all positive, optimistic, success. Everything that we want is above the line. Everything below the line is negative. It's slow. It's all dark. We can get there as people, right? If you're a human, you will go below the line. Things are going to happen in your life. Things are going to happen. So it's unrealistic to say that you're going to be perfect all the time, right? We talked about that. But you have to be aware, am I above the line where things are really good, or am I below the line where things are really down? So it's your job to live in real time and catch yourself. So as a trader, when you're below the line, you need to do things to peak yourself above the line. And for me, that's a focus shift. I call it mind shifting. You just mind shift yourself above the line. Hey, I'm feeling down. Things aren't going well. Oh my God, what am I going to do? Hey, I'm going to take action and I'm going to move myself towards where it is that I have to go. So you move yourself above the line. And that allows you to say, hey, I lost today. That's a below the line thing. But mentally, I'm going to move myself above the line because tomorrow I'm going to go out to win. So a lot of this is reframing and what I call mind shifting. And you have to do that because you're never going to wake up every day and feel great. You're never going to sit down to trade every day and be amazing. But we can increase the percentages of that by moving ourselves above the line.
And actually, that reminds me of a video that I watched on your YouTube channel where you are actually saying about the importance of telling you out loud certain things in order to move you above that line, right?
Yeah, I have these, I call them I am statements. So listen, to be great at anything, it takes a lot of confidence and self-belief. So you have to prime that in your brain. You have to put that there. Nobody's going to put it there for you. And the chances of you just living your life and hoping it's there, there's going to be a lot more crap up there than good things. So what I say is, if you're feeling weak and not really confident, the first thing you should say is, I am strong, I am confident. I am strong, I am confident. And keep putting that in your head. So I say, listen, most people shower every day. That's a great time to prime your pump and get yourself primed up to take on your day. I'm ready to go. I'm a champion today. I'm going to trade like a champion. I'm going to have a great day. I'm going to manage my energy. I'm going to have great energy today when I sit down to trade. I'm going to have a successful day. I'm going to compete today as a trader. You haven't even traded yet. You may not, at that point, you probably didn't even have breakfast yet, but you're prepping your brain to see success and optimize your own mental psychology and state.
Yeah, I think that's a really good point. I mean, the power of intent is incredibly strong. And I also had another question, because we've been talking a bit about separating yourself, not defining yourself by your successes or failures. And trading seems a very interesting example, because if you're full-time trading, your successes and your failures become your livelihood very quickly, and you have so much at stake riding on whether you make good trades today or you don't make those good trades. So have you felt that it's been harder for the traders you've coached to separate themselves from their results than other professions like baseball?
I'll tell you what I see with traders a lot. They're not good with money. Okay, hear me out. Believe it or not, I mean, I've worked with a lot of traders that they live off of their trading account. They don't even have an operating account. So I said, listen, I put a line down the middle. You are who you are. Like, I'm Coach Dana Cavalea. I happen to be a coach, right? You're you, and you happen to trade. So those are two separate accounts, right? This is what you do. This is your business, and this is your personal. And what I find is a lot of traders are just really poor with their own money. So they don't have their own retirement plan that they're feeding. They don't have savings on this side. They they put it all over here, or they have the desire at times to put it all over there, especially after a loss. And then they try to get revenge on the market, which is also very dangerous. You can't do that. So you build your security on your personal security on your personal side, and you trade on this side. So when you mix the two, it's super dangerous. So the way I look at it is, I worked with a client as of recently, and I said, listen, first thing you have to have an operating account where you pay your rent, where you pay your mortgage, where you pay your bills. That's all over here. And when you have success over here, you don't just take that money and put it back in. You take a percentage, everything that you make over here, you determine a percentage that comes back over here for safety and security. So your safety and security is built over here, and you build your business over here, right? You're an entrepreneur over here, but you're building safety and security and a long-term financial growth plan over here. And they don't mix. If you fail here, you don't start pulling out of here to feed this thing. It's a bad idea. And I've seen guys go broke doing that. It's super dangerous. So you have to realize that there's a separation and there's a line right down the middle. And if you're going to cross them, you're going to be very emotional. And that is a bad place to be.
Yeah, that's a really good point. I think that's great financial advice for pretty much anything, Just don't let your job and your personal life mix. And it's a pretty good golden rule. So we have a couple of questions from the audience. Let's start out with one from San Angdo, who asks, do you trade crypto?
I don't trade crypto. I only do what I know. I have clients that mine crypto, but I do not trade it. I just don't know enough about it. And I only stick to what I know. So I stick to coaching. I stick to real estate. I stick to what I know.
And you wanted to add something else?
I said maybe at some point when I want to dig in a little bit more, I'll get there.
So we have another question from Mindmap Academy, who says, which coaching technique do you use? NLP. I'm not sure what NLP is. Maybe it's a coaching technique.
Yeah, it's called neuro-linguistic programming. I don't use any coaching technique. I use my own technique, and that technique is I meet people where they are, right? So wherever you are in your journey, that's where I meet you. I coach traders, I coach executives, I coach CEOs, private equity, managing partners. The same way I would train an athlete. I meet them right where they are, and we begin to handle what's right in front of us. I don't go all the way back and figure out, if you had what your relationship was like with your dad or your mom, or, when you first, felt trauma. Well, we'll get there at some point, but that's not where my journey begins. I meet you right here, right now. What are we doing right now? Because I find most people don't take action on anything. So I don't have a particular style or technique or, I have a degree in sports medicine, but I meet people right where they are, and we begin attacking on their goals right there.
Mm-hmm. And actually, I have a curiosity, like how long, on average, like a coaching program does it last? Like how long do you follow every day some specific person until he gets to the point where he wants to get, and he doesn't need your coaching anymore?
Yeah, well, I try to make that as soon as possible. Now, for everybody's different, but what I'll say is, like, I was talking to a client, again, very successful in private equity today and venture capital, you know, and he's been with me for years. So what it becomes is a relationship that says, hey, I'm your coach and I need you to be peak every single day. Now, every 2 weeks we meet up, or every week we meet up, and we talk about where you are right now and what's in front of us. And what we do is we take this week and we connect it to next week, and then that week, and we connect it to the next one. So when we look back on a 52-week year, we've gotten progressively better, and we've attacked everything that sits in front of us every single week. So like I said, that's the way I coach people. I don't coach people for one session, or it's a little bit of a longer engagement, because I need you to be successful.
All right. Thanks a lot, Dana. I think that we are about to wrap the panel up. It was very cool, interesting. Thanks for being with us.
Yeah, thank you guys. I appreciate it. Thank you again.
Yeah, that was awesome. Appreciate it.
Right.
So everyone, make sure you stay tuned, because we've got another panel coming up for you right now, which is going to be keep calm and trade, how not to fall into emotional FOMO and analyze market sentiment. So it's a great segue off of this one. And that will be featuring Matty Greenspan, Max Engelen, and Mike McGlone, moderated by none other than Scott Melker. So make sure you guys stay tuned for that. Thank you again, Dana.
All right, see you guys.
A lot of a head start.
What's up, everybody? Welcome to the next panel. This is Keep Calm and Trade, how not to fall into emotional FOMO and how to analyze market sentiment. My name is Scott Melker. I'm a crypto trader, former DJ, and the host of the Wolf of Wall Street's podcast. We've got an awesome panel for you guys today. So first, I'll go ahead and introduce our guests. First, we have Matti Greenspan, the founder of Quantum Economics. What's up, buddy? Good to, I think you're muted. We're going to have to stop meeting this
All
way.
good, thank you.
I feel like I'm looking at you through a screen at least once a week at this point.
I figure for that answer, you might as well read my lips, right? It's good.
Exactly. Our next guest is Max Engelen, the head of business development at Crypto Compare. Thanks for being here.
Cheers, Scott. Thanks to Cointelegraph for giving us the invite.
And we've also got Mike McGlone, senior commodity strategist at Bloomberg Intelligence. Welcome.
Hello. Thanks for having me.
Hey, Mike, if I do a good job, you think you can get me a discount on a Bloomberg terminal?
I wish I could do that, but no one gets a discount.
That's what I've heard, unfortunately. I figured I had to try, right? So first, obviously, our topic here is emotion in trading, which I personally, as a trader, think is the most important aspect of trading, controlling your emotions and understanding them. But then even more importantly, how to to analyze other people's emotions and understand what's happening in the market, which is market sentiment. Would one of you like to first tackle this very introductory question, which is what is market sentiment and why is it important?
That's when you tweet something and then a million people tweet back at you.
I think
right. that's how I learned to harness the market sentiment. Anyways, is through Twitter and seeing what people think about something. I mean, that's the most obvious. Anyways, at least except for the price, which the price is the clearest, of course.
Of course. So how does market sentiment analysis work for those of you that are actually doing that? What data are you analyzing and how is that data gathered?
We've been collecting social data for many years, Reddit, Facebook, Twitter, GitHub. But there are other incredibly good tools for sentiment analysis. Maybe Lunar Crush, some of you might be aware of. Looking at across.
I'm an advisor on Lunar Crush.
Okay.
Yeah, yeah, they're awesome.
So I name dropped that for you, so you can walk home happy there.
Thank you. I don't have to now. No, those guys are seriously awesome. You should check out the site.
Yeah, they are. They do a great job. But overall sentiment is seriously important in crypto because it moves so fast. It can change so quickly. It's 24/7. So, Scott, you being on Twitter all the time, I'm sure you understand sentiment more than most.
Yeah, I mean, it definitely gives you a good pulse. I think sometimes it can be misleading because obviously every person sort of forms their own echo chamber. I think to some degree, obviously you follow the people that somewhat agree with you. And so it is interesting to step outside of that bubble and then to identify these tools that I think can maybe give you a better accurate appraisal of what's happening. So I'm just curious, as a trader, how are those tools created and what data are you actually using to create those? Maybe there's no answer directly for that. Mike, being in commodities, and I mean, I guess focusing slightly outside of this, how does market sentiment affect what you guys do?
Oh, it's a big place, most notably in cryptos, because I view cryptos and Bitcoin as the quintessential trading vehicles. The thing from a future standpoint that I used to watch close, and I still do very much, is managed money net positions, basically hedge funds. You don't really have that in crypto, but I do inadvertently scan the headlines a lot. And I'm big picture, so I try to stay away from the trading. As you can see, I've tried that a lot. And like Madi, I got the same hairstyle. So, but what I find is when I put out an outlook, if I sense a lot of bearishness, I'm much more likely to put a bullish comment. And I sensed it a lot the last few weeks. It was great. The minute I saw a lot of people said, oh, we had this moving average crossover and all these little nuances that really mean nothing and getting bearish, then I get more bullish. And to me, that's the way I at least see it because it's ideal for traders. Now, obviously, the smart traders get it. But when you see the headlines, typically, from my standpoint, the media headlines are usually good for fading.
And do you think that sentiment moves, the stock market, commodities market, and global markets as much as it does crypto? Or do you think because crypto is so emotional and technical that it's a much stronger factor there?
Much stronger and more nuanced because it's newer. But one thing, the narrative I really liked was the people said, I'll buy if it goes above 10,000. And the trading kits used to make fun of that. We used to say, okay, you're going to, it's, technically you'd say, oh, if it breaks above 10,000, it's going to go up. We'd say, so if it goes up, it's going to go up. I kind of make fun of that. I might say, well, if you're bullish, you're supposed to just be long. If you're bearish, you're supposed to look for spots to get short. So I like this narrative. We finally broke above 10,000. It's bringing the new, some of the momentum people type back in. But sometimes it's fun to make, little bit of use. I would hope I gained a little bit of wisdom in making fun of these things sometimes, these nuances where I say, hey, if it breaks support, it's going to go down. I'm like, okay, you'd say, so if it's going to go down, it's going to go down.
But shouldn't it make a difference, like with, how strong it breaks? I mean, we had a really strong break above 10,000. We're like shot right up, right through that. We're sitting above 11. We're now testing 11K as a support. So wouldn't that make a difference?
Oh, sure. But the market's hitting stops. And once you run through those stops, it pulls back a little bit. Like when it goes down, it hits stops and it runs, or the emotional traders, however you want to call it. But yeah, I agree. But to me, then you always have to, it broke through 10,000 many times in the last few months, but you have to find a good catalyst for it to stay above that. And I found two that made me put out that comment. If it breaks below 10,000, now that's a problem. I would view that as a stop. And that is number one, gold breaking above all-time highs. Okay, that's a key thing. and the OCC approving crypto for custody at banks. That was enough to me to say, all right, that's good enough.
So do you think that this market—
Visa and MasterCard to boot.
So yeah, Visa and MasterCard, and then you can add in PayPal and Venmo to that, because obviously you're talking about 320 million people having access to crypto. And those are people that can now buy it in theory, or will be able to, on a platform that they actually trust, which is obviously a huge barrier to entry for people in this space. But that touches on another point, which you just said. You know, you're convinced by this move above 10,000 because we have this bullish news. How much do you think that news plays a part in crypto trading or crypto price action, specifically Bitcoin?
Well, it does a lot. I mean, news is always part of the market, but markets are people. People are emotional. And I try to take that, you know, take the nuances out and focus a lot. I mean, a lot of times they accuse me of being too technical here. And one thing I like to point out in modern markets is price is everything. We wouldn't be here now talking about Bitcoin if it was at $100. No one would give a damn. It's 10,000 above there. And that's why price matters. So and price will bring in momentum and things. And I think it matters a lot. So for instance, 2017, we all knew it was a bubble. We all knew it was too expensive. And my indicator said, okay, well, it's supposed to correct. And how far does it correct? Now it's just been consolidating that bull market for 3 years. And I look at it simplistically like, all right, so something's got to change in the big picture of Bitcoin, or it's going to just continue what it's been doing for the last 10 years. And we know what that is.
That's true. So how much does market sentiment act as confluence with these other fundamental and technical factors? I mean, obviously people trade this market in very different ways. Fundamental is barely one of them, but there are people who are purely technical. Then there are people who use these market analysis tools. For you guys individually, as you're trading or looking at the market, how much are you looking for confluence between these things?
I think, you know, in 2017, 2018, big news would move the market quite quickly and quite significantly. But I think as crypto matures, maybe news isn't as much of a factor. Of course it is, but you know, this recent breakout volatility was at an all-time low. It was just ready for some good news to be on the horizon for it to push it out of this trend. So yeah, I think they work hand in hand. For me, I'm probably a little bit more on the fundamental side when it comes to my trading strategy. So news does play a big part. So I think that bank, the news of bank being custody crypto certainly was helpful, but I don't think it was the reason for the breakout.
Well, I agree. I mean, with volatility at those levels ranging for that amount of time, it was going to choose a side, right? I think that kind of speaks to what Mike said before. It is ironic to say if it goes above 10,000, then it's going to go up. But I guess when you are ranging and you're looking for a significant level to signal that you're out of that range, that perhaps that's why that's a meaningful thing. But when you say, Max, that you use fundamentals more, are you speaking, you know, generally, specifically with Bitcoin? Do you trade altcoins? I mean, you guys are obviously tracking everything.
Yeah, I typically trade Bitcoin and ETH. You know, it's about as much as I can wrap my head around to understand the fundamentals really well. When I mean the fundamentals, basically, of course, you know, recent developments, the actual health of the Bitcoin network. So, you know, what's transactions velocity like? You know, how many active addresses do we have? And many other fundamental aspects to it. So I think the word fundamental is very much all-encompassing, but I think I'm certainly not a technical trader. You know, I understand a few charts, but fundamentally, I think I can get away with it, understanding Bitcoin really, really well to improve results and, you know, profits.
Yeah, it's an interesting point. I mean, fundamentals in crypto are very different. It's not a P&L or a quarterly earnings report or something like a company or a stock. You're talking about hash rate and, you know, wallets and those other things. So I guess there's that differentiation between what we look at. So what do you guys make of the recent alt season, if you want to call it that, or the way that perhaps while Bitcoin was ranging, the bullishness of altcoins, the crazy moves, and how much of that was captured by viewing market sentiment?
Yeah, I think that what we have right now in the crypto market is really a microcosm of what's happening in the traditional markets. This is something that I mentioned on Bloomberg Radio yesterday morning, where we have we have a rapidly changing dynamic in the world, right, with the pandemic and everything like that. I think that the initial shock of the pandemic, March, that was, let's say, in a roller coaster, right? You know how it starts out with that huge drop, right? And then after that, and where we are right now, is kind of like the rest of the roller coaster, which is where we're being carried off of that momentum. And now we're seeing all the twists and turns and loop-de-loops. So some companies, they're going to crash. They're going to get completely hammered. The airline industry, the demand just kind of collapsed on them. And, that in turn had a knock-on effect on the oil industry. And some companies like Tesla, people are trying to vote with their money. They feel that, this is kind of the future. So they're going way above their fair valuation. So I think that this is happening as well in the crypto market and the altcoins, and traders are getting very selective, where you have some altcoins which are getting completely hammered, and then you have some which are zooming towards the sky. I put up a tweet the other day, which was a graph showing Link against Tesla, and it was like for like. It was exactly identical over the last few weeks. It was just incredible.
Well, that touches on an interesting point that all of you can probably speak to. What do you make of Tesla? I mean, it's obviously reminiscent of, the sort of .com bubble and the tech boom, when all of a sudden you were seeing these insane stock prices that had nothing to do with valuation, but generally we saw how that ended, right? Reversion to the mean and back to proper valuation. Do you think that Tesla, which is clearly a FOMO situation, which is what we're talking about here, it's people FOMOing in because they don't want to miss out on the future. Do you think there will be a mean reversion, and do you think that that's something that we'll be able to see coming?
Well, can I get on that one real quick?
Please.
There always is.
Please.
There's always is some form of mean reversion. The question is from what levels and how level. But I think the way you premise that is the key thing. It's a disruptive, in a good way, new technology. And we all know what's happening with technology and digitalization. I think that's why I'm visiting a few crypto traders who are looking at buying Bloombergs. They would have Bitcoin right next to Tesla on two different screens. I'm like, all right, I get it. It's the key thing in factor investing where I like them in the same bucket, and that is momentum. Disruptive technologies, and they're just going up. So I view them as similar, but in fact, it's kind of funny. I had to convince our editors that I had to be allowed to do a few bits on them together, because you're very kind of professional and stoic. And, I'm at Bloomberg. I'm like, guys, this is what matters in crypto, is things like this. So to me, momentum, similar technologies, breakthrough. Yes, you always have to. But the key thing about Bitcoin, that's the key thing that got me bullish. It had an 80% correction, and it's had them in the past. I don't know how much we've had that in Tesla. That's what really got me bullish, is when you have a bull market that corrects, it's fundamentally positive, and it drops 89%, you're just supposed to say, okay, thank you, I'll join that party.
Because that's the nature of a parabolic breakdown. But does that mean that parabolic breakdown is coming for Tesla, and we're going to see a 78.6% or 80% drop? I mean, obviously, I should premise, as a trader, the last thing I want to do is say that I can predict the future, that any of you should be able to either. It's just a conversation of what could happen. Go ahead, Max. Sorry.
When you're in a bubble, it's very difficult, and I think that Mike was alluding to this as well. It's very difficult to know how much farther the bubble is going to pop, and then when it pops, where exactly are you going to come down to? So it could be that Tesla will continue to go 10x from here, and then when the bubble pops, it'll go, maybe $1,000 higher than it is now. We have no idea. But we can clearly tell that it is a bubble. I think that's really the only thing that we can be certain of at the moment.
For me, my opinion on Tesla is much like Bitcoin, to be fair, is that I'm pretty convinced in its long-term ability to accrue value and to be important to people. So regardless if it were to correct 80%, obviously I would, that's not a good day for anybody, but it's something that I would continue buying and probably holding for a lengthy period of time. And that just shows, why there is to Mike's comment, that there's the momentum, is that people really believe that now. And there's results, they're one of the biggest car selling companies in the world now. So they've got a real commodity.
Right. Well, go ahead.
It's a simple way to look at it in Bitcoin is when you're an investor in that, one of the best ways to make it go higher is to skim profits. And if you don't, it usually goes down. At least that's the rule I've learned.
That's fair.
Just watching some of these comments is hilarious. I understand that people think that the markets are going to go up forever, and I too have listened to a bit of Mr. Stool Presidente telling me that stocks only go up. But I've seen that so many times over the course of my career, where people come in, they make steady gains for 2-3 months, they think that they are literally a god, and sorry, the end result is never good. I mean, maybe this time's different, but I don't think so.
Well, those are the most dangerous words in trading, right? This time it's different. Is that Templeton, the most dangerous words in trading? So you just brought up a good point. You touched on Portnoy and Davy Day Trader and sort of what's been happening since COVID began and since the market bottomed. And since we're here to talk about FOMO, what do you guys make of average Joes popping their $1,200 stimulus checks into bankrupt companies and pumping them for multiple 100% gains? Is that what's actually happening? And what do you make? And what do you think is going to be the end result for those people that have made those investments, so to speak?
I would be quite careful, to be honest, purely for the fact that they're going to come after you if they see that you've spent this stimulus package incorrectly. So whatever you do, don't be sending it to Coinbase where they've got, a huge amount of tracking software. I'd be sending it probably to your mate, P2P. But yeah, that's my opinion.
That's true of the PPP loans that were given to businesses, but I'm talking, more specifically about the individual, helicopters flew over and dropped some cash on everybody, $1,200 stimulus, which they will or won't correct, which you are allowed to use for whatever purpose you want, just for clarification. Okay. But we did just see in Miami that a guy took a few $1 million of his PPP loan and bought himself a Lambo, which is the most it's not crypto, but it's the most crypto story I've ever heard.
Yeah.
Well, they are, as you alluded, they're classic signs of peaks. And I look at it simplistically, a disciplined standpoint. When gold is outperforming the stock market, you stick with the rock. It's beating stocks. And I view that as similar with crypto. I don't know if you can see the screen I shared, but you look at volatility on Bitcoin, it's the lowest ever versus the NASDAQ. Can you see the shared screen I'm showing?
I can see it, yeah.
Yeah, so that's a key thing I'm watching. It's very simple. That so we're talking about stock market when this asset, I heard the other day, I have to look at gold because gold I associate with Bitcoin is because I heard another day said gold's getting a bit frothy. I'm like, well, so on a 10-year basis, it's up 60%, and NASDAQ's up 500%. Which one's frothy? Very simple. But the world is not thinking that yet. The world hasn't shifted yet to at some point we will get a stock bear market. And of course, unless, history has changed and they'll never get one again. But this is the key thing I want to show is the NASDAQ and Bitcoin cross paths, at the same level back in 2017. They're still there, both about 10,000. So which one has the upper hand from a pure measure of the market's risk? Bitcoin has the lowest volatility ever versus NASDAQ, which I show in the chart. My thought is fine. Which one's going to appreciate the most from 10,000? If history is a guide, you're probably better off in Bitcoin.
And how much is that volatility determined by market sentiment?
Well, that's the key thing. Volatility is simply a measure of the market. It's 260 days, so it's annualized, and that's what I have to do a lot at Bloomberg. I have to keep it big picture, and you can't argue with it. And that just measures the lack of less risk in Bitcoin as measured by the market versus that more risk in the stock market. So as far as sentiment, there's one key thing I like to show about sentiment, and that's right here on this one. What you see in orange, that's just the one of the most transparent ways to look at Bitcoin is GBTC assets under management. Now, oftentimes it's better to divide under and put in BTC equivalents, but look at that. It's from the lower left to the upper right. Very transparent. That's retail getting in. At some point, that's going to ETFs. It's just a question of time. And one key indicator of that going to ETFs is futures. But one thing I want to show you here is sentiment. Let's look at one of the most robust leading indicators I see for Bitcoin, although it's a moving average, is the 30-day average of active addresses used. And that's what you see right now. It's equivalent to the price of about 14,000. This was a key metric that kept me bearish in 2018. It plunged. And then when it broke above these old highs.
I don't think the audience can see your slides here, unfortunately.
Okay, well, so it's just a key thing. Active addresses used are at the equivalent level of what Bitcoin was last at 14,000, based on an auto scale for the last 3-4 years. That's the simple way to look at it. And that's a good measure of sentiment adoption that has a robust correlation with the price.
I really like that volatility slide. Did you
Yeah, it
send
was
that one out in the
amazing.
email?
In terms of
I want to tweet that one after our call.
Yeah, it's really,
we,
really awesome.
We actually tweeted saying just the other day in terms of volatility, when Bitcoin broke out, it actually bounced off the exact line or the same level of volatility in March of 2019. So USD volatility rose from its lowest point since March 2019. So that's what I meant by how important the volatility was to break us out of that trend.
Yeah, 30-day volatility was near the lowest ever just a few days ago. Exactly.
Yes, yeah, 30-day volatility, exactly.
And how much room does that have to grow?
Tweet it out right now so everybody can see what we're talking about.
So how much room does volatility have? I mean, to grow? It looks somewhat bottomed looking at that chart. Yeah, we have a long way to go, right?
Well, that's the key thing about volatility. Bitcoin volatility is on its way down with natural maturation of the asset class. That's just a no. So hopefully, because that's just a sign it's becoming more adopted, it's becoming more like gold. So gold volatility is running typically around 20-30%. Bitcoin volatility is still around 80% on an annualized basis. They're converging. It's just a matter of time. But that's why I think that last measure, these things, we should continue to see Bitcoin drop in terms of volatility, which is a good sign. It means it's becoming digital gold.
Right, which is obviously a narrative that's been around for a long time without much actual data to support it, and is now, as you said, sort of coming true. I think another huge discussion that hasn't been had here, it might be a bit off topic, but it's important, is that I think the 2017 rally, if you want to talk sentiment, we saw these huge spikes in Bitcoin searches, right, on Google. Everybody was talking about it. Your Uber driver was trying to get you to buy Bitcoin. Your postman, every single person was into it. And now we see this trend where price is sort of in the same place where that launched from, or even higher, but the Google searches are not there. I think retail, as you said, you are seeing it on these charts that retail is getting interested. But do you believe that this rally this time is being buoyed by retail, or do you think that we're actually seeing the smart money in institutional investment and interest that was sort of conjecture in 2017 and 2018?
I think there's two reasons for your searches not being there. Number one is people already know what Bitcoin is. They don't need to go and search Bitcoin. So the action really is happening on social media and in just in conversations between people, and people don't have to go, hey, what is Bitcoin? Number two, we're still, as far as I see, very much in the beginning of the cycle. So the astronomical figures that you saw on the Google Trends, I mean, that was at the peak. So I think we're just not there yet. We're not at the point, and people have other things on their minds with the pandemic and everything like that. There's so many other things going on. The evidence to me that we're seeing more institutional players lately and more institutional adoption is the reasons or the drivers that are moving the markets right now. And in January, right before the pandemic, or before people were scared of the pandemic anyways, we saw an incident in Iraq where the United States assassinated an Iranian general. And that actually moved the price of Bitcoin. I think that was the first time since 2017 where a global news event, or since earlier, that a global news event really actually had a direct impact on the price of Bitcoin. And then again in mid-March during the crash, I mean, Bitcoin's fall, I mean, that was right in line with everything else that happened. And I don't think that was the hodlers. I think that was the retail investors who are still kind of new in the markets, looking for liquidity, looking for cash. They needed to get some there. They just happened to have that Bitcoin that was sitting in profit, for the last 6 months. That was an easy way for them to raise cash for their margin calls. So that's like, I don't know any hodler that goes, oh, market's about to open right now. It's the bell's coming. I need to raise money right now. I'm going to sell my Bitcoin. No, that was very likely. That was due to institutional adoption, and that's a large part thanks to the efforts of Fidelity and Backed, the CBOE and everybody else who put Bitcoin in front of institutional.
What do you guys think?
I'd have to completely back that up with data. futures open interest all-time highs. The key thing about futures is, yes, it's for trading, but they're CFTC regulated on exchange, on a regulated exchange. That's been the problem with ETFs. You look at other things, addresses used. Okay, that can be anything, but trend is clearly from the lower left to upper right. Gold, okay, and again, the key thing also is GBTC. Now, I understand it can be, but these are more buy and hold types. So virtually every indication I see, as Maddie mentioned, there's BAC, there's futures, there's Fidelity, and then there's anecdotal information I get from some of the money managers I speak to, and they all get it like, well, why risk not having 1% in Bitcoin? Because who cares about 1% versus what it can do? And I look at it as a bucket in gold, and I see a lot of those types. That's what I've been saying for quite a few years now. I should bucket Bitcoin with gold. And I see that as a more attractive investment going forward, because the key thing about that is it's a virtual guarantee with unprecedented central bank easing. That's going to guarantee that gold will be supported. Yet everything else is subject to economic expansion, fiscal stimulus, a return to normality, in demand pull, like higher bond yields. All that stuff is much more dicey and less likely.
That makes sense. Max, what's your take?
Well, I do think there's certainly a lot bigger appetite coming from the institutional market, which will certainly help to break Bitcoin up to its new all-time high. We have an index business, and we've licensed over 30 different indices. About 4 or 5 are listed on regulated exchanges, and that just shows the appetite of companies or asset managers are looking to license a crypto product because they've got clients or people that really want to have some skin in the game. If you look at Mike's chart on how far Grayscale have come, I think that is a great indicator of how much interest and positivity there is, and wanting to get your hands on it. So yeah, I don't know. It's to the point of Bitcoin searches. I think I do agree with Maddie there, is that more people kind of do know a little bit more about Bitcoin now. But I would still assume like how to buy Bitcoin would still be quite a big research, search term, because it's damn hard to buy Bitcoin most of the time, or at least quite confusing for most.
I agree, which is one of the huge barriers to mainstream adoption, which, like, to me, why Venmo and PayPal is such a layup, things like that, where someone can go somewhere that they trust, they know how to use it, and they just, we've seen it with Cash App, right? That's where that's driving their business at this point for Cash App. So I'm curious, we've talked about using social media and market sentiment and all these things in your analysis. Do you think that people maliciously use social media to drive price in one direction or the other, to fool retail?
Dogecoin comes to mind, right? With
Doge is awesome. Come on.
Well, yeah, but Dogecoin is all about the pump and dump and the memes and the shtick, right? So I think that was kind of characteristic. But yeah, what do you think? What do you think happened to Hertz? A bunch of people got on Reddit and go, "Hey, we gotta pump this thing right now," and bring it to the moon. And same thing with Dogecoin. We had a bunch of TikTok people who put a campaign up that we got to get Dogecoin. So yeah, I don't think that, I think it's difficult as an individual to make those kind of, to try and move the market like that. Even, Warren Buffett tries once in a while. I think he has a hit and a miss record on those. But as far as groups doing it, I think that it's a lot more powerful. And especially when you get, a large enough group, it certainly can impact the market. I think we're seeing a lot more of that these days now that the market is full of retail investors.
Yeah, Doge was certainly helped by Elon Musk.
Yeah.
Well, in a market like this, it's not regulated. It's just a guarantee. I remember being in the trading pits, and you could see how guys would manipulate stuff. I learned early on that it's just not worth it. You can make a lot of money and have a great life without doing anything illegal, but it's virtually guaranteed. There's a lot of that. I think it's more collusion, that people don't get what they're doing is illegal, and some point it'll come out. But the good thing about Bitcoin is just getting too big for that, which is once you get that depth, which is part of the reason. Once you get that depth, it only goes one way, and it's already earned that. Now all the other coins are there's 5,000 of them. It's a guarantee. There's collusion and manipulation to make money, because there's no repercussions yet. And that's coming.
So everyone here is a trader in one degree or another, regardless of your strategy. And As I touched on in the intro, I mean, for me personally, I think controlling emotion is the single most important aspect of trading, not how you find your trades or how you identify, it's just really how you can step back and let your plan manifest without getting in your own way. So how do you guys control your emotions when you're trading? How do you, accept a loss? How do you step back and let it happen? Anyone want to take this one first?
I'll go with that one. It's not easy, right? When you take a loss, especially if you put a little bit more money on the line than you typically do. Funny enough, I only really started purchasing futures about less than a year ago. It was quite an experience to me, is that I could make pretty quick money overnight, but I could also lose it all overnight. What I learned was not to try very hard not to stay in a position too long, and if I was, to learn not to do that again. And I kind of have learned that. But if I'm using big leverage, then I typically wouldn't stay in a position very long, especially not overnight. But I don't really have a way of picking myself back up again. I don't look at Bybit for a few weeks and then I come back again, I guess.
So for you, it's stepping away and resetting and then coming back with a fresh mentality. How about you, Mike?
Well, I think as an ex-trader, one of the best things to do is use disciplined guidance. And one of the things I'd like to watch is moving average envelopes, Bollinger Bands. You guys can probably see the screen right now, but just recently what happened in Bitcoin, the 52-week Bollinger Band, the annualized measure was the nearest ever. And it usually means it's going to break out. So typically you're supposed to go to the top band, which is right around 13,000. And guess where it bottomed recently? At the bottom of the band. So to me, that's the key thing. And the bottom line I use as a day trader, and learning that in a trading pits, is never trade without stops. Define your target, define your risk, put the stop in after you put the trade on. Sometimes you have to use a limit to be careful on part of it, but definitely use stops. And that's the joke we used to use in the trading pits. Oh, he's trading without stops, which means you can lose your house. And that's from the heart of trading pits, where these guys were the quintessential, bid and offer. So in cryptos, it's the same to me. Never trade without stops if you're trading. And the way I've resolved that is I don't trade. I just invest.
Mati?
For me, and I know that every trader and every investor is different. For me, it's kind of a lifestyle. And I think that people just kind of have this preconceived notion about what is trading, where, you go in, you do it for an hour and then you walk away. And I don't know, maybe that works for some people, but for me, it's always being in touch with the markets 100% of the day. I have a partner who goes, "Come on, Mati, just film yourself trading for 20 minutes." I'm still struggling of how do I do that, right? I'm trading 24 hours a day, 6 days a week. Of course, we just saw, I think the previous presenter on here was some kind of sports coach, and he was saying how much eating the right things and having the right state of mind and all that. He'd never traded in his life, but there is something to that, which is having the right mindset. First of all, I meditate about an hour a day through prayer. On Friday night, I shut off my phone, shut off the computer completely for 24 hours. So that's just my downtime away from the markets. But other than that, 24 hours a day. I mean, it'll be the middle of the night. If I'll just wake up and check my phone and see what the markets are doing. And you sometimes you feel like, okay, it's time to take a trade, and sometimes it's not. And that's just, for me, that's what trading is about. So when you ask kind of how do you manage your emotions in trading, it's just kind of the same as how do you manage your emotions in real life. It's it's just a matter of having that emotional maturity.
Well, Mike, you were in the pits, right? I mean, you've been doing this for a while, and you were not trading a 24/7 market like crypto. So for you, I know you said you don't really trade it aggressively, but what is it like to track a market that never closes?
Oh, I love it. But I love the fact that I don't have to go to work on weekends. That's one thing I've always enjoyed about being in this business, is the market's closed on Friday. When you're in the States, it's time for a cocktail, because there's no market in the world that's open. It's just the best happy hour there is on Friday in the trading, and when you're trading. And then things open back up on Sunday. And I love that. I love how cryptos are. Yeah, they trade 24/7, but they need to, because it's money. But I'm a big fan of shutting down the weekends, like Maddie said, you either praying or meditation, whatever you want to call it. People need that. And that's why I've always defined markets. The best way to really watch markets is on a weekly basis. Days will just mess you up. Weeklies, it's a psychological. So that's what I suggest for traders. Watch the weeklies, 52 weeks. You can use exponential as you want, because that's the psychology. It's a little bit different than, hey, Maddie's daughter. That's great little view there. But so that's the key thing is, again, bottom line is never trade without stops and leave those stops in. I would say you got to be discretionary. Leave limit off. Say if you're long, you got to leave. Say if you're long, typical example, say if you're long 2 Bitcoin, you put in stops or a fraction of that, limit stops because you can run through, and you always put in offers. You just leave them in all the time and contingent, and then move forward, because if you don't, you're not disciplining yourself. And also one thing you need to remember, a true trading can be completely mentally and emotionally demanding. It can take so much from your life versus reading a book. Sometimes it's just a much better thing to do.
So you need to be able to step away, basically. You have to be able to disconnect.
Put in your stops, put in your limit orders, and walk away.
Yeah, so I guess that touches on the next question, though. That's easier said than done, right? I think what we find in trading is that people, even if they have a firm system and they have a plan and they approach a trade and let's even say that they identified a correct stop and they size their position correctly, which most people don't do. What keeps you from seeing price approaching that stop loss and saying, this thing's going to bounce right now, I gotta lower this?
Well, that's one thing always remember, and I'll let my colleagues speak next, is most people lose in trading. You just got to know when to get out and stay out.
Max, have you ever done that before?
Yeah, multiple times, which obviously I'm proud of. But you know what, like, I to Mike's point is just set a stop loss, nice tight stop loss, and you don't need to stay up at night or worry too much or sweat watching it get as close to your liquidation point as it shouldn't, really, because you shouldn't let it get there. But I think maybe your guests would probably got more experience with that. As I said, I've been buying Bitcoin spot since 2013, but for about the last year, I've been trading when it comes to putting in stop losses and all the rest. So maybe Maddie's got some good stories about that.
Yeah, I just want to say really quick, liquidation should never be used as a stop loss, just for the record. Yeah. For anybody listening, no matter what your leverage is, your stop loss should be above your liquidation point. Go ahead.
That's a terrible one. So in 2014, I was trading on the euro dollar. I was shorting the euro pretty heavily because it was just going up for a very long time, and there was a feeling that it was about to take a big drop. And was coming up on Mario Draghi's speech. And, Mario Draghi was the central banker in the European Central Bank at the time. And I knew it was going to get volatile. My stop loss was a fair bit away. And just before he announced quantitative easing, right, that they were about to embark on a huge cash injection. This was when quantitative easing was still relatively new. Just before he announced that, just as the speech started, there was this bout of volatility which spiked the price up. It hit my stop loss by 2 friggin' pips. And this was a very heavy short trade. And the euro just kept going down for 6 months after that. So stop losses can save you, but they can also be your worst nightmare in some cases. It's just a matter of getting to know them and a matter of experience on that, I guess.
It's one thing traders need to accept, Maddie. That's a great story. It's happened to me, all of us many times. You get stopped in the lows or stopped in the highs. Traders have to accept that and move on. And guess what? As Dennis Gartman says, the market's a horrible mistress. It will find out what your position, and it will rip your head off. And guess what? If you haven't had your ripped off, then you haven't traded or haven't taken normal risk. That's why as a 55-year-old guy, I sure love just not trading and watching other. And sometimes it's that knowledge. You know where the stops are. You know when people are getting hit. And that's why it helps with my analysis. Like, okay, now I'm going to put out a bullish comment because I know that just hit all the stops.
Yeah, to that point, pro tip for those of you trading on BitMEX and Binance and Bybit and all of those other high leverage, if you put a stop loss, you're revealing your position to the market maker and they're going to take it. So watch out, because I'm quite certain those guys are running stops, and probably anybody else who's got, high leverage trading, especially for retail. They're going to take your stop every time. They'll move the market on purpose just to run those stops.
That's a great example of how things have just migrated that I learned in the trading pit. Sometimes I was on the phones. I was always on the phones. You see those guys talking to the institutional traders, and I was arbing in the pits. And a lot of times I would just ask the brokers I know, hey, where's the stops? And this is a signal you go, where's the stops? And they would say, okay, around here. So are there stops upside? Where's the stops? And because they knew in their deck. So if you kind of define where the stops are, people would try to run to them. Nothing's ever changed, nothing will change, and you just try to hit the stop. So guess what? Markets will go to like Maddie mentioned. If there's a cluster of stops, markets will go there.
Yeah, and in this case, what he's touching on even more specifically is that likely these exchanges, which are unregulated, are actually internally running your stops. it's part of the business plan.
It's not new to crypto.
Yeah.
It's not.
Yeah.
This is an old thing that market makers like to do, and this is way before crypto was invented. They've been doing this in the forex, especially in the high leverage markets, is where there's they in essence, if you're trading against a market maker, you're trading against them at some level. Some market makers are a bit more honest about it and won't do as many running stops, and some are a bit less honest and a bit shady, but you'll never know which are which.
Well, here's an example in options. Look at options open interest. So oftentimes you see a concentration of call strike at a call strike or a concentration of put strike. So if you're bearish, you always want to be short the strike where there's a lot of open interest and long a strike in front of it. But guess what? Because people are typically long puts and they're going to be selling near there. Same in calls. Typically, people are oftentimes short calls. So you want to, if you're bullish, oftentimes you want to be, you want to be careful with all that concentration open interest in that call. Market's not going there because there's too many people going to be responsibly selling. It's kind of like a stop. So you have to act accordingly. So that's one thing that really can learn from options. And like Manny mentioned, that stuff is just, it's as old as trading Japanese candlesticks in the 17th century. It's just on a different format now.
Yeah, and if you're trading derivatives now in crypto, there are actually really cool tools, which I guess you could consider fundamental tools that will just show you where the 50x, 100x, 25x, 10x, and 5x liquidations are. I mean, it's open data. You can see where the positions were. You can back calculate, and there are tools that do that. And it's almost inevitable that the market will go hit at least up to the 50s, right? Usually the 25x's, and that's why, that high leverage is almost like you're giving your money away to some degree. But Mate, I want to talk about something that you touched on before with your euro trade, because it's something we've all experienced. So you obviously stopped out like almost to the pip. So we've all been there, but there were 6 more months of price action in your favor and you never re-entered the trade. So emotionally, what was the reason for that? And, is it a urge to not take a revenge trade? Was it fear that you were going to finally do it and the market would reverse? So, in that situation, what are you thinking?
I was liquidated.
No money left.
and that, at that point in time, that was like I was all in. And when you get licked like that, you're gonna have to take some time off.
Keith,
and plus, I didn't know it was gonna keep going down. 6 months.
Never do.
I mean, that trend is monstrous, and you always go okay. So I mean, my take profit was significantly lower, but it tripled or quadrupled where my take profit level was, to be honest.
Crazy. So you would have been out. You wouldn't have ridden the entire thing, but still, I mean,
you
always like to think that you like to think that you would have, though, right?
Yeah, no way.
So that's where Maddie's example is just a really good indication of how to analyze the market. Number one, trade less position, more focus on the position, and maybe scale in and out as a trading bias. For instance, that plunge we had in Bitcoin down to 5,000, in March, April, was that classic
March 12th,
stop out. Yeah, just classic. We all knew it. Fundamentally bullish, flushed out all the week longs, and here we are. I mean, it's easier said than done, but the same thing happened in Treasury market in 2018. Sentiment, managed money net positions on bond futures and interest rates were the shortest ever. And here we are, yields have gone in the 30-year from 3% to less than 60 basis points. So those indicators are sometimes the best you get out there, but you have to try not to be the victim. And Maddie, we both learned the hard way, and just, you got to get back in, try not to be the victim. The way I like trading sometimes, if you scale, fundamentally have a position. Are you bullish Bitcoin? Fine. then you overweight. You've got to be ready to overweight when it dips and underweight when it rallies, but keep that fundamental position and you just trade around it is the way I like to suggest people should trade.
But what is it about humans that, makes them want to, you just said, you have to be willing to sell when it's going up, which is the opposite of the stop hunt we were talking about, right? People move their stops, they do those things, but they also refuse to take profit at obvious areas, or they take it too early, or they get greedy and try to ride it. So as you said, it seems so obvious that you should be selling on the way up and buying on the way down, but people almost invariably do the opposite thing. Why is that?
That's a good little lesson that I've learned also is when you're on the phones and you got a guy in Japan who's trading a lot, he made a lot of money in a position you suggested. If he calls you up and suggests taking profits, you always say yes. That's a rule in the business is you never get fired for taking profits. So I actually recently did that in gold. I've been bullish gold for about 5 years. And as a strategist, I have to be careful, but I just pointed out, if you've been bullish and you're long, it's all-time new highs. It's basically stretched above the 52-week average the most in 10 years. You probably should be scaling back a little bit. And the key lesson we learned, I remember being with some traders, and I used to be on a trading desk a lot too, is you're bullish, and I'd be ask me, why are you selling? Well, because I've made money, and if I don't sell, it's going to go down. If the market thinks I'm selling, it's psychological. If the market thinks I'm selling, it's going to go up. It's just you got to play this silly game sometimes, but as long as you're booking little profits and not getting overweight, it's the overweight positions that really get hammered.
But does that play to what you said about scaling in and scaling out? I mean, you have much less emotional attachment if you sell 75%, but you still have your 25% just in case it, as we say in crypto, it moons or continues on. Because like you said, there's a lot of people who are now getting interested in gold because it broke the all-time high, right? And so,
yeah, which is a bit risky, and that's why I say, but it's fundamentally a very bullish market, and I look at it like it's only up 60% on a 10-year basis versus the Nasdaq's up 500%. So yeah, you don't want to be the first one. Here, the level you have to fully expect, maybe we'll get a 10% correction. Maddie was kind of pointing it out in one of my comments. I can't predict that, but my point is if you get it, you got to be willing to not get stopped out and to buy dips if you're fundamentally bullish. And the point is, if you've been bullish for so long and you're made a lot of money, it's prudent to skim profits. Always prudent to skim profits.
Yeah, I took profits on gold at 1650, and then I've been waiting for a deeper pullback since then. So you know what? Sometimes you take those decisions, and no, I'm not bitter or definitely not kicking myself for losing that opportunity. Not at all. No.
Well, you made money, right? And
oh no, I made money, but you know what? I could have rode that one for a bit longer, no doubt, had I known what was going to happen. I'm still waiting for a pullback, honestly. And once we see it happen, $100, $200 pullback, and this is all throughout 2009, 2010, 2011. You got to remember that gold rally that just lasted 3 years without stopping, and we had pullbacks along the way, and everybody knew pullback was the time to get in. So I'm not gonna try and FOMO in at the top over here. I'll wait for that pullback, even if it comes at 2,200. I'll wait for the pullback before getting in.
Well, I think that's the right sentiment. I think Bitcoin's in a similar bucket. The difference is it's up a lot in the last 10 years, and but the key thing I like to compare about both of them had substantial corrections, gold and Bitcoin. The stock market has it, and that's what you typically have to do to reset and to reset a good bull market. And they're in the same bucket. Gold is increasing correlation as to Bitcoin's increasing correlation as to gold.
Mike, I'd be interested to know how low do you think the S&P or the Dow needs to go for it to have that correction?
Well, that's the key thing I like to ponder, and I like to ask ourselves and our audiences, do you think there's ever going to be a bear market in the stock market ever again? And we all know the answer to that. Is at some point it should happen. It always has. I don't know when and where, but my key point is gold's outperforming the stock market. There's that old mantra that don't fight the Fed, but that used to be stocks. And at some point, interest rates are zero. They've been dropping for decades. How much higher can the stock market go before it finally succumbs to just normal diminishing returns? Yet that old saying, don't fight the Fed, is really tilting towards gold, because it's almost a guarantee. Gold price has to appreciate unless it's banned like FDR did in the 30s. So I don't know. And I thought the S&P 500 would go down to around 2,000 and stay there, but it dropped to 2,200 and since went straight up. So, but my key point is at some point it's going to happen, and I don't see gold bottoming until the nadir, near the nadir of the next stock bear market. And maybe that's starting now. That's my sense is, as we mentioned, there's so much froth. It's as our equity analyst, just real quick, our equity analyst at Bloomberg, who's been very good, pointed out one key thing: the stock market's dependent right now on fiscal stimulus. Gold's dependent on one thing: monetary stimulus, and that's a guarantee.
So true. So true. So we have sorry, I said that's true.
Who was the analyst? Sorry. Oh.
And Mike's muted.
Gina Martin Adams. She's our top. She's our head equity strategist at the BI.
Cool. So I have a question that was sent to me from the audience, and that question from Diego Martinez is: any potential to apply behavioral game theory in crypto? That's a bit over my head, to be honest with you guys. So maybe one of you guys can answer that.
I don't understand the question.
Yeah, I think just saying is game theory a part of your trading strategy, I guess. But
I did a course on game theory once, and that is somewhere in my psyche. Honestly,
deeply ingrained. You're
it's there. It's there
gaming us right now.
Subconscious, yes.
Absolutely, yes. As long as it works for you. I remember being in the trading pits. The guy next to me made a killing in the 4x12. The other guy worked great in using candlesticks. Everybody had their own different system. Maybe some were more fundamental, like Max. Whatever works for you. If it's different, fine. But the key thing is, the one thing I always like to point out is be careful with those widely watched things you see on the press and public media, because they're often good to fade.
So sell the news. Yeah, good to fade for sure. So Mike, I'm curious. I want to hear your best story from the pits. Because I think that most people who are watching, and certainly anyone who's only traded crypto, literally has no idea what we're probably talking about with the pits, much less has heard any great stories.
Well, there's so many good stories. I remember one time when I, this is more of a fun one because it was, I would, as a phone guy, you give orders to the guy you knew, but also there was a guy on the side who was my brother who was trying to get my business. And one time I had a 10,000 lot option spread, which meant the commission for that was $20,000 for the broker. So I looked to the guy to execute the trade, and he wasn't looking at me. So I went to my brother. He's my brother. I said, I need to sell 10,000 market at the number. He looked at me and goes, 10? No, I know. I went like this, 1,000. And he freaked out. The pit went crazy. And the broker I didn't give the order to came out and threatened to beat me up. It was so funny. I'm like, dude, go ahead, hit me. I'll enjoy it. But that was, you have those kind of things a lot. But to me, the most exciting part was the Gulf War in the 90s. And, you know, when bonds went limit up, crude oil went limit down. And I just love busy markets.
I think everyone like my generation, I'm in my 40s, like the image we have is the movie Trading Places, right? Eddie Murphy and Dan Aykroyd down in the pits, you know, orange juice futures or whatever they were trading.
I don't know how many times we quoted lines from that movie. Get back in that pit, it sells. It's a lot like that. But the thing about, I was in the bond options and bond futures at the time. It was the busiest pit in the world. Orange juice is nothing, but no, we try to say that. Now it's all electronic.
How does it compare the feeling from then and now? Like what's the like?
Well, the thing is
about the now is more. Yeah.
Pit traders would get the edge because I remember you could sense, you can smell, because when people are really busy, men sweat and they smell. I can smell the volume. And you can sense where markets are going sometimes. And sometimes, like you do like this to the, this was this thing, is the market long or is it short? If you get a sense that the traders, the pit traders, which are long, towards the end of the day, then you don't want to be long because you know they're going to be selling. And if they're short, you want to buy a little because you want to hit their stop. So you get the feel in the pits. Away from the pits electronically, you have to use any type of system you can, which is much more algorithm and systematic.
So it's easier to find an edge in the pit. And a lot of that plays again to emotion and psychology, which you're talking about. And I've heard John Najarian talk about this a bunch, his time in the pits. And I have this like, imagine this guy's an NFL linebacker is in there and literally throwing people out of the way, jockeying for position in the pit. I mean, how much did physicality and aggression have to do with success as a trader before it was digital?
A lot. And that's one thing I really enjoy, never being in the pits, because a few times I had to go in there, it was just like, no, I don't want to be with all these masculine guys fighting. I'd rather be on the side and go home to my wife. And that had a lot to do with it. If you're tall, my brother was in there, he was tall. You had to wear glasses because sometimes you get a pen in your eye. And that made a big difference. I remember the best traders ever was a guy named Charlie D. Francesca. The last time he went in the trading pit, he was dying of cancer. He came in with his oxygen. And he's in that book, Market Wizards. I remember watching him trade, and he was just one of the best ever. And he was a big guy. There's a few Chicago Bears players in the trade. I'm from Chicago in there, and that really helped. You know, ever see the cow trader, Scott Shalady? Yeah, I used to work with him. He's a classic kind of pit guy.
So
awesome.
what you're saying, Mike, is that the internet is democratizing finance.
Exactly. Well, and so what's related
for short guys?
Really fast internet.
Well, it's like tell my kids, geeks are inheriting the earth. Be a geek, please.
Yeah.
That makes sense. So guys, I think we're up against it here. So just to round it out, do you guys have any advice, a last piece of parting advice from your experience for people on how to like manage their emotions, use sentiment, anything along those topics? We just go around. Max, you want to start?
When it comes to looking at sentiment, I would certainly, for me, I find Twitter to be a good barometer, but go look at the tools like Lunar Crush, go look at the tools like Crypto Compare and our API that I've used. We've got like 4 or 5 years worth of social data that you can mine through to look at trends. But when it comes to making sure you don't lose yourself a lot of money, maybe don't use leverage and scale in over time, you know, weekly, daily, or monthly. And at the end of 2 years, you know, you're not going to have any stress, and you should have a nice, decent bank balance as well.
Let's hope. Mike?
I'd have to echo that sentiment a little bit. Trade less, position more. And we know some of the biggest money in the world has been made from people who just buy and hold, and that's not just Bitcoin. So
it's never changed.
Stick with the fundamentals and be willing to lose 50% and not worry about it.
There you go. Mati?
Well, everybody's got to find their own way. So, you know, it's really a matter of experience. You know, find the people that you like to listen to, you know, follow them, listen to what they have to say. I'm listening intently to both Scott and Mike. I mean, both of these guys. I read a lot of what they put out, and I believe vice versa. So find out who you like and who you feel has good insights, and just listen to everything they say and ask a lot of questions, and that's the best way to learn, and then find your own path in trading.
Well, thank you guys so much, and thank you to Cointelegraph for having us. It was definitely an honor, and hopefully we can get the 5 of us in a room one day and have the rest of this conversation over a beer. Thank you guys.
It'll be a year or two. Have fun.
It might be a while.
Cheers, gentlemen.
All right. Welcome, everyone. On this panel, we're going to be talking about the price of Bitcoin in 10 years. My name is Sunayna. I'll be the moderator today. I am an investor and advisor in the crypto space. Previously, I was the head of crypto at Robinhood. Started off my career at on Wall Street at Morgan Stanley, and then Credit Suisse after that. I'd like to turn it over to the guests to give some quick backgrounds on themselves. Maybe Raul, you'd like to start us off?
Sure. My background was finance as well. I was at Goldman Sachs and also running a large macro hedge fund and writing macroeconomic research and strategy. I also started a video on demand media platform for finance called Real Vision, which I'm the CEO and co-founder of.
Nice. And Avishal, you want to go next?
Sure. My background is not in finance. It's in technology entrepreneurship. Started at Google, worked on search and ads, started a machine learning company, started a mobile infrastructure company, which I sold to Facebook, and I was director of product there for many years. And I now run Electric Capital. We're a VC firm in the space. I invest primarily seed, Series A, and crypto networks, layer 1 protocols, Bitcoin, obviously. And yeah, that's what I do these days.
Awesome. And Clara, would you like to go next?
Sure. I work at Gemini. I run our retail products there, all of our consumer products, and I have mostly a technology background. I've worked in crypto for 5 years and tech for 10.
Awesome. And Clark, would you like to go ahead and introduce yourself too?
Yeah, my background is aerospace engineering, and then I've been basically doing Bitcoin for my whole professional career, launching my first Bitcoin site in 2011. I've had 2 acquisitions of Bitcoin companies over the years, and now I'm at Kraken working on the CryptoWatch market data and trading software.
Awesome. I got to tell you guys, I'm excited for this panel myself. We've got such a great cross-section of different backgrounds here. I think this is going to be a lot of fun. So why don't we dive into the first question and just to sort of, start with the conclusion. I mean, what are people's predictions for the price of Bitcoin in 10 years? Let us start off with Avishal. You want to kick it off for us?
Oh, man. So I can't give price predictions. I generally don't, other than I think it'll be higher than it is today, and likely much higher. It's not investment advice, so don't go do your own research and so on. Standard disclaimers apply. But the way I think about it is, I think the standard analogy people use is digital gold. And if you just kind of do the back of the envelope math, gold at about $8 trillion market cap. If Bitcoin gets anywhere close to that, if it's about the same, each Bitcoin would be worth about $380,000. If you kind of eliminate the roughly 15% or so of Bitcoin that has been lost, for lost keys or Satoshi's coins, you get closer to like 450. And of course, there's no reason to think that Bitcoin couldn't be bigger than gold. Like, coming from a technology background, the way I always think about it is, when new markets emerge, we often underestimate the size of them. So like the knock against Uber at the Series A was, well, if the entire taxi industry is worth $10 billion, how could you possibly be worth more than $10 billion? And of course, in retrospect, we realize when you put something on a mobile phone and 2 billion people can access it at the push of a button, market sizes all of a sudden become 10x bigger than you thought. And so actually, several hundred thousand or million, actually, to the point of the panel, if you start looking at it through that lens, is potentially not out of the question. Now, when that happens, or if that happens, people should do their own research. But I think actually there is some math to back up that we could potentially get there.
Makes a lot of sense. Let's see, Claire, do you want to give us some views just in general on where you think the sort of future price action might be many years out?
Yeah, I mean, I want to say 0 just because I'm convinced no one on this panel will, but I don't actually believe that, obviously. I mean, I don't want to make a specific prediction either, but obviously I'm long-term bullish on it. I think the thing that is very likely to happen is that there'll be less volatility. And so I think it just will be a very different environment. I do definitely agree that I think the price will be a lot higher. And I think even in the short term, the price probably will be a lot higher. 10 years from now, I think it still has the potential to be a life-changing investment. Even if you got into it today, you never had bought any before today. I still think there's huge potential for people as an investment. So yeah, hopefully a lot more than now.
Makes sense to me. Clark, would you like to offer some views?
Yeah, so I recently wrote an article about the 10th anniversary of the first Mt. Gox trade, which was July 17th, 2010. And Bitcoin traded at 4.95 cents per coin. A few weeks later, let's see, on October 8th, 2010, it was a penny. So it's come 5-6 orders of magnitude price increase so far. I mean, the other side of the coin is what's the US dollar's purchasing power at that point? When a gallon of milk is $1 million, then we're all millionaires, but it doesn't mean anything. So I don't know. I think the bullish case for Bitcoin in terms of ever printed, ever devaluing fiat currencies is pretty strong. We've come a long way so far. I don't see, it's easy to say, you know, current price action. It's easy to say, oh, it'll never go 10x from where we are, but you just zoom out a little bit and we've already come a lot more than 10x.
Fair enough. And I can see the wheels turning in Raul's head. Raul, I would love to know your views on this. 10 years from now, where are we?
Look, I mean, I agree with the view that, you know, you can back it out versus gold and you get reasonably large numbers. But let's look at it from a different perspective, because I think we're all familiar with that. It's the adoption curve that I think is really interesting to me, is understanding, having been in that institutional investment world and hedge fund world for the last 30 years, I know how they act. And the point being is at $200 billion, which is what it is now as just Bitcoin, it's not even an asset class, it's noise. But people know that it is serious. Yeah, they know the players involved, they understand how much work is going on in this, and they understand that it has to be on their radar screens. Now, if Bitcoin goes up 100%, which it could do over the next 2 months, you know, it's kind of well within the realms of normal volatility. Well, it's suddenly a $400 billion asset class, and then a $500 billion asset class, and then it matters. And then everybody's essentially short the upside. And we've seen this before, is they all have to pile in. Now, if you have an understanding of the issues that are embedded within the pension system globally, the pension system is dramatically underfunded. We've now essentially just lost bonds as an asset class, because as they trend towards zero or negative rates, forget the negative rates, red herring, everybody's screaming, oh my God. It's not that, it's that they don't work in a portfolio. There's no offsetting ability. So people are looking at gold, but gold is not so liquid. It's a bit more complicated. It will fit in with portfolios, but Bitcoin has that thing. So everybody's eyeing it. The endowments are there. So that's coming. So you've got to think of it that everybody's short the upside. So if it rises, and more people adopt it and it gets bigger. And then obviously as we go over the next 10 years, I don't think we fully get to the 21 million Bitcoin, but what happens is we stabilize in price, because the stock to flow has changed dramatically at this point.
Sure.
So you end up with a stability, and I think this is where it's all going. In the end, whatever that price is, it becomes the global benchmark collateral for a new digital system. So could that be $1 million? Could it be $10 million? Could it be $500,000? Sure. But the point being is we will unlikely think of it in the terms we think about it today. If you think about the digital currencies that are coming for central banks now, we know the world is about to change dramatically. We know this is everything we're all working on is a dramatic change. So it will be a different way, but I have a feeling that there's a good probability that it's the independent collateral for the new system.
I couldn't agree with you more, and especially here in the States with the OCC just approving federally chartered banks to custody crypto, I think that portends a lot to come, and kind of in a lot of similar veins to what you just said. That's also a great segue to the next question, which is kind of, people are inherently interested in the price, but why is the price so important? Raul, you started to talk about it. So maybe you can sort of start us off, and then if anybody else has any thoughts, I mean, what is it about?
Well, because the price is a manifestation of Metcalfe's law, essentially. So what it's showing us is the adoption and the value of the adoption. So as it's becoming adopted, whether it's by the network effects of money transfer, which I don't think is what Bitcoin's core application is, but as a store of wealth, it's clearly going on. I mean, you know, the proliferation of exchanges, the number of people involved, the rapid growth. So I think the price is a reflection of that. I've always called it a call option on the future of the financial system. It's another way of thinking of it, because if Bitcoin goes up, well, the whole ecosystem from blockchain to Ethereum to Cardano to whatever all grows out from this. And so if those things are going to succeed, Bitcoin will succeed. And therefore the Bitcoin price is a call option from the whole lot.
Yeah, in tech parlance, I think it's, we talk about metrics and goals, and I think you have to be careful not to conflate the metric with the goal. And the price is one of the metrics that we should look at, but really the goal is adoption. And the goal is that there are new and better ways of building these systems. So much of the legacy financial system was built and architected from a computer science and software perspective in like the 70s and the 80s. And just the state of the art of technology has evolved so much in the last 40 to 50 years. But the inertia and sort of the lock-in and the network effects keep us locked into these legacy systems. And so, to me, when we start seeing these large numbers on price, what it hopefully signifies actually is that there's real adoption, that there's real value being created underneath it. And that's actually ultimately the goal. And the price is just a metric to pay attention to as a proxy.
I think often you see a lot of people come into the retail space because they see the price move and they get excited. And then after they realize what an amazing technology this is and all the potential for the future applications. And so I think that when the price is high, there's a long tail of adoption that comes from that. And that's why it's so important now, but I don't think that will always be the case.
I think that price also, you get the liquidity volume corresponding to the price. So at 10x, the same quantity of Bitcoin on the order book is 10 times as liquid, right? It takes 10 times as much money to move the market. So that's kind of this, Claire said earlier, the stability aspect. When you ramp the price way up, it takes more money to move it around, you get more stability.
All of that makes a lot of sense. And so I've got sort of a kind of a corollary question to all this is, how important are price predictions in the crypto space generally? And I guess maybe for Bitcoin in particular, I mean, I think we've all sort of talked here about how price can be a proxy for adoption. Price can be a proxy for a lot of other things. So I guess in that context, are price predictions per se important for people, or is that sort of beside the point? Maybe we can start off with Raul, and then maybe Claire would have some thoughts.
Yeah, look, I think it is important. And it's important for the simple fact, to go back to what we were talking about before, is these kind of larger price predictions and the structure of price movements in the past are basically showing people not how much money I can make from it. Sure, we're all in markets and we all want to make money, but it's also the magnitude of the opportunity, how big the adoption is, as we talked about, what it means. Because as Claire said, is once you get your head around, the first thing you get your head around is, oh, this is a great asset class, I can make some money. And then you realize you've only just started your journey and everything you thought you knew is wrong, right? Everybody goes through that. And the price future target, I think Plan B's work is incredibly useful, regardless if he's right or wrong. But it gives you an understanding of the magnitude. And that is what keeps VCs in business, because it brings entrepreneurs to build businesses around it, all of that. If we all said, well, the price is going to stay at about $10,000 for the next 20 years, we would change in what the kind of stuff we did. So yes, I think it's important.
Got it. Claire, any follow-up thoughts?
Yeah, I mean, personally, I honestly don't put any stock in price predictions. Again, I don't think it's going to be zero, I think it's going to be higher. So I guess that's a prediction of some kind, but, there's no day-to-day, month-to-month, year-to-year price predictions that I think really have been turned out to be super accurate over time. It's very hard for people to predict. So many conditions are changing. Plus, we're in a once in a century point in history in several different aspects right now that I think can greatly affect where the price goes. So, for me, it's about fundamentals. Do I believe that this technology, whether it's Bitcoin or something else, has the power to change the world? Is this an amazing technology? And that's why, I got into Ethereum when it first came out, because I thought, okay, this is introducing something really new that's really important. Bitcoin Cash, at the time of the fork, I didn't really believe in it in that same way, because how is this really different from Bitcoin? And to me, at that time, it really wasn't. So I think people, I'm kind of more like a Warren Buffett, values, fundamentals type investor, I think would be my style. And I think a lot of people in retail feel that way as well. These aren't professional traders, and neither am I, obviously. So that's kind of where I'm coming from with it.
Makes a lot of sense. And Avishal, I'm wondering, as a VC in this space, I hear sort of two different things from Raul and Claire about, there is some value in the predictions, and then, well, maybe, for other types of lenses, it's not as germane or relevant. How do you think about this? And maybe some of the entrepreneurs that come to you in the space, how does this all play out for you?
Yeah, so a couple thoughts on that, but I would like to, I want to riff on something Claire just said, which is it probably isn't going to zero. Well, I can guarantee it won't go to zero, because there's only 20 million Bitcoin, and if it gets to $1, I'll just buy them all. So you heard it here first, folks. Bitcoin will never go below $1. So Bitcoin will never go below $1, I guarantee you. So it can't get to zero. Okay, so to your question, how do I think about it? Our core thesis at Electric is this is software eating money, and kind of the breakthrough here, which it took me honestly probably about 2 years to get my head around, is that for the first time ever, the bits inside your computer are money. And it's a very important difference from the bits in the computer represent money, which is how it is in the legacy system, right? There's some database, and there's your bank account, and it says you have a certain amount of money, and then you can go to the bank and get some US dollars. But the bits in the computer being money is a pretty fundamental shift, because what that means is that you secure that money through a private key, which is another set of bits. But for the first time ever, computers can own money. They can take custody of money and value, and they can do value exchange. And so that opens up this whole new universe of people being able to transact with machines, or machines being able to transact with machines. And anytime we've seen that happen, anytime we've seen the digitization of something that used to be atoms and it turns into bits, the market explosion and the way that people deal with that, you tend to get $1 trillion sorts of disruptions, right? Just think about literally any communications technology or any sort of digitization that happened, and kind of the unlocking of value that happened. So our core thesis really is around programmable money. Like, what could you do once you can program money? And if you think about it, a lot of the world is basically, here's a pile of money, and here are some rules around who has access to that money and under what conditions that money can move around. And on some future time horizon, I want you to do XYZ things with this money. And today we codify that in what we call legal code. And we just think all of that gets codified in computer code instead. Like, literally it's called code, right? And that's strictly, if you think about it, the one thing computers are better than humans at is deterministically executing instructions on some future time horizon. And so literally anything that is REITs, equities, bonds, derivatives, wills, trusts, escrow, any of these things that are fundamentally, here's a pile of money and some rules around that money, this just eats up. And it'll take many years to happen. We think it's a 20 to 30 year time horizon. But when you start adding up those numbers, that's at least as big as the internet, if not bigger, in terms of like the net impact that it has on society, because it turns out a lot of the world is just, here's a pile of money with some rules around the money. And for the first time ever, we have infrastructure that is a perfect fit to solve those kinds of problems.
Why do you think it's so slow? I mean, I was surprised by the answer of 20 to 30 years.
Yeah.
Just because of the sheer number of people working on stuff now. I mean, do you not think it might be faster?
I think it's an S-curve. It's a great question. I mean, and I think it certainly could be, but sort of pattern matching to how people, I think there's this human tendency where if you feel like you've seen the future, it feels like it's inevitable. And then it just turns out there are many more people in the world who need to buy in to that future before it can actually happen. So now, before we started our fund, we went back and we read a lot of stuff from the early internet, right? Like 1990s era. Or if you've ever heard Mark Andreessen talk about Netscape, he was worried that he'd miss the internet. And so like the last idea was like this browser, and he's just like, all the good ideas are done. It's like, it's over. And I think, when you've seen the future, if you went and read those articles from the 90s, it's just, like online education, social networks, like real-time video chats, like business is going to move remote. Shopping is going to happen online. Like, libraries don't need to exist. Like all of this stuff people were talking about in 1990. And it really took, I would say the modern internet really got off the ground roughly 2005, like post 2001 crash. and like YouTube acquisition around '04, Facebook happening around '04, '05. That was sort of like the birth of the like realization of all of that promise. And that was like 15 years after those articles. And so if we figure that many of these insights people started to say would be possible, let's say roughly 2015-ish, right, with roughly the birth of Ethereum, and people realizing that you could do more than digital gold, you know, I suspect it's actually 2030 before it's sort of the birth of the modern financial stack in a meaningful way, and then another 10 years, you know, from 2005 to 2015 for that to really sort of go mainstream. But you know, pockets will happen before that, right? Like Amazon was already a meaningful company by 2000, eBay was already a meaningful company, Netscape was already a meaningful company. So, you know, it'll be unevenly distributed. But in terms of like the average person realizing that it's a thing, I think we might still be like 10 years off.
Yeah, makes sense.
But again, it's always risky to reason by analogy, right? So I think there's an argument role that like the world is so much more connected that actually maybe it happens in 7 years instead of 15 because we're so much more connected.
And also, we seem to be in the middle of probably the largest event of all of our lifetimes. We don't know what the economic outcome of, and whether there is a need to sort something out. We can see BOJ, the Bank of England, the ECB all talk about digital currencies. And I think that digital switch is coming faster maybe than we think. You know, one of the things I look at every day is the price of bank shares around the world. I tweet out about it quite a lot over the last few years, but European banks keep going to zero. The Japanese banks seem to be going towards zero. The UK banks seem to be going towards zero. And there's probably a matter of time for the US banks. So it feels like we're coming to some logical conclusion somewhere of something. And the central banks are talking about digital currencies as a way forward. One of the reasons being is they can then disintermediate the banking system themselves because you don't need these banks to be able to give money out. And so then you can do a bunch of different stuff. So it kind of feels like maybe, and again, who the hell knows, could be dead wrong. It feels like there's an accelerant and we're in the middle of it. It could pass and may come to nothing.
Yeah.
And to your point, Raul, that's actually a perfect segue to the next question, which is, you know, what are the factors that will drive us toward $1 million per Bitcoin? If we assume that's true, and I think it's looking more and more true as every day goes on, that banks are realizing that digital currencies, digital assets are a thing that they need to be embracing. You know, what other factors, or basically, what does that do to the price of Bitcoin? So maybe we can start with Clark, who's, I know you've been in the space for a while, having seen a lot of sort of developments. What do you think all this does, and what other factors will contribute to Bitcoin going to $1 million?
So the value of any money is determined by the aggregate reserve demand that each individual has. So it just involves more and more people deciding, I want to hold a positive balance of this thing. And so what precipitates that, you know, mindset change? There are other places on Earth that switch to dollars after their currencies collapsed, and that happens pretty quick. You know, money's a huge network effect, and if you're looking around and more people each day are using a different money, you may tell your employer, hey, I need to get paid in this other thing that people are using. And so I think it's, you know, the process, while it happens, it's one of those exponential processes where once you start turning the corner on an S curve, then it happens so much faster than you think it would have, and I think it could have. But the underlying factors are the fiat money system, you know, being a disaster. It's kind of the short answer.
And how, you know, I guess I'm curious, kind of like Raul was saying earlier about, you know, why hasn't it happened quicker? Why haven't people yet realized that there's this sort of sound money element, and, you know, a lot of the critiques that people could have of the fiat system maybe are addressed?
You can't have 100 volatility sound money. The concept is sound money. The reality is the opposite. We have to be real about what this is, right? You don't tell your grandmother who's 90 years old, you need to stick it in Bitcoin, it's sound money. That's madness. So what we're trying to build is a system that is a future sound money. We believe it has inherent value more than it has now because of this particularly key attribute, but it clearly is not sound money now because it goes up and down 90% in every cycle. So it's kind of a weird old world. And we need to decide whether we actually believe that Bitcoin will be the money of the system or the collateral of the system or a sideshow within the system. And none of us know any of these answers yet. How do the central banks deal with the fiat currency issue themselves? They're not just, I don't think they're going to walk away and go, well, let's go back to a gold standard, or let's go to a Bitcoin standard. I think it becomes a personal reserve, like gold has remained a personal reserve for anybody for as long as the fiat currency system's been in operation. You can always use gold and step out of it. So, I don't know what format it's going to take, but.
So I want to come back around to that in terms of, so we're talking sort of about the bull case, and then the bear case would be maybe if something were to replace Bitcoin. But before we sort of dive into that, I wonder if Claire or Avishal, if you have any other thoughts on what factors might sort of drive Bitcoin, sort of up into the right from here. Like Raul was saying, we have a lot of factors, a lot of different vectors at play here. So just curious if you have any thoughts on the factors that might be sort of bullish.
Yeah, I mean, I think I agree with Clark for the most part. Mainstream use cases and adoption right now for the average retail investor, or not even investor, average retail person, right? I don't understand, how do I use this? How do I get into it? It's still just way too complicated for people. And so when it's as easy as using a credit card, I think we're well on our way, but we're not there yet. And there's a lot of people trying to figure that out. Bitcoin may not be the one that gets us there because of all of the issues with the technology being too slow to really scale in that way. But, and I don't know which one it will be, or if it would be something else. I think having it as a collateral is an interesting idea, but I firmly believe that money will go digital just like everything else. I don't know which one it will be though.
So be curious to know, Avishal, what do you think about that in terms of, I guess, what would be some signs that there are other assets coming up to sort of challenge Bitcoin, and what would sort of make it less appealing to be, the asset that sort of, kind of drives the conversation from here, if any?
Yeah, I mean, there's still, when we think about risks, in some sense, I think the question you're asking is like, what are the systemic risks here? And I think there are technology risks, I think there are market risks, and I think there are regulatory risks. Technology risk, for example, is perhaps the CPU-based proof of work approach just doesn't continue to scale for some reason. Maybe we've hit diminishing returns on ASICs or power, or whatever. There could be edge cases here. I think there are ways to mitigate that. People are experimenting with proof of stake systems. There are things like proof of space-time, which is still a form of proof of work, but uses hard drives instead of CPU, and people are bringing that research to market, companies like Chia or projects like Chia and Space Mesh. So there's an entire category there. And the second category around market risk, I think, is really, does it turn out that the path to success, in effect, the go-to-market strategy is one of digital gold, or it actually does something like Ethereum, which allows you to have decentralized finance or generate yield in a zero interest rate world, turn out to be the killer go-to-market? And then, on the regulatory, I think there's some significant open questions. And actually, Bitcoin has a pretty significant advantage here, right? It's only Bitcoin and Ethereum have really sort of gotten the regulatory thumbs up as being not a security at the very least. And so, some degree of okay from at least US regulators, though other countries are less or more okay with it. And so when you look at those risks, the way we think about it is, how do you mitigate across those risks? And so there are ways to mitigate across those by investing in other approaches. But when we look at kind of our investments, it's still far and away, you still have our largest position is still Bitcoin. Just even on a risk-adjusted basis, that's where it just has such a lead in so many ways. It's hard to imagine something in the short term replacing it. But again, if you take a 15 or 20 year time horizon and you believe we're in the very early days of this, 15 to 20 years of compounding from something starting from a very small base to compete with Bitcoin is still, there's a long runway here. It's also worth mentioning perhaps that it's not necessarily winner take all, right? If you look at even the existing fiat system, there is a winner takes most dynamic. And so it is not necessarily the case that if Bitcoin wins, everything else must fail. And or you look at something like social networking, which is a highly liquid network effect business. And Facebook, of course, won big, but if you were in the seed round of LinkedIn or Twitter, and you ended up with a $25 billion company, you still did quite well. And so, as investors, we sort of risk mitigate, but we also take into mind that we don't think there's going to be a power law here, but there are more than one way to win.
I'd like to riff on this if that's okay.
Yeah, please.
So two things, proof of work and protocol. So proof of work, I would say, if you notice a challenger gaining a significant fraction of the total energy dedicated to proof of work, then that could be a sign that you've got a serious challenger. Bitcoin is far and away the most heavily spent, energy spend for any network. So I would keep an eye on that. I haven't looked into proof of stake enough to know if it's actually possible or not. I know that a lot of people are thinking about it very hard. It sounds nice. I just don't know. But then the protocol thing, the winner take most argument, I'm not sure I buy it as far as if it's money. You had bimetallic standards throughout the years, but that was only due to the actual divisibility of gold or silvers. You had like copper coins for like little tiny values. You couldn't actually split a little sliver, a little shaving of gold and like have it be accurately weighted, but you can with the digital money. And everybody wants to use the currency, right? The most saleable good used during transactions. So I just don't know in like any specific society if you'll have competing cryptocurrencies alongside one another. I think that's a big open question, and you have to look at, like, you don't have competing say power protocols, right? You've got one type of plug in your house, and that's all you've got.
No, because globally you've got tons, right?
But in one area, it's
and again, so Europe has changed all of its protocol, but the UK, being typical of the UK, didn't. It's got
like
the US has another, India has another. I mean, it's a total shit show globally. It feels that the fragmented world is typically human, right? We're tribal. We want to have not only our tribal attributes, but we also want to have our sovereign, some sort of sovereignty over our money, which basically means the ability to tax. So it kind of feels like whatever this world is, it's a mishmash world of a load of things, which is phenomenally exciting because you get loads of opportunities, because loads of things go from zero to a lot. What they are, I don't know, but that's why it's a very exciting space to be, to be a VC in this kind of environment, because there's lots of zeros to 100 out there, and it's not a winner take. I don't think it's a winner takes all. It could be. Again, who the hell knows what we in 30 years time? But it just feels like, we're so lucky. As I said, I've been in the financial business for quite a long time. It's like to be given an opportunity this big. I've never seen before. I've literally never seen anything like it.
On the protocol thing, you kind of have a winner take all with something like HTTP, right? We have any browser on Earth can grab a website from anywhere else on Earth. Yeah. That's a kind of digital first protocol.
And I'm not so sure that I don't even understand it well enough to figure out what are the protocols we actually need for this new world. I don't even know, but I kind of figure that Ethereum probably plays a big part in it. I think there's a bunch of things. Somebody's going to figure out how they can all speak to each other. That's the other thing, the interoperability. I think that will get solved in certain ways.
So Clark, I actually think the internet analogy is a really interesting one. And you might argue, I mean, if you look at, say, modern internet, right, post 1990, let's say, that we're roughly 30 years into it, and I think there's an argument that we're refragmenting, right? China kind of has a great firewall and has its own separate internet, basically. India just banned a bunch of Chinese apps, and a bunch of American companies invested in geo to the tune of tens of billions of dollars. Europe has GDPR, which creates its own sort of challenges for companies, and so you might actually be ending up with like 3 or 4 internets here. So actually, I mean, I think the internet analogy is very apt. Is that like there was a period of time where you had global liquidity in essentially one protocol, and then once it got big enough to matter, governments got involved, and governments have their own interests and started sort of segmenting it. And I wouldn't be surprised if money behaves the same way, that for 20 or 30 years it sort of is not big enough to matter. And once it is big enough to matter, then the regulators sort of get involved and they start slicing it up, and then you end up with maybe like 3 or 4 big winners. So I actually think the internet analogy is very apt here.
So speaking of the regulatory sort of side of things, just briefly here, and also to Raul's point about how just massive of an opportunity and how big of a sea change we're all getting to live and work through, which is just phenomenal and amazing. I'm kind of reminded of sort of the separation of church and state. And I wonder if the separation of state and money is a thing that governments will allow, quite frankly, or is it something that will have to be sort of forcefully resolved, for lack of a better word. Any thoughts on that? Maybe Raul, you want to start us off?
I think it exists already, right? You know, rich people buy art and cars and they're outside the state, and, you know, we can all buy gold and it's outside the state. So to have Bitcoin or whatever, any digital currency outside the state is fine. But if you want to live in a state, you'll end up somehow having to transact with the state. And that means taxes. And that's okay too. Unless you live in the Cayman Islands, where I live.
The established church served an important function as well in partnership with the state. So the church or the local witch doctor or whoever is the chosen, you know, appointed by the state to be the one way. And they in turn preach that obedience to the king or the chief or whatever is godliness. Or maybe the chief is God himself, you know, so that disobedience is now heresy and you can be thrown into the volcano or whatever it is. So I think that that role has been replaced by the intelligentsia, the economists at the Fed, the blue ribbon panels. They serve the same function as putting a scientific spin on what the state wants to do, like Keynesian economics, right? Oh, print, it's the solution to every problem. Oh, that sounds great to us too, right? So it's kind of this, we fund academia, you rubber stamp all of the things we want to do with a scientific stamp. And that's replaced kind of the role of the church in, you know, compliance with the king or whatever is obedience to God. Oh, those are the same thing, you know. So I don't know. I think it's a new. We've replaced the church with scientific management of the economy.
Any other thoughts?
I do have some thoughts. I have a whole rant, but I don't know if Claire has thoughts, and I didn't want to rant for 5 minutes without giving her a shot if she had any thoughts on this.
So we have about 20 minutes left, and I'd love to leave time for some audience questions, and then one other question I've got for you all. So in that context, Claire, please take it away.
Yeah, I mean, I was just going to say before, you know, I think kind of riffing on what we were talking about, the previous question as well, like there is a global reserve currency though, right? And it's the US dollar. So yes, we have pounds, we have euros, we have dollars, but you know, if I go to most countries, that US dollar is going to have a lot of power, you know, Bitcoin or whatever it is might be that same thing. And I think about this idea of separation of church and state similarly. I also think that there may not be as many governments as there are, you know, long term. We may not have, you know, 270 countries. We may have 20 or, you know, 100. Who knows, right? But I think there can be some consolidation as well, especially for countries that aren't able to financially support themselves. So I think in those scenarios, this cryptocurrency, you know, may become that reserve currency for a lot of these states, in which case the state actually has a vested interest in allowing that to go forward. Just like in a lot of states that have trouble with their money, volatility and so on, right? They are happy to have US dollars in the system, or if they're not happy, you know, they risk a lot of disruption if they don't go along with it. So I think there's some potential for that as well. But I do want to hear the rant. So
okay, I'm gonna so two thoughts. Actually, I mean, I think the points around reserve currency are spot on. And you know, you look at the numbers. It's, you know, the U.S. dollar is something like 65% of global reserves, and the euro is 15 to 20%. And so you do kind of have a very interesting power law, even with global currencies. You know, the yen and Canadian dollar and so on. But, you know, I think kind of what that touches on even is kind of the game theory of this all. And so put on your, you know, I think there are a couple of different actors here. There's the US government, there's the Chinese government, there are the European governments, the EU, and then there's this sort of decentralized crypto universe, Bitcoin included. And, you know, I think the interesting game theory here, if you're the Chinese government, is you have your digital RMB initiative happening, and you are potentially cut off from doing a lot of what you want to do because of the US dollar system. And so you have an incentive to try to push your digital RMB system. And if your RMB system works, great, you win big. And so they're going to invest in it. They're going to push through Belt and Road, and it's really smart. I mean, they're to their credit, the Chinese government is phenomenal at investing in technology and embracing it and using it. But you know, what is the next best alternative? Well, the next best alternative is likely not to continue to exist in a US dominated system. The next best alternative might actually be to support the decentralized ecosystem and allow that to flourish such that it actually serves as a counterbalance to the U.S. system in some form, and continue to sort of diminish that percentage of country reserves. The U.S. dollar used to be 75% of country reserves, and so it's losing share. And so can you get something in there that is another 10% of country reserves and gets the US dollar to 50? And so the Chinese government actually has a very strong incentive, in my opinion, to support the Bitcoin ecosystem. And the way they'll do it is they will likely support the infrastructure behind it without letting their citizens own too much of it, because they care about civil unrest. So they don't want their citizens to own a ton of Bitcoin, but they're very happy to have ASICs designed there and have miners there, because that allows them to continue to support this ecosystem. Okay, so if you take that and you play that one step forward, you say, okay, well then, what does that mean for the US government? And I actually think what that means for the US government is obviously they have to try to invest in some sort of digital dollar as a counterbalance to digital RMB and to support the existence of this US dollar-based system. But they also have to acknowledge, you look at something like healthcare.gov, it's not like the US government executed well on that. And so they don't have a great track record of building high quality software and shipping it on time and making it usable. And so what is your next best alternative? Is your next best alternative to let the digital RMB system win? No, probably not. Your next best alternative actually is to embrace the decentralized crypto system, because so many of those VCs are already here in Silicon Valley. So many of those companies, the biggest companies in the world, are already in the US. And so actually what you really want to do is embrace the crypto system and allow the US dollar to be the fiat on-ramp and off-ramp into that system, so that you can continue to use the tools that you have to do AML and KYC and so on. So actually, I think if you play this out, the separation of church and state, I actually think there's a natural equilibrium where governments, by virtue of having to compete against each other, actually all end up having to support a decentralized system, because it's like the second best alternative to the existing system, or the alternative of the other government winning. So I'm actually pretty bullish. I don't think it ends up being a total separation of church and state, but I think you actually end up in a system that like the crypto ecosystem ends up coexisting with the existing fiat system, because the governments kind of have to support it because of the game theory of it all. But that was me pretending to be a macro guy, and Raul may very strongly disagree with me.
I think it makes sense just from what you say is the second alternative. Look, we don't know yet what the digital currencies mean and how they're going to apply them and what it means for the SWIFT payment system, all that stuff. So we don't really know a bunch of this stuff, but you can see it already is Silicon Valley and the finance guys who've all got into this new space have basically gone to the government and said, you guys cannot let somebody else win this battle because it's so powerful. And I think the US understands that now. I think many of the other larger countries understand it now. I think, Russia not banning it now. I think the Russians clearly understand what this is all about. And within the game theory, they would love this to be adopted because it helps them massively. And I think the same as you just said with the Chinese. So I think it's dead right. It won't stop them putting their own interests first, but they'll have a second bet on this too, to make sure. Yeah. And we can see that with that custody situation that happened last week. Okay, that's really meaningful. They basically just green lighted everybody to be able to custody digital assets.
Totally. So we've got one more question here, and then we've got some questions starting to come in from the audience. And by the way, let me just go ahead and invite the audience to go ahead and submit some more questions if you have them, and we'll try to get to all of them, time allowing. So before we do that, though, kind of last question for me here is kind of if you could each sort of provide just either your or your company's perspective on the industry overall, if you've got sort of a long-term vision for BTC and crypto and the blockchain and sort of how that all plays together. So just sort of big picture views, either for yourselves personally or for your companies or both. So Claire, maybe you want to get us started there?
Sure. Yeah. So, I mean, obviously both myself and Gemini are long-term bullish here. I think, short term, I expect to see a lot of professional trading still dominating. Like we were talking about before, I think the retail audience, they're coming, but they're not there in the numbers that, I would like to see. But trading is just one small aspect of what I think, will be part of this ecosystem. So one thing that happened to be really successful at Gemini is we launched a digital art platform, which was NFTs. We call it Nifty Gateway. Back in March. So the timing we thought would be horrible, but it ended up being amazing because everyone was suddenly not able to go view any art in person. And they've, broken some records for the price of their Nifty sold. And they've just, been very successful in just a very short amount of time. And I think all of these amazing use cases we probably haven't even thought of. This panel represents several people who have spent, basically their entire careers on this, and we haven't figured it out. It's such early days, which I think probably you all feel. So, I think trading is going to dominate the conversation in the industry today. And then I think the next applications of money, right, will have decentralized banking, decentralized finance, earning interest, staking, all these things. But I think long-term, there's going to be a lot of applications outside of just money and payments. And I don't know what those are, but I think those will easily be, million, trillion dollar industries, a couple decades from now.
Makes a lot of sense. Clark, you want to share some thoughts in terms of sort of the big picture here too?
I would say that from my experience, I would say that this is a retail-led phenomenon so far. So kind of the other side of the coin, and we haven't really seen like real institutional interest, sovereign wealth funds, gigantic pension funds, things like that. So I may just throw that in there. The other thing is, we're getting a lot of this legitimacy stuff, the custody rules and things like that, making it easier to deal with this, and legal for large players to hold on to it. So that's a big ball that takes a long time to get rolling, but I think that it's tipped over the precipice of the mountain. So
here, let it here's to it continuing to roll. In the meantime, Raul, any kind of big picture thoughts for us?
Yeah, my involvement in this space came from understanding what happened in 2008, but really from being on the ground in Europe in 2012 when we almost lost the banking system. Right, when that goes through your head, that here I was living in Spain, and we were about to lose the banks, and eventually the ECB had to force Spain to borrow money over a weekend to save the banking system, which was going to collapse on the Monday. And realizing that the whole thing was a mess, the collateral at the heart of the system was rehypothecated when it claimed it wasn't. So in the middle of the DTCC and Euroclear and all of these things that most people don't know anything about, I got stuck into all of them, and it's a mess. It's a mess on who owns what. It's a mess in leverage. It's a mess at every level. And at that point, I realized that we need something different. So I was trying to set up a bank at the time, back in maybe 2013, which was trying to be the world's safest bank that had no leverage, that if you deposit capital, it's held in US government bonds and a bunch of stuff like this. And it just was complicated trying to buy a bank in various countries. I tried Singapore, we tried in Europe, we tried all over the place, really hard. Anyway, a friend of mine introduced me to Bitcoin. Obviously, we'd seen the headlines and stuff like that. So around the 2012 period. And then I realized that this was coming. Now, what is interesting about this space, so here's me, I come in from this angle. People come in from different angles, but what is incredibly interesting, never have I seen a black hole like this. So where all the smart guys in technology are all getting sucked in, the smart guys in finance are getting sucked in, the kind of philosophical thinkers, the kind of non-mainstream economics people, everybody's being sucked into a space which is like a super black hole of talent. I've not seen anything of this magnitude before, in terms of the sheer number of people and the size of the outcomes. Because when you started in the internet, we didn't know the outcomes, but we know how big money is, right? Money is one of the oldest things on earth, and we know the size of it. And as Claire says, it's not just about money. I mean, everything is going to be tokenized, and literally everything. The whole digitization of assets, none of us can get our heads around. Maybe an 11-year-old today who operates online has a better idea than we do of what digitization and the value of digital assets is. But everything is about to change, and it's a platform change of money and value, and that's extraordinary.
That's it? Just a change in money? I mean, that's all. That's tremendous. I could not agree with you more. Avishal, would love to know your kind of big picture thoughts, what's going on with your firm and that sort of thing as well.
Yeah, I very much agree with what Raul was saying. Is I think, as mentioned, I think this idea of programmable money to us as the core thesis, that part of it is clear. In some sense, it's sort of, there's this snowball that formed, and the pebble at the center of the snowball was Bitcoin, and the snowball around it we can kind of see is all these decentralized finance applications and programmable money, as we call it. To me, though, I think if you sort of extend that forward and abstract it even more, what you have here is a different way to build software. And to us, one of the things as technologists that gets us really excited is that it makes fundamentally the opposite set of trade-offs to the internet. Right? The internet was about speed and scalability and throughput. And to achieve all of those things, we gave up our privacy and we gave up data control to these central parties, and so on and so on. And actually, these systems do the exact opposite. Right? We can retain our privacy. We can control our own data. Computation can happen at the edge rather than on these centralized servers. And so in many ways, it's just the opposite as a software platform. And if you look at the history of software and computation, it goes through these oscillations. It goes through these pendulum swings, right? It goes from mainframes out to the edge on PCs, back to servers, back to mobile, back out to the edge. And every time that happens, you get these massive changes where actually the core applications that kicked it off end up being really big, but they end up having second order and third order effects on a lot of other things. And so, we're fairly confident in the programmable money thesis, and that's where we invest today. But when we play it out even 20 or 30 years, we say, well, what happens as this becomes just the standard de facto way to build software? And what are the kinds of industries and places that it touches? So for example, this might actually be an interesting way to think about a network of self-driving cars, right? And self-driving cars that are, edge nodes on the distributed system, how do they communicate with each other? And what do they need to do? And does some of the software apply there? Or, we're talking about, art, or we're talking about video games. Like some of these technologies actually spill over into these other areas in very interesting ways that I think we haven't even seen yet. And so that to us is the even bigger potential here, is actually it's just a fundamentally different way to build software. And we don't yet know, I think, what it'll unlock. And it'll probably take us several years to really get our heads around it.
That's tremendous. Appreciate that and very much agree. We've got some questions coming in from the audience here. Let me just do a quick time check. We've got about 5 minutes left. So the first question here is, it's about ETH version 2. When will that happen and what could it lead to? Let's see, Claire or Clark? How about Claire? You want to start us off on the second iteration of ETH?
Well, Clark's probably the better person to answer this as a software engineer, to be honest. But I mean, phase 1 is happening now, basically this year, and it's going to happen over the next 4 or 5 years to the timescale horizon. What could happen? I don't think I know the answer to that. Probably no one does. I've always been very excited about ETH. I just think, obviously, smart contracts were such a step forward for the entire ecosystem. And it's something I think about, practically on a daily basis, is how we can leverage those to add more value to the ecosystem beyond, payments and things like that. So that's obviously the core right now. But yeah, I mean, I can't say that I have a strong prediction right now about ETH 2.0, but maybe Clark, you might. So let me defer to you.
Yeah, I spend most of my time looking at Bitcoin. It's a deep enough rabbit hole for me. However, I would like to see a prediction market that ETH 2.0 actually launches. That's all I'll say.
I have some thoughts since I spent a lot of time in ETH land and ETH alternative land. I think ETH 2 is a fascinating experiment. TBD when it actually launches. There's some really, really hard technical problems that they're working through. More macro, I think the challenge, setting aside the technical challenges, which are non-trivial, and there are lots of people working on solving them in different ways. For example, the Near team is working on many similar sorts of technical challenges, and they're rolling out this fall. Things like cross-shard communication, very challenging. Things like, will proof of stake, we touched on this earlier. I think Clark was talking about this. Like, does proof of stake even work? We kind of don't know yet. We haven't really tested the edge cases, right? It's new technology. It's new economic technology. But I think, that one of the things that's really underappreciated about ETH2 is actually how successful ETH1 ended up being. And actually the sheer amount of liquidity that's gone into ETH1, right? And imagine you're one of these protocols, one of these decentralized protocols that has, take like Maker, for example, which has $1 billion of ETH locked in it. Are you jumping up and down to move to ETH2 as soon as it's launched? Like, probably not. right? That's actually a huge risk to take to want to move $1 billion of Ethereum over to ETH2. And so there's kind of this interesting race against the clock, which is that ETH1 keeps getting bigger and bigger and bigger and more successful and more successful. And so in a funny way, actually, the biggest competitor to ETH2 is actually ETH1, because it actually hit product market fit in a way that nobody expected and got to scale in a way that nobody expected. So I actually keep an eye on, ETH2 may not end up being successful just because it can't outcompete its own ETH1.
Very interesting point. And I've heard many people talk about the same thing, about the sort of challenge of jumping from one to the next. Another question here from the audience, in terms of digital currencies, central bank digital currencies, how soon can we expect a digital euro or even a yen token, for example? Any thoughts on that? Maybe Raul, you want to start us off on the sort of timeline for that?
I think it's coming fast. I don't know, but my guess is within the next 2 years. I mean, it looks like the Chinese have got something off the ground already. India has a whole digital payment system that almost everybody in this space doesn't realize what India's managed to achieve, which is astonishing. 1.3 billion people on a instant payment system, which is basically operates without much of a middleman, without the whole banking system, all of this stuff. So look, it's happening fast, and I think faster than we think. So I think within 2 years, we'll have some form of digital currencies. What they're used for, how they're used, I have no idea yet.
And do you think that they'll have sort of upward price pressure on Bitcoin necessarily, or unknown?
I think they're just think of them as digital fiat. They will have the ability to distribute in highly targeted ways, which is quite useful for central banks that now have no interest rates to function at. So they have to push money through the pipes. So that works quite well. I think that it creates digital on-ramps and off-ramps. It just accelerates everything. Because it's a lot bloody easier. I mean, it's an absolute nightmare setting up. For me, the Cayman Islands, to open a Kraken account, I mean, it took me 7 weeks. I mean, it's crazy. Why nobody started a KYC independent business, I've literally no idea. The amount of times you have to do KYC when somebody should put it on a blockchain, centralize it, update it, as they do in India with India Stack, where I can go and buy a pint of milk with my finger, or I can open a mobile phone account or a bank account with a fingerprint or a retina scan.
Totally.
But right now we have to do this KYC. It's nuts.
A lot of people have tried to do that, I think, and they haven't been successful because the problem is getting other people to accept your risk thresholds. If I KYC Clark and I say, A+, let's onboard him, but then, Kraken doesn't agree, for example, what are they supposed to do? So I think that's kind of always been the problem in that space.
We kind of accepted PayPal. I mean, it must be solvable, and it would accelerate everything overnight, because the whole digital world, you have your own personal.
It's a regulatory issue, though. Yeah, it's because PayPal absorbs the risk. That's the difference. Right now, if I onboard someone who's a bad actor, I have to bear the responsibility.
So the easiest answer is the state should do it. Your passport should be KYC.
Totally.
Which is what it is in India with the Aadhaar. You have one identity that gives you everything.
Yep, guys, this is such a fascinating conversation. I want to thank everybody. We're going to have to wrap up. The next panel is about to start. But as I suspected, this was such a fun call, fun conversation. Thank you all. Hopefully our viewers got some good value. I'm pretty sure they did. And thanks again, everybody. And we'll I guess, leave it here.
Thanks, everybody.
Thanks, everyone. A lot of fun.
Take care.
Bye, guys.
All right, what's going on, everyone? Welcome to this next panel. I think it's the last one of the day, and we're going to be talking everything you need to know about cryptocurrency baskets, or sectors you might know them as. I'm joined by a pretty all-star panel here. We have Brian Melville, Director of Strategy at Cumberland DRW. Thanks for joining us, Brian.
Sure.
We have also George Saman, Crypto Advisor. How you doing, George?
Hi, how's it going?
Doing well. All right, and Matt Hugan, who is the Head of Research at Bitwise Asset Management. Thanks for making the time, Matt.
Thanks for having me. Glad to be here.
Of course. So what I wanted to dive into today with this topic, breaking down everything that the retail investor, also I imagine there's some larger investors need to know about this. And crypto is unique in the sense, well, it's unique for a lot of reasons, but our product offering and how people get involved is also quite unique. So it makes sense that the products we offer are a little bit different. And think about equities. There's a large percentage of investors in equities that just buy an index, or they can buy a sector. That's quite easy to do. In crypto, not as much. So I want to kind of go over what's the current offering today for the average investor looking to invest in crypto baskets. Matt, I know you guys have done a ton of research over there at Bitwise, looking at volumes, looking at who's buying and what they're buying. I believe you even have a application in for an ETF index. What is out there today? What's the current product offering?
Sure. Yeah, there are a number of firms out there offering basket or index strategies in crypto space. Bitwise was fortunate to launch the first, and we run the largest crypto index fund, sort of the S&P 500 of crypto. But there are other firms out there doing it as well. Galaxy has an index fund. Grayscale has an index fund. They differ a little bit. And then as you move on down the spectrum, there are more crypto native offerings that are more sector specific, although those are really still in their infancy. So we're just at the early stages of penetration. I think the space is going to be massive. I think just like in stocks, just like in bonds, just like in commodities, eventually a strong majority of people will get their exposure through index-based products. But it's going to take a while, and we're still in the earliest stages of that.
That makes sense. Brian, what do you see on your side? You have your hands in a lot of the different markets happening here in crypto. What do you think investors want if they were to have kind of their selection or the best case scenario of how they can invest in different sectors and baskets? What does the market want?
Sure. I think, Matt kind of harped on the fact that there's already a variety of different options that exist in the traditional markets. And right now, most of them aim to just give kind of a broad overview of exposure to the entire space. Whereas, I think the crypto native market, or more specifically in the DeFi space, we've seen, specific baskets that represent a certain part of the market. So giving them, exposure specifically to, DeFi tokens or privacy tokens. And I think people want options most of all, to be able to select, what's the best option for them.
George, any thoughts there?
Yeah, so what I'd say is that, like, for most of the time that crypto has been around, it's been pretty hard to get baskets together because it's been such a nascent asset. And as a result of that, there hasn't been, like in the traditional space where you have sectors, right, like that you can invest in via ETFs. We haven't really had that yet in crypto. Most of the offerings have been around like top 10 type of offerings for like the top 10 type of coins and whatnot. But now what you're finally starting to see is exchanges like, for example, FTX are offering indexes, which are perps, which are different types of indexes for different coins that people might want. They actually have a DeFi index, they have a shitcoin index, different move contract. And while these aren't exactly traditional types of baskets in the sense that they're ETF structure, they're more around a futures product, which has different risk profile to it. You're starting to see offerings there for products like that. And that's really what traders want. I think as the industry itself matures, though, you'll start to see more sector-like baskets start to form. But you need more companies working on the same types of or similar types of sectors, which you're finally starting to get this robust universe of products out there and companies working on things. So, whether it's DeFi or oracles or anything else out there, you'll probably start to see more and more baskets form.
Mm-hmm. I was just going to hop in. The interesting thing about baskets, particularly when you get in the sector space, is you have to find the right kind of investor, right? You have to find an investor who doesn't have particular enough opinions that they want to pick individual projects or companies, but doesn't want just a broad-based exposure to crypto. So you really need that narrow slice. And I think that narrow slice emerges at times like this, when you have big, powerful trends in the market. Certainly over the last 2 years, the recent run around DeFi and the sort of exploding interest in that area of the market is the first real sector-based trend that I've seen take hold and sustain itself with a relatively wide audience. So I think if you see that sort of sector-based performance and sector-based excitement continue, you'll start to see these individuals emerge who want to make that sector bet, but don't want to get so cute as to pick individual projects.
That makes sense. Go ahead, George.
No, sorry, I was just going to add to that. DeFi in and of itself can even be considered a basket for multiple reasons. One being that you have projects that are building on top of each other, composability, so different projects are using each other to build out things. And then you have these pools of assets that through yield farming, where you are basically getting some kind of ARB opportunity and a yield opportunity and get tokens as a result of coming into a pool with other investors and putting money together to make liquidity. So, and that's pretty much a really new phenomenon, probably over the last, 4 to 5 months, it's really started to take off, and you're seeing some really juicy things happening there where it's not even like going out and trading, tokens and in a particular like token, but really just pooling your money and getting a different kind of return out of it.
Yeah, one of the challenges though, if this continues to accelerate, and especially if we have the sector performance like we do out of DeFi, as more and more investors want to participate in these baskets, some of the challenges in crypto that are unique are, let's say a coin gains 500% this week and it jumps into an index, and then next week, it bounces right back out. It's down 60%. What are some of the challenges that crypto is going to have to overcome if we do want to have an abundance of these offerings, if we do want to let the investor and the trader have that choice to be exposed to a particular sector? What's the biggest challenge going forward? Anyone take that?
Yeah, sure. I'll start, Matt, and then I'll hand it off to you. From our perspective, Cumberland serves primarily as a market maker in the space, on exchange as well as in an OTC capacity. And so our objective is providing liquidity that meets the demands of institutions, of anyone who we're hoping is going to enter this space in the next few years. When we talk about how are some of these products going to become successful, you harp on like a great point that some of these constituents or these components of the basket are illiquid and not able to easily be replaced with another component. And our biggest concern is performing our role in the market and providing liquidity as best as possible.
Yep. And I would just add, the beautiful thing about this is we don't have to reinvent the wheel. So there's 40, 50 years of history in indexing. I used to run an academic publication focused on index investing, and there are rules in place in other asset categories that can be applied to crypto. So to take that example, Luke, one thing we have in our index, the Bitwise 10, is buffer zones, so that it's not just the top 10. If an asset is number 10 and at the end of the month, it just squeaks down to number 11 and something else comes right above it, it doesn't replace it. It has to move a substantial amount so that it's economically important to make that switch. And so you can tamp down liquidity in that way. Now you'd have to expand that as you went into sectors and have bigger buffers, but that's just part of adapting to an asset class. And whether you look at commodity indexes or certain sector indexes, they all have different buffer rules in the equity space or the commodity space to handle that sign of volatility. So you need sophisticated indexes. Indexing sounds like the most boring thing in the world, but rules like this are important. Even in the top 10, if you did a blank rating of the top 10 assets on CoinMarketCap, it wouldn't look very similar to our top 10 assets because there are a number of assets that don't have real liquidity, that can't be custodied, that have fundamental security flaws. And so you need smart indexes in crypto to weed those out. Even if the idea is to make it simple on the outside, on the inside, it has to be pretty sophisticated.
Do you think these challenges are mostly going to be solved by DeFi or by centralized finance? Because both have kind of a bumpy road ahead. On the centralized finance side, obviously they can move quicker. It's easier to use, better UI, but they have some regulatory problems with trying to create these indexes. On the DeFi side, they can basically do whatever they want. And there's companies and protocols like Set Protocol. They now have a DeFi token you can buy. Who do you think solves this kind of gap in the market as traders want to buy sectors? Who comes out with more offerings in the next year, you think? DeFi or CeFi?
Well, just based on the rapid innovation happening in the DeFi space, it's definitely going to be DeFi. But from a standpoint of solving the problems of, I think that's still yet to be decided. DeFi gives you tremendous transparency into like every aspect of the token itself and whatnot. CeFi sometimes lacks a little bit of that transparency, just from the perspective of, it's not all on chain and you can view and see things and whatnot. But I would say from a standpoint of what's easier to use, CeFi probably is still a little bit easier, much more well understood still. The DeFi stuff is not for the layman. Even just to like put your money into any of these pools or to understand actually what most of these protocols or applications being built on top of other applications are and how and what exactly you're buying and getting out of it. We've already seen a couple of times where sophisticated hackers have been able to come in and steal funds and whatnot within some of these projects. And, that's more like, auditing and stuff like that. But it's still at a point where I'd say like DeFi will be rapidly innovating more, but CeFi probably still has some advantages. But most CeFi exchanges are also starting to move over and make DeFi products as well alongside them, potentially with the thought process of replacing themselves over time and remaining relevant within the crypto space. So yeah, that's kind of where I see it at the moment.
Yeah.
Go ahead.
Brian,
Matt.
go ahead.
Echo the same thoughts. The time frame is the biggest question here. I think in the short term, CeFi is already has a very strong grasp of infrastructure already set up. Everyone has accounts. It's very simplistic, safe, and very clear and easy to use. And our hope is that we'll see that level of adoption in the CeFi space over the next year or two. But I think in the longer term, there's certainly significant benefits that can exist in the DeFi marketplace that are hard to overlook. And it's expected that in one way or another, they will have kind of a real impact on how these markets develop.
Yeah, I agree with all of that. I think there are certain challenges in the DeFi place to make some of these rules purely algorithmic with no discretion on top of them, because so much of crypto data is somewhat chimeric and difficult to get your hands around. And there are many edge cases, sort of hard to identify all the unknown unknowns before you set something up. So I think that's going to be a challenge, but I still think we'll see enormous creativity out of the DeFi space, and it will be fun to watch.
Yeah, it's going to be a wild ride here for the next 6 months, year. Innovation doesn't stop. Now let's look a little bit at performance and the correlation among these assets. That's another thing that's a bit unique here, different in crypto. In equities markets, you have different sectors which can move at different times. You have industrials versus consumer versus tech. In crypto here, as Bitcoin rises, generally everything rises, and as Bitcoin falls, generally everything falls. As kind of a risk on, risk off trade. Do you think as we evolve and mature as an asset class, do sectors start to behave differently? Like right now, we have DeFi doing incredible. Are we always going to have kind of this sector outperformance, sector underperformance, or will we always move as one here?
Yeah. Go ahead, George.
Sorry. Okay. Well, what I'd say is that we're still super immature. And just to clarify something, generally when Bitcoin moves up, the altcoins move down pretty harshly, especially if Bitcoin rises very fast and in a volatile fashion. So like a lot of the time, you'll just see things correlating where everything goes down when Bitcoin or Ethereum start to rise rapidly. I thought maybe like in the next move up, based on how much more infrastructure and like how much further we've gotten along in crypto, that you might not see these moves happen. But just in the last couple of days, as Bitcoin has started to like rise again, pretty fast and furious, the rest of the sectors have fallen again versus Bitcoin. And then when Bitcoin settles down, the moves, people come back in and they'll buy the other assets as well. So it's still pretty much an immature class in the sense that like everything rises and kind of falls based on what Bitcoin does or doesn't do.
Yeah, I have two thoughts on top of that. One, I kind of agree that I think I hear those comments a lot from the investors we talk to, but I think they're somewhat overblown. So in the equity market, investors talk about diversifying out of US equities into international equities. And the correlation between US and international equities is higher than the correlation between Bitcoin and Ether. So if we say it's fine to diversify your stocks into international stocks, then it's also fine to diversify your crypto beyond Bitcoin. So I think people are setting too high a bar if they expect correlations between Bitcoin and other assets to be 0.4. They're going to be 0.6, 0.7, 0.8, 0.9 because they're all crypto assets. I do think, and I agree with George, over time, we're going to see more sector-based performance. So if you think of the returns of crypto right now, you have a giant, massive crypto risk factor that's the primary driver of all crypto asset returns. And then you have their actual penetration into the market and their unique success in their use cases. And that's a minor driver of returns right now. But as they penetrate further into the market and as the risk factor come down, that pendulum will shift. And I think we will see more distinct sector performance because they'll be further into their use cases. Just like you see in any area of the market, when that risk factor is giant, it overwhelms the sector-specific performance. But over time, that risk factor will come down and sectors will be more distinct, which we're seeing right now in the DeFi space.
Just one thing to add to that. Another factor I think that will kind of be like a tell for that is the Bitcoin domination index. You want to see that fall down a lot more than it is now. And then obviously that means that the space itself is growing tremendously versus Bitcoin, and that probably the correlation between all these assets versus Bitcoin when Bitcoin goes up or down won't be as great as it is now. Right now, the Bitcoin domination index sits at what, about 62, 63%, maybe something along those lines. That's really, really high for any sector that exists in the entire world. So I think you need to see that thing start falling over the next, 2 to 3 years, depending on your viewpoint on crypto and maximalism versus not. You might think it's going to rise or not rise, but that's really going to be the telltale sign as to, how the correlations moving forward either, are bigger or smaller.
Right. Yeah, just to throw one last data point. I love data points. We have a top 10 index, top 10 coins. The average monthly dispersion between the best and worst performing coin in a month is about 60%. And in about half of all months, there's at least one coin that's positive and one coin that's negative. And these are the 10 biggest assets. If you go outside of that, the dispersion is going to be much larger. So, that far trumps the kind of dispersion you see in S&P 500 securities. It far trumps the dispersion you see in different corporate bonds. It is a relatively diverse asset class. But as we've been saying, it's still early, and that will only become more so.
Yeah, I think these guys have made some good points. The only thing I would add is, with the introduction of, some of these commodity-backed or digital tokens that are tied to a different asset, they kind of the opportunity expands pretty substantially, especially with something like token sets. You think about how digital gold now can be introduced into some of these baskets, and I think the possibilities become a little bit more endless. And bringing in new risk and trying to avoid excessive correlation becomes a lot easier.
Sure. Looking at this performance and trying to manage it, trying to understand it, what do you think is the best benchmark for the average investor, and then also for the institutional investor? Should they be using Bitcoin as the benchmark? That's what a lot of people say. I think that's why we look at the Bitcoin dominance, because we want to understand how this certain crypto asset is performing versus Bitcoin. should they be using Bitcoin or should they be using, an index like we have in the S&P?
So,
yeah, go ahead, Brian.
So, I mean, from my perspective, it's a matter of perspective and what you're trying to ultimately capture or evaluate yourself against. If you're looking at the entire crypto market as a whole, as the opportunity, and you're trying to kind of outperform the crypto market as a whole, then you'd want to use a basket, something like the Bitwise basket. Whereas if you're trying to, Bitcoin has kind of been the de facto leader for 5-6 years, in the kind of the comparison game. And I think that's probably an easy choice to make to lever or benchmark yourself against Bitcoin. It certainly would be, setting the bar much higher, at least historically, but, we'll see.
It's interesting because I mean, it's kind of the same argument that goes on in the traditional space and even like in the stablecoin space, right? Like you have stablecoins that are back to USD, and then you have these other types of baskets that like SDRs, right? That like are a bunch of different currencies, not just the US dollar in there, trying to balance the weight of the US dollar versus everything else, right? And it's kind of the same thing that's happening in the crypto space with the argument around is it to be priced in Bitcoin or should it be priced in a basket of things? And yeah, it's just it's not really that new of a conversation, really. It's kind of just going on, and yeah, just to make that point.
Yep, makes sense. As we look forward then to the rest of the year, towards next year, what baskets or sectors are you guys most bullish on? Obviously, DeFi is stealing most of the show right now, but do you think another sector reemerges and can kind of take that attention, can take some of that performance? What, or maybe even just a theme, even if you aren't basket specific, what do you think emerges as investors continue to look at investing in cryptocurrency baskets?
Wow. I'll give you two barbell answers to that.
Yeah.
For one, I think a massive theme this year in the crypto market in general is the entry of traditional investors and institutional investors into the crypto space. And you're seeing that in the rise of Bitcoin futures volume and in asset flows into major asset managers. And those investors, I think, are going to be terrified of inflation in the rest of the year. And so I do think we're going to see digital gold and Bitcoin particularly have a nice run. I think an interesting area to look at, which is the forgotten sort of stepchild of the basket space, is privacy coins. They're excluded from the Bitwise indexes because of the regulatory risk. But as the world sort of teeters closer to insanity, I think that could be something that catches interest. And I don't think the DeFi story is going away. So I guess I'm covering my bases. But I do think people forget about privacy coins as an area of the market because they've largely been excluded from institutional conversations. And I think with the rising chaotic nature of the world, I think they could find a bid as well.
Yeah, I'd also add to that, that I think, obviously DeFi is the story of the day, as has been reiterated here, but there'll be more and more pools and more different types of ways to invest within the DeFi space, which in and of itself would be baskets. I also think more and more innovation will happen within like these perp type of contracts out there, which are a different way of getting exposure than your traditional space, than the traditional way through a traditional basket. But I think like one of the more important things to always think about when you're thinking about any type of portfolio construction or just investing in assets is sector rotation, right? So like, DeFi is hot now. It will go out of favor at some point. There's a lot of unloved assets out there that have been building since 2018, 2017 that are in spaces like maybe virtual reality, gaming, DAOs or whatever. And they're undervalued right now versus like everything that's been happening in DeFi, and people have forgotten about those projects, even like mid cap to large cap, bigger protocols out there, layer one protocols that are like out of favor right now, the Ethereum killers and all that kind of stuff. Like money flows into different parts. And, if those, like if something emerges out of those, like say Ethereum 2.0 has like glitches in it, maybe you get like baskets of layer 1 solutions out there that are like the Ethereum killer index or something like that, or the gaming index and et cetera. And, you know, so I think that's something that you want to look at as well. It's really hard to say right now though, when that happens, because there's so much real hype and so much money moving into DeFi that it just seems like there's going to be a lot of portfolio construction and pool construction going on there for quite a while. But yeah.
Yeah, I mean, from my perspective, I would really just love to see a Bitcoin, you know, ETF first and foremost. I think, you know, something like that is going to, you know, pave the way for the rest of these conversations to have, you know, be meaningful. And that's in the CeFi space. In the DeFi space, you know, I don't really have like a specific preference, but really would just love to see something, you know, win or be really, really successful, so that it is, you know, kind of a de facto, you know, choice for the market, and, you know, can build and grow into something that is, you know, very successful, where, you know, there are liquidity providers providing liquidity, and, you know, it's something that we can all point to and say, you know, this is a success of the market, and is a clear example that, you know, the market should continue to develop in this way with clear guidelines around it.
I think we all want the ETF, and I think everyone's been waiting.
It's an easy answer.
Exactly. Everyone's been thinking about it, but I have to ask the question though: do you guys think it happens in the next 6 months to a year? I remember a year ago people were saying, just wait 6 months, the ETF will pass. Do you think it's inevitable in the next year, or is it still like 50-50, something closer to 25%? What do you think, Matt?
6 months and a year are two different time frames. I think 6 months is difficult because we're entering an election season, and the SEC tends to clam up during election seasons. But real progress is being made. So at Bitwise, we have multiple people working full-time or more than full-time trying to push forward a Bitcoin ETF. And I think we're narrowing the scope of concern rapidly. So I do think a Bitcoin ETF will happen. I'm skeptical it will happen before the election. But I think we'll get it soon, and I think that'll be a great day for the industry, and honestly a great day for most investors who still don't have an easy way to access Bitcoin through their primary brokerage and retirement accounts. So I'm working hard. I'll be working on it after this call tonight.
Yeah, I would certainly defer any guesses to Matt. You know, our objective is when it does happen that, you know, we'll aim to be there. You know, we think we can, you know, provide liquidity, and then it's going to be great for the space. It's going to be, you know, a great opportunity for a lot of investors in general. There is, you know, as Matt mentioned, countless people working on trying to solve this problem, and I think it's going to get done eventually.
George, anything else?
No, I don't have anything to add there. You know, I'm hoping it comes as well. But when it does come, though, my interest is more in just like what that actually means for Bitcoin itself. Like at that point, it's like super mature, and like probably if there's any alpha left in it, it's probably gone. So like from a trading perspective, for me, you know, it'll be interesting to see when it happens and what price Bitcoin is when it does happen. But yeah, I don't have anything to add as to when it may or may not happen.
That's fair. One thing I want to do before we wrap this up, I want to take some questions from people in the chat. So if you're watching on YouTube, throw a question in, happy to propose it. I'm going to put, obviously there's some discretion involved, but one of the first questions we have is from Wook. He said, are VCs sprawling investments individually, or are they mostly focused on specific aspects or specific baskets? Are we seeing them be, you know, coin pickers, or are they looking to play a sector? Do you guys have any insight on where that flow is going?
Oh, I'd say they're coin pickers. You know, I'm looking at projects, and VCs look at projects, they look at teams, and then they invest in, you know, themes that they generally believe in. But overall, it's not basket-ish weighted. It's more companies and, you know, a large swath throughout the whole entire space.
Got it. We also have one from Cointelegraph. They said, how big is the crypto basket business? And one that I've been thinking about is, as we grow these offerings, I know the ETF would obviously bring in tons of money, be very beneficial for Bitcoin and all the other crypto assets. But just thinking about baskets in general, as we create these product offerings that make it easier for traders and investors, is that really something that brings money in, or does it just make it easier for the people already here?
Oh, I think it's huge. I think it's massive. So the reality of crypto is that most crypto is owned by retail investors who control about 8 to 9% of the wealth in a country like the US. The vast majority of wealth is controlled either by institutions or by financial advisors. Financial advisors control $22 trillion in the US, about the same as main institutional investors. The only way they really want to get access to this is through an index. They'll buy a Bitcoin ETF because it's the easiest thing for them to do. But these are the folks who buy SPY and Vanguard funds and BlackRock funds because they just want to make a bet on the sector. And so long term, yeah, I could see hundreds of billions of dollars in crypto index funds. Obviously, the sector has to be much bigger to sustain that flow. But I do think for professional investors, index-based strategies are going to capture, I don't know, 30, 40, 50% of the market long term. And that's a really big market.
Yeah, I mean, look at what Grayscale has done. You know, those guys have done very well and are, you know, very smart on top of what they're doing. And they solved the need for the market, and you know, it's become very clear. I would imagine that they're very focused on a Bitcoin ETF and what it would look like as well.
Yeah, and I just add to that I think like the whole entire basket ETF type of premise is predicated on the fact that you're going to get more of these traditional investors coming into the crypto space that want some kind of broad exposure, as Matt said, but don't want to have to pick it. For the most part, most of the traders that are in the crypto space now prefer, they don't own baskets, right? Like they're immersed, evolved, and they're trading these big, wild, crazy, volatile moves that you're getting in coins every day. A lot of it is, you know, based on technical analysis and, you know, information flows and stuff like that. So, you know, there's more upside for, you know, the average crypto investor to just run their own strategies and maybe use some of these lower end type of, well, I wouldn't call them lower end, but just a more exotic type of basket like type products like the FTX products where you actually get big returns on them, right? Or losses, whatever. So yeah, I think like it's definitely predicated like on getting Robin Hood type numbers into the crypto space.
So what I'm roughly taking from this, more baskets is more bullish. I think that's a fair generalization.
There you go. I love it.
Yeah, I mean, the more people want, the more product offerings means that people want more products. So that means that's good. Yeah,
it's good. It's good. That's good for me. You know, bullish. Bullish. All right, guys. That is all I have today for the introduction to cryptocurrency baskets. I want to thank Cointelegraph first off for putting this entire event together, but also this panel, Matt, Brian, and George. Thank each of you for taking the time as well.
Thanks for having me.
Thanks so much.
Yeah, of course. And with that, I think we're going to wrap up this Cointelegraph stream. Thanks for everyone hopping in the chat, asking your questions. Hopefully did my best to pick some. Hopefully you got your answers. Thanks everyone for stopping by. That's all we got.
Thanks a lot.
Yep.
All right. Bye-bye.
Bye.